Forward by Ryan Levesque. On March 23, 2019, I had a conversation that changed my life forever. That conversation was with a guy by the name of Justin Donald. Everything changed when he whispered 4 words to me over lunch that I will remember for the rest of my life. These 4 simple words sent me on a journey that changed my life in ways I couldn't imagine, at a time scale faster than I ever dreamed possible. And if you pay close attention to what you hear in this book, the same could be true for you. Let me explain. First, if you're like most people listening to this right now, you probably have a dream to achieve financial freedom by generating enough passive monthly investment income to cover your lifestyle expenses, and then some. In other words, to be in a position where you no longer need to work. Or, right now, you might be working a job and making decent money. Or you might own a business that makes decent money, but it's one that requires your time, perhaps a lot of your time. That scenario is the exact position I was in when I first met Justin Donald. The day was Saturday, March 23rd, 2019. I was attending a retreat in Austin, Texas as part of a group I had recently joined called Front Row Dads. A fantastic group devoted to being a better father, husband, and family man. It was at that retreat where I first met Justin. After meeting for the first time earlier that day, Justin and I decided to have lunch together, the two of us. Talking about fatherhood and family, the conversation eventually led to the inevitable question, so what do you do for a living? Justin motioned me to come in closer. I'm a lifestyle investor, he whispered. I looked around to make sure nobody was eavesdropping on what suddenly felt like a clandestine conversation. Lifestyle investor? What does that mean exactly? I asked. He told me his story and how he had reached complete financial freedom in his 30s, and how he did it without receiving a massive exit or inheritance, but instead by taking an unconventional approach to cash flow focused investing. So wait, you're telling me you generate 100% of your income through passive investments? I asked skeptically. Okay, so how would someone like me in my position get started doing the same thing? Well, I'm happy to share if you're interested, he replied. How much time do you have? Now, before I go any further, I need to backtrack a moment. You see, I met Justin when I was in my mid-30s, and I had just spent a better part of the last decade building a successful multi-million-dollar business. As a kid, I grew up working class and was the first in my family to go to college. After graduating, I went to work at a job making $42,000 a year, and a few years later, making 6 figures working for myself. Eventually building a $10 million plus per year business together with my wife that we started from a 500 square foot apartment with $5,000 we had squirreled away in our savings. And even though I had traded working for someone else to working for myself, my wife and I were still working. And we were still working a lot. Sure, we had more control, more freedom, and more income. Sure, we had good financial habits, lived below our means, and worked hard to continue saving for our future. But at the end of the day, we were still working to make money. Money certainly wasn't working for us. And with 2 young boys who were growing up faster than we could believe possible, the idea of being able to cover 100% of our family's living expenses entirely through passive monthly investment income so that we could take time off, spend time together as a family, travel the world, and create memories together that didn't involve work was immensely appealing. But it also felt like a pipe dream, not something possible for people like us in our situation, at least not right then, maybe in a few years, but not with everything else going on. As Justin continued to go deeper and deeper into his story and share the details of how he did it, I began crunching numbers in my head, and it felt strangely doable. This wasn't about building a well-diversified portfolio using low-cost index funds across multiple asset classes, waiting for decades of compound interest to kick in. But it also wasn't about scrambling to put in all your chips on the latest IPO or hottest tech stock either. In fact, it had almost nothing to do with investing in the stock market or any of the public capital markets for that matter. Now, as someone who had worked for the investment bank Goldman Sachs in my early 20s, Justin's approach was, in a word, unconventional, but at the same time, it made complete sense. When our lunch that day drew to a close, Justin posed a question that hit me like a sucker punch in the gut. He said, "Your kids will grow up before you know it. Why wait when you could have the lifestyle you want right now and enjoy the greatest years of your life today?" He was right. I left that conversation with a renewed focus, a renewed sense of purpose, and a renewed sense of urgency to take immediate action. I decided to do whatever I needed to do to learn everything I could from Justin Donald and take massive action based on what I had learned. Now, a few months before that fateful lunch, my wife and I had sat down to set our 5-year financial goals together as we had done practically every year together since we had been married. We'd set an aggressive stretch financial goal to generate enough passive income outside our business to cover all our family expenses within the next 5 years. In other words, it was our big someday maybe goal, something I'm not sure either of us believed was even possible. Fast forward to March 2019, less than 6 months after deciding to learn everything I could from Justin and take massive action towards our target, we had hit 53% of our 5-year monthly passive income goal. I'll say it again. With Justin's help, we hit more than half our 5-year stretch financial goal in less than 6 months. I'm talking tens of thousands of dollars per month in real cash flow generated from 100% passive investment income. And by the way, as crazy as it feels to be writing this, I'm expecting we'll exceed 100% of our 5-year monthly passive income goal within the next 12 to 14 months, if not sooner. And we did it simply by following Justin's 10 commandments of cash flow investing. We did this by investing in many of the exact deals Justin reveals right here in this book, and by taking copious notes and paying incredibly close attention to everything Justin shares. When Justin writes, it's not as hard as you think it might be, and it doesn't take as much money as you might think. He is right, but it does require the right focus, the right strategy, and most importantly, it requires the right teacher. If there's one thing I've learned in my career in business and life, one thing I can describe as the secret to success, it all comes down to 3 simple steps. When there's an area of your life or business in which you want to improve, step 1, seek out a mentor, someone who has done what you want to do. Step 2, invest what it takes to learn everything you can from that mentor. And step 3, strive to become that mentor's number 1 student. That's it. It's really as simple as that. For me, in this particular area of my life, Justin Donald is my mentor. What I've learned from Justin has changed my family's life forever. And for that, I am forever grateful. So I'll end by saying this, as clearly as I can. Listen to this book. Study everything Justin Donald shares. And most importantly, put what you hear into action. And the next time you go to lunch and someone asks you the question, "So what do you do for a living?" maybe you'll be able to reply with those same 4 life-changing words, "I'm a lifestyle investor." Ryan Levesque, 3-time Inc. 5000 CEO, #1 best-selling author of the books Ask and Choose, featured in the Wall Street Journal, Harvard Business Review, Entrepreneur, and NBC News.
Justin, we have in the book 2 forewords. First of all, congratulations, because that's pretty cool. Good accomplishment there.
Thanks.
Yeah, but the first one is Ryan Levesque, and Ryan is quite the mover and shaker. He is definitely known in the internet world. But you tell the story about Ryan, and basically he mentions that you changed his life. How cool was that conversation and that day in particular?
Well, it's really flattering. I think Ryan is just an amazing guy, and his forward was just really nice. It's cool seeing the story from his eyes and how it unfolds, over a period of time of us meeting each other. Because when we met each other, we didn't know. I'm not in the marketing world, so
Sure.
I didn't know really who he was. Someone had said, hey, this guy Ryan, he's got a big name, and I met him at Front Row Dads, a mastermind basically for fathers who want to be family men first, then businessmen second. And so I figured the guy has to be a really cool guy, and I just got to know him, and he is just amazing, and we've had so much fun just furthering our relationship and friendship.
That's fantastic. And he was at a place in his life where he did start to see the lifestyle investor concept, but he thought it was going to take 5 years. He thought it would be something that would be this big stretch. And all of a sudden, you're sitting at this lunch, and he starts pretty much eating up what you're saying and starts applying it. And then in a very short time, surprising to him, all of a sudden, the lifestyle investor concept becomes his reality. Is that normal that somebody in 6 months starts experiencing such dramatic results?
Well, it can be normal. It just really depends on the person. So, really, it's a compliment to Ryan because he is a man that just takes action. And he didn't question, he spent his time doing his research. And once he knew that this made sense because it was totally contrary to everything he had learned, and he had spent some time in financial services. So it was very opposite of how he was raised in the financial world. Once he got his mind around it, he just took action. And for anyone that takes action, that's the reality. I have several clients that is the exact same story with them, where they immediately took action and got results way faster than they thought they would.
Yeah, he says 53% of his 5-year monthly passive goal, he got that in 6 months. That's unbelievable. Now, you have a young daughter. Ryan has young kids. I've started listening to your content. I have younger kids as well. Is this only for young families, or is this for older people? As we start out this book, what is the demographic for this particular book?
Well, it's really for anyone because, in my opinion, everyone should be saving and investing a portion of the money they make. So it doesn't matter if someone's a high income earner, a middle tier income earner, a low income earner, as long as someone can be disciplined enough to take a portion of what they earn with each check or each commission and set it aside to invest. Anyone can do this because you can start small or you can start large. And in fact, this is one thing where you don't have to start off with a huge clip of passive income to cover everything. The goal is to start with something. Can you cover your mortgage, or maybe it's your car payment, or maybe it's your utilities, but it's starting somewhere and covering some of the regular expenses that are going to happen every single month.
Fantastic. I love what Ryan says in terms of how he really filtered you to see if you were someone that he should study. He said, step 1, he seeks out a mentor, someone who has done what you want to do. Step 2, invest what it takes to learn everything you can from that mentor. And step 3, strive to become that mentor's number 1 student. That is fantastic advice, and that's really what the listeners can do through this audiobook, those 3 steps. Is that something that you've done in your own life, Justin?
Yeah, most certainly. I feel very privileged to have had the mentors that I have had. But I do want to say that I've been very intentional about getting the mentors that I've had. I have tracked people down that I was not on their radar. They had no clue who I was, and it was my intention and my purpose to make sure that they knew who I was and that I wanted to learn from them and I was willing to be their mentee or their student or their guinea pig or whatever. I just wanted counsel and advice and wisdom. And, I was blessed with several people over my life that have poured into me. Forward by Mike Koenigs. What if you could wake up whenever you wanted, do whatever you wanted, and know that all your bills were covered? You could travel wherever and whenever you wanted and know you could have an amazing lifestyle. You could send your kids to the finest schools, wear great clothes, drive your favorite car, and live in the home and neighborhood you've always wanted without fear of running out of cash. And what if you could do it all without having a regular job? To most of us, that sounds impossible. But you're about to meet a master of cash flow investing for passive income and financial freedom, Justin Donald. Justin walks his talk, and as soon as you hear the chapter Commandment 1, Lifestyle First, you'll get a strong sense of what's possible, no matter what kind of investing climate you're in. Most importantly, you'll soon learn how to invest without requiring that you have money to invest. I met Justin on the island of Fiji a couple of years ago and was immediately intrigued by him. My first impression was that he seemed like a nice accountant or CPA type. After getting to know him, I realized he was exceptionally smart and creative, lived a lifestyle I only dreamed about, and built it from practically nothing in record time. All that was packaged in a values-driven, disciplined, no-ego, likable person. Before meeting Justin, I was a dumb investor, but I didn't think I was. I had investments in some stocks, mutual funds, and a whole bunch of startups going back almost 20 years. Unfortunately, nearly all those were equity investments, and not one that I can think of had liquidated. In other words, I had been providing a whole bunch of people interest-free loans with no guarantee of future performance or profit. Dumb. Here I was, a successful serial entrepreneur with plenty of assets earned over 30 plus years, but with very little knowledge of what to do with them. After one simple conversation with Justin that lasted about 20 minutes, he'd introduced me to some of the concepts that are now in this book for rethinking the way I would approach investing for the rest of my life. That included making sure I was generating monthly or quarterly cash flow, gaining equity, negotiating bonuses, negotiating what he calls sidecar agreements that produce even better returns because of enhanced terms, realizing the return of principal in a relatively short period, and fascinating ways to use existing investments or insurance policies to fund these new investments. Along with that, he'd offered some interesting and fully legal ways to provide huge tax advantages. He also shared some of the most interesting ways to select hidden deals and opportunities most investors would never think about. My only regret? I didn't meet Justin sooner. Suffice it to say, the way I think about investing and money changed in those few minutes. In this book, Justin shares some unique strategies that enable him to make more money without having to invest or take more risks. He does this by stacking his systems and developing a unique mindset for finding unparalleled opportunities that would normally go completely unnoticed by typical investors. He'll show you how to leverage your resources and assets to build a unique portfolio that can pay you every month or every quarter to build and grow equity. You'll also understand what differentiates a great investor from an outstanding investor: mindset. Justin built his net worth to tens of millions of dollars in just a few years using the exact strategies you'll learn in this book. And if you have any doubt whatsoever as to whether Justin, his methods, and character are real, head over to his website and listen to, watch, and read a few of the testimonials from people who experienced actual results with his system. You'll quickly understand and see Justin as an amazing mentor and advisor to lots of people who didn't want to take 10 or more years and risk millions of dollars to achieve what he has accomplished in a fraction of the time. In short order, Justin has a system for investing and making money that flat out works, no matter what level you're at in your investing career. If you ever get a chance to work directly with Justin, do it. He's incredibly busy with opportunities and professionals who want to study with him, but he never does it at the expense of his lifestyle or family. The fastest way to become an exceptional lifestyle investor is to learn from someone who's doing it right now. Justin Donald is your guy. Enjoy this book and make sure you check out Justin's free videos and resources on his website. Mike Koenigs, serial entrepreneur, San Diego, California.
Justin, I love that second foreword by Mike Koenigs. People who know Mike know that this guy is quite an influencer, and he's helped Tony Robbins, he's helped JJ Virgin, he's helped all kinds of people throughout the world in the personal growth industry. And yet here he says, prior to meeting you, he was a dumb investor. That's interesting that someone can be that smart in their expertise, but yet consider themselves a dumb investor. Do you run into that a lot, Justin?
Well, I run into people that have never heard of what I do, that my philosophy and my strategies are just totally in another world from what they've ever experienced. And so, I don't think that there's necessarily, someone that's a dumb investor. I just think that someone's uneducated and they are going to have the opportunity, if they choose to grow their education. So Mike, I think, is a very smart and sophisticated guy. I mean, one of the smartest guys in many different areas. But he's also a quick learner. I mean, the guy just picks things up so fast. And so it's been neat, really seeing him and seeing the way that his investments have shifted. And, part of the reason that he, kind of calls himself a dumb investor is because his only way of doing things is the way that is more conventional, that everyone, or most people have done things, because it's the only way they thought they could do things.
Yeah, and by that, the conventional, you mean the classic stocks, mutual funds, high fees. I mean, these are things that have been passed on as common sense for years. Why do you think there's this new emerging desire to have a lifestyle investor versus the classic advice we've all been given?
Well, I just think there's more education out there. People are not willing to have the wool pulled over their eyes the way they were. There's a lot of what was the norm that's being challenged in a lot of different areas, not just in the financial world. We're seeing it today more than ever before. And I just think that people aren't willing to take whatever the status quo, whatever it was, whatever is common, whatever everyone else is doing, as the law and as the way to do it. And I'm just so pleased that people are taking their financial education seriously and not just relying on the government or relying on financial advisors that are likely not going to be able to deliver the results potentially that people expect they're going to deliver.
Mm-hmm. Mm-hmm. So with Mike in particular, you mentioned that Ryan succeeded with this model because he was a quick learn, he took action. I almost think there needs to be some humility with this process. In other words, you have Mike and Ryan and others who are going to be, listening to your content here, and there has to be humility to take your advice, to say, I don't have it all figured out. How important is that? I know you're a lifelong student. I know you've invested over $1 million in your own education. How important is it that we come to this conversation of investment with some humility?
Well, I think it's incredibly important because, as I tell people, I'm an eternal student. I'm a lifelong learner. I know that I don't know everything, and I know it's really important to put people around me that know a heck of a lot more than what I know. So I think it's important to be smart enough to recognize when you need other experts and advisors. But I think that humility needs to be there as well, because someone for me, someone should just be, my best clients are just eager to learn. And when you're eager to learn and you're open and you're receptive, it's amazing how much more you learn and then how much easier it is to take action. Even for action-oriented people, for someone that's used to just taking action, great, that this is probably going to be pretty simple. But for someone that's not, as long as they can come open and willing to learn, they're going to be able to take action a lot easier because it makes sense, because it's common sense.
I love it. And you said recently when we chatted, curiosity. So I know that as I've been around you, I've learned all kinds of words I never knew, these new terms. As we start out on this journey, how important is it that the listener, at whatever level they're coming in, remains curious and not overwhelmed by some of the terms?
Yeah, so the curiosity part of it is everything because it keeps you open. Whenever you're introduced to things that are foreign, or you just don't have as much of a education on, it can be intimidating. I remember when I first started investing, there were just tons of terms and ideas and strategies, and it really felt over my head. I wasn't sure, but I remained curious, and that made me want to learn more, and it helped me understand quicker. And so, yeah, I do think that curiosity is imperative, because anytime you could get frustrated, if you show up curious instead, you're going to be able to learn and absorb these concepts, whereas frustration, you may be blocking some things out. Preface. Welcome to the Lifestyle Investor. My favorite things in life don't cost any money. It's really clear that the most precious resource we all have is time. Steve Jobs. In this book, I've captured the most important concepts of how I invest. When I started investing, I was tired of trading my time for money. Learning there was a way to earn money that didn't require my time piqued my interest. As I continued my research and learned more, I discovered a community of people who regularly lived the life I desired. I thought, why on earth am I spending so many hours working the way I am to generate the income my family and I live on? I wanted to create independence from how I spent my time and the income I earned. From the beginning, it was important that I could spend as much time as I wanted with my family and friends and live the lifestyle we wanted on our terms. More than anything, my mindset was to buy back my time. I wanted to spend time with people I love, doing things that are fun and meaningful to us. From enjoying life in the moment rather than someday, to taking care of our health, to living with an abundance mindset and giving generously to people and causes that are important to us. What I've accomplished with lifestyle investing allows all of that and more. This book is about paying it forward and giving back. It's about sharing my experiences and lessons learned so you can achieve the lifestyle you desire. In line with my desire to give back and give generously, all of my profits from this book will be donated to charities that help others improve their lives on the most basic levels. When an article in Entrepreneur magazine called me the Warren Buffett of Lifestyle Investing, it made me realize how much time, money, and energy I'd invested in coaches, experts, events, masterminds, and travel to learn the strategies and framework to build my toolbox. It was at that point that my focus shifted to helping others achieve financial freedom. My first step was to offer private coaching for investors, executives, and entrepreneurs. One of the reasons I started my private coaching group was because whenever I shared my vision for financial freedom, I usually heard, "I want that too." However, the demand for my coaching services became greater than the number of people I was willing to coach in a given year, so I created the Lifestyle Investor Mastermind for like-minded people where the coaching and interaction is done in a group setting rather than one-on-one. Through my private coaching program called my Lions Network and my Lifestyle Investor Mastermind, I have learned and compiled the strategies, philosophies, and concepts that resonate the most with my clients. Lifestyle Investing for You. This book is my next step to help you find your path to financial freedom through cash flow investing. It is the result of my previous study and coaching. You can do exactly what I've done if you follow the guidelines here. I call this book The Lifestyle Investor, The 10 Commandments of Cash Flow Investing for Passive Income and Financial Freedom, because that title resonates with everyone I know. Everyone wants time compression. Everyone wants financial freedom. The power of coaching. The fastest way to get your time back is by investing in smart coaches and advisors who can compress 20 years of knowledge and experiences into 3, 6, or 12 months. Listening to this book is an important step on your journey. While I no longer have clients working one-on-one with me, the Lifestyle Investor Mastermind has become a thriving group that shows members exactly how to implement the lifestyle investor principles and commandments in their lives in the shortest time possible. My goal is to move my clients to cash flow generation quickly and avoid potential setbacks. During their coaching term, I introduce clients to the same deals I have access to. I teach them how to negotiate favorable terms to start generating cash flow immediately with an overall strong return. I teach them how to do this with the least amount of risk, and I show them how to do it all so they can avoid spending the 20 years it's taken me to understand and implement these principles and commandments. Many of these strategies and concepts are included in this book. If you're coachable and willing to open your mind to an expanded future for yourself and your family, you're in the right place at the right time with the right guide. How to use this book. Part 1 of this book contains some background information on who I am and why you want to consider lifestyle investing. I discuss the core principles you need as a lifestyle investor, along with unpacking the most common financial myths to help you reframe your mindset. Finally, you'll discover Murphy's Laws for the lifestyle investor. You don't want to ignore these laws. In Part 2, you'll learn the 10 commandments of the lifestyle investor. With every commandment, I include examples of real deals I've worked through. First, I'll explain the deal to you so you can see the opportunity and why I pursued the deal. You'll learn some of the background and why I felt the deal was worth investing in. To help you better grasp the cash flow investing concepts, the end of each commandment will discuss the mindset, structure, filter, and negotiations used. Finally, I'll sum up each commandment so you can take the principle of this chapter and apply it to your own cash flow investing. Throughout the book, you'll find several investing and financial terms included in the glossary. Each term is set in bold in the physical book. Even though I give a brief description within this book for most of these terms, you'll find a more in-depth definition in the glossary. For you listening to the audiobook, you can go to lifestyleinvestor.com/gift and download the complete glossary of terms. This book contains strategies culled from my extensive investment in coaching, education, and research. Much of the reputable source information is included in the resources section. I hope you'll take time to study these valuable tools. Are you ready to begin your journey to financial freedom? If so, let's begin. Acknowledgements. Writing this book has been one of the most inspirational and creative things that I've ever done. It is the culmination of the last 20 years of my entrepreneurial and investment career. There have been so many lessons along the way and many people who have contributed to the content of this book. I am so thankful to everyone who played a role. It wouldn't have been possible without the help and influence of such an incredible team of high-caliber people. Over the years, several friends have strongly encouraged me to write a book. Their consistent reminders warmed me to the idea. John Kane, Ryan Levesque, John Rulin, John Vroman, Tim Nikolaev, and Hal Elrod, thank you for your friendship, inspiration, and support through this writing journey. I value our friendship tremendously and thank you for your persistence, encouragement, and belief. Mom and Dad, Thank you for raising me in an extremely loving and grace-filled home and giving me the freedom and autonomy I desired to grow into the person that I am today. You always supported me in everything I ever did, and I thank you for that. You gave me choices and allowed me to learn from my mistakes. You gave me the space to grow wings and learn how to fly on my own. I owe so much of my success to each of you, and I thank you both for always believing in me. Mike Koenigs and Marisa Brassfield, thank you for your inspiration and creative ideas. You gave me vision and an exciting atmosphere and environment to create this great content and capture my story. You both saw something special and helped elicit that from me in a way no one ever has before. Not to mention, I have had some of the biggest laughs of my life during time with you both. I am so pleased to not only have worked with each of you on this project, but also for the tremendous friendship that we forged during the past year with all the time spent together. Amber Vilhauer, thank you for your excitement and confidence in everything I have done with regard to this book and all the additional projects that are extensions of this book. You have been incredibly committed to delivering the highest level of service and support, and you've been a great collaborator and partner in so many ways. Your work ethic is second to none, and you really shine in differentiating yourself from everyone else in your industry. I have loved every minute of working with you. Carrie Oberbrunner and his amazing team, including Kirsten Samuel, David Samuel, and Sarah Grandstaff. Thank you all for your thoughtful insight, collaboration, and attention to detail. You are such an incredible team full of wisdom and creativity, and I feel blessed to have been able to work with each of you. I have thoroughly enjoyed spending time with all of you, and I appreciate the influence you have had on this book. Savannah, you inspire me, and so much of what I share in this book is for you to learn when the time comes. I marvel at how much of a learner you already are and how curious you are about everything. This book wouldn't be possible without you because you are the reason why I knew I had to put all my thoughts together in one place. I love you so much, and I can't wait for the time you grow up when you decide you would like to invest with me. Jennifer, you have always supported me in everything I have ever done and have been a great source of encouragement every step of the way. You are truly my biggest fan, and that means the world to me. You have been such a strong figure in my corner through all the challenges and victories of my entrepreneurial life. Your discernment is truly a one-of-a-kind gift. I love you so much and feel incredibly grateful to do life with you every single day. Part 1. The Challenge. Who am I and why should you listen to me? You have to learn the rules of the game, and then you have to play better than anyone else. Albert Einstein. I value and spend time learning from people who are world-class at their craft of investing. I read books and listen to podcasts by smart investors and people who have different philosophies that have worked for them. And as a lifestyle investor, I am intentional about my mentors, striving to be their number one student. Education is one of my biggest keys to success. I've invested nearly $1 million in my education, attending boot camps and seminars, and learning from coaches, my advisory team, and industry experts. To master the gamut of investments, I've studied real estate types, private equity, public equity, debt, especially senior secured, distressed assets, operating companies, franchises, e-commerce, technology, syndications, funds, royalties, collectibles, and more. In short, I want to be skilled and knowledgeable across the board and stress test my criteria to filter and select investment deals. When I first started investing, I didn't know my criteria. I looked at deals subjectively. This makes sense, or this feels right. But over several years of educating myself and analyzing the types of investments I chose, obvious criteria emerged that simplified how I subconsciously, yet consistently, made decisions. Bedrock values. I grew up in a working class environment. My parents are both wonderful Christian people. In the family, they modeled values such as honesty and integrity. My upbringing established a bedrock of values on which I stand. My mom worked full-time as a secretary at the church we attended, earning about $27,000 to $30,000 a year in the late 90s through 2018. A conversationalist, she consistently put people first. She taught me how to maintain strong connections, address conflict head-on, and put good relationships together. My dad worked in sales most of my youth, selling cars and appliances. I learned valuable lessons about work from him. He worked long hours, often gone from 7 a.m. until as late as 9 p.m., 6 days a week, with an occasional shorter day. He wanted something better for me and didn't want me to work as hard. His example paved the way for my own success. His work ethic became foundational to mine. My dad also taught me about goal setting. I saw how hard he worked to achieve his goals. He designed his monthly goals to hit his quotas and earn his bonuses. He shared those goals with me and how they broke down into strategic actions to achieve them. He taught me the essentials of goal setting in achieving my goals. The values of my other family members impacted me. My younger brother joined the Army when he was 18 years old and proudly served our country for 7 years on several overseas tours of duty. I've learned a lot from him over the years about mindset, discipline, and courage. Work ethic. In 7th grade, I remember asking my parents for money. Their reply was, "You need a job. We're not going to be your source of income." So I started selling newspaper subscriptions door to door. I had a similar bonus structure to my dad's. I received a bonus if I achieved a certain number of sales. I broke down what it would take per day to get there, and then I worked hard to achieve my goal. Early on, I experienced a ton of rejection. Salespeople get a whole lot of no's for each yes. Gradually, I built up an immunity to the word no to the point I didn't take it personally. Soon, I became the top salesperson and retained that status through the end of high school. Depending on the time of year, I worked for 4 or 5 hours an evening, 3 or 4 days a week, earning between $250 and $500 per week as a high school student. That was in the mid to late 90s. I loved having enough spending money to enjoy travel, entertainment, and experiences with my friends. Because they were intrigued with how much money I earned, I recruited several friends to work with me. I soon had a crew who sold subscriptions for me, which gave me a taste for leadership and its margins. It was tough at first, and I learned not everyone was a natural at sales. Over time, however, I learned how to hire hardworking, talented people and develop a team that sold under me. The sales pitch I developed was so successful that my boss asked me to script it out for the others to use as well. That was my first sales script, and I used it to train all of the new members on my crew. We laminated clipboards with some of the elements I'd incorporated into my script, including sales goals to earn scholarship opportunities. Once my team started using my language and scripts, I had much more competition because everyone's sales increased. Still, most days I found a way to outsell them. You can see a sample sales script at lifestyleinvestor.com/resources. Competitive drive. I've always been competitive in my pastime activities as well as my work. The thought of accomplishing something I haven't done before has been the most motivating factor, well beyond money or extrinsic reward. My curiosity keeps me open to learning. I love the feeling of setting a goal, achieving it, and knowing I'm accomplishing my best. My favorite games involve more strategy than luck. From card games like hearts, spades, euchre, gin, rummy, blackjack, poker, and racehorse canasta, to board games such as Clue, Risk, Stratego, to video games such as Maze Craze on Atari and Zelda and Mario Brothers, my competitive drive gives me an advantage. Competitive sports of all kinds have impacted my desire to succeed and give my best effort as well. By age 6 or 7, I played nearly every youth sport available in an organized league, primarily baseball and soccer, though I also played a decent amount of volleyball and basketball. Not being good at something wasn't an option. By being persistent, studying, and working to understand the aspects of a sport in which I didn't excel, and playing and practicing until I did, I found success. I loved the camaraderie of a team, but I hated to lose. One particularly painful memory from my youth is that I cried whenever I struck out in baseball. I'd return to the dugout with tears in my eyes. At first, I wasn't sure why I cried, but eventually I realized that I felt like I had let the team down, which I never wanted to do. Family time. I'm a husband and father. When my wife and I started a family, we didn't want to trade time for money. I knew I wanted to show up at every game, recital, and important activity in my daughter's life. When my daughter was young, I chose to work in a way that was not at the expense of relationships. I valued building a life that would give me and my family lifestyle freedom, and that's what I created. In the span of 21 months, right before my 40th birthday, I had investments that drove enough passive income for both my wife and me to leave our jobs. I negotiated deals with over 100 companies, multiplied my net worth to over 8 figures, and established a family-centric lifestyle in less than 2 years. And then, 2 years later, I doubled my net worth again. Lifestyle investing works. I've now mastered the low-risk cash flow investment principles, and I share my experience and strategies with entrepreneurs and executives around the world. In these pages, I share principles that center on creating passive income and significant wealth while being liberated from a day-to-day job. Lifestyle investing works. I've done it. Many of my friends and clients have too. And I know the roadmap for you to do it also. My system for investing and making money flat out works, no matter what level you're at in your investing career. Check out the resources at lifestyleinvestor.com/gift.
As an author myself, I know that sometimes people skip introductions and they think, I'm just going to get into the actual content. But yet, Justin, as I've heard your introduction, it is incredible. And I think it sets the backdrop for this entire book. You talk about how you grew up in a home with wonderful parents, and they taught you all kinds of lessons, but they also had, like every family, they had some basically limitations. And one of the limitations your mother had was the fact that she was always around a $30,000 a year job, which is not bad, but it basically is limiting. And you had a father who taught you a wonderful work ethic, and yet he worked a ton of hours. Share a little bit about some of that upbringing and how it shaped your view of finances.
Yeah, so I feel really blessed because my parents are both incredible. I've got a great relationship with each of them. I've learned great lessons from each of them. And, you know, it's interesting, though, when you take a look at what beliefs exist and where you got them from. So with money, for example, sometimes I would find myself repeating things that my parents said, like money doesn't grow on trees, which is a very scarce type of mindset, you know, having scarcity on how limited money is. And I just didn't want that. And I recognized that that wasn't my own belief. That was a belief I had adopted. And societally, there are other beliefs that people adopt. And so I think it's important to really get clear with whose beliefs they are and really challenging them to make sure that you, in fact, believe it and that there's a basis for that belief. But from the standpoint of just things that I learned, I mean, my mother was so great with relationships and people, and everyone loved her, and I saw the way that she interacted, and I knew that that was important to me, that people and relationships were so important to me. And she's the master of it. And my father just had such a great work ethic. And the work ethic was one of the greatest foundational skills that I could have ever learned, because that is to me, that's the key to getting good at anything you would ever do.
Discipline.
Yes,
Yeah.
there's a discipline to just showing up and giving your best effort. Now, I also want to say that there need to be boundaries around work ethic. I think work ethic can be one of the greatest gifts, but if it's abused, it can be a great detriment. So I wanted to put my work ethic inside of boundaries so that I worked hard when it was time to work. And then I worked hard with my family when it was time to put in family time. And whatever the thing is that I was doing, I wanted to do it to the best of my ability, but I didn't want it to happen at the expense of whoever I should be spending time with in that moment, especially my family.
Fantastic. And as we talk more about this concept, we do have an upbringing that each one of us has to battle with. So for me, in my own story, I grew up thinking the early bird gets the worm, and there's only one worm in that story. In other words, we're all competing, we're all fighting against each other. And it's these terms that I think the listener really needs to unpack, because if they come to the table talking about money and finances without understanding their past, how often do you see your clients, their past view of money, their upbringing, actually hold them back?
That is one of the most common things that I see. In fact, it's the whole reason that mindset is one of the first things that I discuss in my book. It's because most people have the wrong mindset around money, and it's not their fault. It's just how they were raised, and it's just how normal it is in society for certain behaviors to take place, or certain ways of viewing money to take place, or you know, the main way that people invest their money. So I don't blame anyone, but it is incredibly common for people to show up with what I would call baggage around money and what it means and how to properly invest and the beliefs that people have surrounding it.
That's so true. In our upbringing, we often hear about, filthy rich, or we hear about, money is the root of all evil, these types of things. Do you see people almost having this civil war inside, where part of them wants money because they feel like it represents, security or something like that, but then also part of them is opposed to money? Even in movies, it's like the rich guy is the bad guy or something. So let's talk about some of that. I mean, money, upbringing, past, all these concepts. What advice would you give someone as they begin this journey with us right out of the gate? How can they kind of be aware of their past with money?
Yeah, first of all, I would say that people show up and they're either conflicted and they realize it, or they're conflicted and they have no clue. So there's no doubt that there is a tug of war, even if it's subconscious, on how much money they're entitled to or they deserve.
Wow.
And so it exists. People, I can't tell you how many times I have seen the self-sabotage that happens, and people don't even recognize they're doing it. It's a total subconscious activity that's happening that's holding people back. So most people don't have the mindset in the first place. And so that's why I want to spend a lot of time in this book covering mindset. But at the same point, even when they begin to develop it, there are those beliefs that they're going to have to battle against. And so my recommendation is, besides remaining curious and open to learning, the goal is to be a sponge and to absorb everything that you can. So as a listener, you can implement everything you can. But at the end of the day, all you need to do is implement one more thing than you did yesterday, and you'll be better off. And one more thing tomorrow than you did today. So it's really baby steps, and it won't feel like a huge shift, but in a matter of months or years, it's a tremendous shift.
I believe it. Well, you did mention mindset quite a bit. And let's jump in now to the core principles of lifestyle investing. I love how you set the audiobook up by talking about these 4 principles. Principle number 1 is mindset. You've talked about that. And our thoughts kind of dictate our results. What was the mindset that you had early on in some of your beginning days of investing?
Well, for me, I recognized that most people were not getting the results that they desired to get. And most people were following one path, which was invest in their 401k or invest in the stock market or invest in this company for equity and just hope that it pays off and the company does well. So to me, I saw a lot of people doing what is normal or is conventional and not getting the results that they desired. So I just recognized early on that this isn't the path for me. And I also saw a lot of people that were holding back from living life to its fullest today to be able to do it tomorrow. And that didn't feel right either. I just always believed that you could live a great life today and plan a great one for tomorrow and have it get better every single day.
I like that. That's foundational because most people think that they either have to have wealth and that choice or freedom and that choice. Like the two can't coexist, but you knew early on your mindset was to say you can actually have both. I think some people don't even think that's possible.
Well, it's definitely possible, and it's definitely kind of the basis of everything that I teach. It's the foundation because I do believe you can have, you can be like a free-spirited person and just have that freedom, or you can, be really disciplined and hardcore and, do everything you need to be financially free with maybe missing out a little bit. Or you can actually just blend them and you can be a real good steward of your money today. So we're not talking about recklessly spending it, but you can still have a great lifestyle while saving for the future. So my goal is to have behaviors that support building net worth today and into the future and have it growing, but allowing income for today to do the things that would be enjoyable to create long-lasting memories with the people that we care about and love most.
Let's talk about structure. Principle number 2. You say that you're attuned to deal structures and that's one of the core principles. Talk more about that.
So I wanted to have a framework for what made a good deal to me. And I wanted it laid out. I wanted to know what that looked like ahead of time. So that way it was very clear to me if something would kind of fall into the structure is what I think is a good deal or out of it. And so right away, just having the framework of wanting to make cash flow immediately, that would be a simple structure in a deal that either happens or doesn't happen, which for me can say it can help me to make a decision quickly. Do I want to spend a lot of time trying to figure this deal out or do I not because it doesn't meet that criteria? So structure, there's a whole lot of different ways to structure deals, but to have clarity on the structure that works best for you can really make investing a lot easier and can save a tremendous amount of time.
Yeah, I think you said that the structure, well, it leads right into principle number 3, which is filtering. So not only do you have deal structures that you pay attention to, but you have a lot of deals coming at you. You've reached this level where you have more options than you even can do. So there has to be a filter. What are some of those filters and why is filtering important?
So without filters, I would get bogged down on things that just don't make sense, on deals that I shouldn't even be spending time on. So having filters saves me time, but it also helps me make good decisions. So I don't waste time on bad deals. I spend the adequate amount of time on good deals. And it's something as simple as if I'm investing in rental real estate, which I love. There are several different categories that we can talk about, but just rentals in general create cash flow. a simple filtering type of criteria would be it needs to be in a large metro market, a tier one market where there are a lot of people, and I don't have to worry about that economy collapsing because it's supported by just one business.
Fantastic. And I hear you saying that this filter helps you make quicker decisions. So with investment, how important is speed? Because investing can be risky if people don't know what they're doing. But I also hear you saying that filtering allows you to make quicker decisions. How important is speed?
Speed at my level is incredibly important because I need to, well, first of all, I'm investing for myself and my family. Secondly, I've got a lot of friends and clients that rely on me and rely on the investments that I do. And so I need to make sure I'm not wasting time on investments that don't make sense, that are not a right fit for me. It doesn't make them a bad investment necessarily, but it just makes it not the right fit for me. So that's where I want speed. I don't want speed to just pull the trigger on a deal.
Sure.
That doesn't make sense, and that's a recipe for disaster. And I have bowed out of deals at the last minute because I've been rushed. And to me, I am not going to pull the trigger unless I have all the information. I need to know that this is going to work. I would rather not do a deal than do a deal because I was pressured into it or because someone was holding a time crunch, over me. That doesn't make sense. And something else I will say is some of the best things that my filtering and criteria and 10 Commandments in general creates for me and has created isn't just what deals to invest in, but it's also to not invest in certain deals. So some of the, I would even say the best investment I've ever made is to choose not to invest.
Oh, that's good. I like that. Principle number 4, negotiation. This is the one that made the list, but from the audiobook, we've learned that you've created at least $7 million in additional net worth through negotiating preferred terms. In a recent chat with you, I know you talked to me about not having certain people lose or win when they negotiate, but really your philosophy is that everyone can win. Talk more about that.
Yeah, I think a lot of people look at negotiating as like a win-lose or as a very confrontational or adversarial type of relationship. I don't look at it like that at all. To me, negotiating is finding ways that everyone can get what they want. So I don't come into a deal and say, these are my terms, I demand this. What I do is I come in and I say, this is the structure that I normally like. Let me give you some options of what I do and what I've done in the past. I'm curious to know what resonates with you and what doesn't. And it's interesting because a lot of the time, the things that I want match up exactly with the things that the people or companies I'm investing in want. Sometimes I don't want a lot of equity. Sometimes they don't want to give up equity. They think that the equity is going to be worth a ton in the future, but I would rather cash flow today than a whole bunch of equity with no cash flow. So if you negotiate it just right, everyone can win, and that is the goal. So I want a good deal for me. I want a good deal for my group. I want to make sure that I'm protecting the downside risk in any situation, and I want to feel like the investment was a great deal. But I don't want to do that at the expense of whoever I'm investing in feeling like it was a horrible deal. I actually want it to be such a good deal for both sides that they want to do repeat business with me, which happens all the time.
That's even unique right there because a lot of us grew up thinking that in a negotiation, there are winners, there are losers, and you have to essentially game somebody else. But you've just redefined investing partnerships, and really it's about collaborating and not competing. Is that correct?
Yeah, there's no doubt about it. And I want everyone to walk away feeling good. I want everyone to walk away saying, I'm glad we did this deal. I just did a negotiation with a partner that I've already invested with, and they came back and wanted to do another investment with me. And it was very clear that I could have negotiated for more equity in this partnership. And he knew it. He even said that he would have been willing to give up more equity. And I said, I know that I, could rightfully ask for more equity. But the goal for me isn't to maximize or optimize our relationship or the investment. My goal is to get a good deal where I feel good, where you feel good, and that we all win together, that no one has bad feelings. And if you know that I didn't take as much as I could have taken, that leaves you feeling great about me and us working together in the future. Find your path to financial independence. My dad encouraged us to fail. It changed my mindset at an early age that failure is not the outcome. Failure is not trying. Don't be afraid to fail. Sarah Blakely. Over the years, I've studied people's mindsets, what makes them tick, and what they desire in life. Additionally, I've gotten to a place where I understand what I want in life. That's important because what other people want isn't necessarily right for me. If I am clear with the outcomes I desire and I'm firm with my non-negotiables, managing my finances becomes more of a game that I have the freedom to play. Once you reach that stage, you can play too. To become a lifestyle investor and develop a successful cash flow investing lifestyle, you decide what the lifestyle looks like for you. What do you want in life? Why do you want it? How you answer these questions prepares you to work through the next 3 stages towards financial independence. Financial independence. There are different stages of financial independence. Each one is important and helps build momentum in creating the life you truly desire. Stage 1, cover your bare minimum expenses to live. Stage 2, maintain your current lifestyle. Stage 3, live the life you've dreamed about. How you move through these stages is up to you. This book is about how to do it as a lifestyle investor. Stages 1 and 2 are the basics for an everyday working person's life. To move into stage 3, however, you must face and evaluate your mindset. This mindset places limitations on how you look at investments, the value you give money, and how you allow money to affect your life. In stage 3, you're living life on your terms, based on monthly cash flow, not annual cash flow. Financial independence lets you stop doing things that you don't want to do and gives you the freedom to do what you want to do. You can design your life to be what you want and live it on your terms. While money won't solve all your problems, it will solve your financial ones. When you move into the stage of living life on your terms, you experience a total paradigm shift. You move from a scarcity mindset to abundance. Instead of grasping and scrimping with money, you realize it's a tool to accomplish your goals. In this stage, you understand that having a scarcity mindset is probably not the best, and living from an abundance mindset makes more sense. Cash flow investment. Many people make investments in businesses, effectively financing a zero-interest loan for an unknown time frame for someone else. In doing so, they buy equity in exchange for believing that someday they're going to get their money back. That approach to investing is more of a gamble. It's not investing unless they have superior knowledge to understand and negotiate a wise deal. Otherwise, they're rolling the dice and hoping to get the right number. There may be a place for that investing approach for you. But I don't think it makes sense to invest in a way that doesn't achieve financial freedom first, or when the proposed return is so low, or you won't see a return for 10 to 20 years. The more significant part of my portfolio is geared towards generating cash flow. Not only do I expect a return on the principal of my investment, but I want cash coming in from it, and as quickly as possible. Cash flow investing means some sort of cash comes in regularly, whether monthly, quarterly, or some other time frame. The goal is to have it flow in a way that you can live on it. For passive income, it's the idea that this money isn't based on work, but on assets and other money working that doesn't require your time, or in many cases, anyone else's time either. My goal is cash flow within the first month. For some investments, that goal isn't realistic. The first distribution might not be for a quarter or longer. But for new investors, it's optimal to invest in a way that provides some amount of cash flow immediately. My end goal for each of my investments depends on the specifics of the deal and how collateralized the investment is, meaning how secure and safe the principal investment is. It also depends on how much I'm earning on that principal during the investment. If my return is high, I might be okay having my principal remain in the investment longer because I'm earning a good return on that money. Most of the time, however, I like to get my principal back as quickly as possible because often my equity position would remain the same, even after my initial principal has been repaid. I want that principal back to reinvest in other deals. For me, the ideal scenario is that I get the principal back in 1 to 2 years. Certain real estate investments might not return principal as quickly, but they still could be inside a 3-year window. That time frame is acceptable to me, but rarely longer. Real estate and debt investments are two of my favorites. I'll touch on them briefly here and in much greater detail later. Real estate investment. Location and structure are important when investing in real estate. Focusing on a good location can reduce risk. For example, you don't want to be an investor in a town with only one major employer. If that employer were to go out of business, the whole town would suffer. If the whole town suffers, real estate would become less valuable, harder to keep occupied, and harder to sell. I prefer investing in large cities with large populations and strong economic growth. I like to see a couple of key indicators that typically lead to having a strong occupancy, such as a market with a wide array of large employers, strong healthcare providers, and several good educational programs and universities. The way you structure your real estate investments is also important. Look for deals that give you a lot of options for returns. For example, you can invest in certain real estate asset classes, which means a group of investments that behave similarly and are subject to the same market forces, to provide you with an opportunity to earn long-term equity while also getting a preferred return that generates cash flow. A preferred return is a profit distribution that is paid out to investors prior to the general partners who run the day-to-day operations being able to take any profits. So, you would have cash flow coming immediately. Also, you want to invest in assets where principal comes back quickly and you still maintain your same equity position. This quick return of principal with immediate cash flow allows you to make other investments and create more equity positions and additional cash flow sources. Debt investment. I'm a big fan of debt investments backed by collateral that pay a high interest rate with monthly cash flow. Often, in this sort of investment, you can negotiate a kicker. A kicker is an additional perk that you negotiate into a deal, and often you get it for free. Here are some examples of kickers with additional perks. Equity, a percentage of ownership in an asset. Warrant, an option to buy equity in the future at a predetermined price. Revenue share, a percentage of the total revenue that is paid out. Profits interest, equity right based on the future value of a company. There are many different ways to create a kicker. I like to be flexible, stay creative with the process, and come up with ideas that best suit my family and me. These kickers may seem like small perks in the beginning, but there is a compounding effect that happens when you continue adding multiple kickers over time. If you choose to go after kickers, what ends up happening as an investor is you can get all your money out of each investment and still retain the kickers to participate in the long-term growth of the company or investment. And best of all, these kickers don't cost you anything extra to begin with. These steps will assist you as you find your path to financial freedom by examining your mindset and choosing your investments wisely. Core principles and criteria for lifestyle investing. My number one guiding principle for a successful life: do the right thing, not the easy thing. In every moment of choice, choose to do the right thing over the easy thing, and your becoming successful is inevitable. Hal Elrod. 4 core principles guide every investment I make. In part 2 of this book, as part of explaining each of my 10 commandments based on these principles, I'll walk you through how to apply these principles to each specific commandment. Right here, I want to introduce you briefly to each principle and commandment. Principle 1, mindset. The best investment you'll ever make is your mindset and personal growth. Nobody can ever take away your knowledge and education. From Warren Buffett to Benjamin Graham, Ray Dalio, John Templeton, George Soros, and John Bogle, each mastered their minds and fears to become incredible people to model. The same can be true for you. I have invested a tremendous amount in my continued education, and I read over 100 books a year because the most important investment in my portfolio is my ongoing learning and personal growth. My mindset on any given investment guides my choices. Principle 2, structure. Do you want to know how to double your return on investment, or ROI, with zero risk? Learn how to structure a better deal. Structure is the relationship between specific investment terms in an agreement. I'm highly attuned to deal structures. Almost every deal I invest in must produce predictable, recurring cash flow. Ideally, it produces cash flow and equity with a quick return of principal. What you'll discover in chapters ahead is what I call a strategy stack, a way of combining multiple non-obvious approaches to earn an even greater return with low risk. Principle 3, filter. What's the fastest way to determine a great deal or discern something you should run away from as fast as you can? Filters. Filters are criterion used to sort through and narrow down investment opportunities. Using filters to screen investments saves significant time and creates greater efficiency. I've developed sophisticated filters and decision trees to determine whether an opportunity meets my criteria and should be acted upon. These filters often help me spot invisible deals, more on that later, and avoid overwhelm. The better my filters are, the more time I can spend evaluating high-quality investments. Principle 4, negotiation. Negotiation is a core part of my investment strategy. All opportunities are negotiable. Negotiating is not necessarily confrontational or adversarial, so never assume a term sheet is the final word. I've created at least $7 million in additional net worth by negotiating unique and preferred terms. I'm regularly pulled in by investors and companies because I routinely stack multiple strategies to get increased returns through additional stock, warrants, advisory shares, and various other deal terms, often with reduced fees and lower minimum investments. My goal of negotiating is to find terms that are win-win for both sides. Because of how I negotiate, many companies and investment groups I have worked with in the past come to me first on future investment needs. The 10 Commandments. For years, friends have asked me to write a book to share my principles, commandments, strategies, and secrets to investing. At first, I didn't know exactly what those were, but looking back at all the deals I've done, I discovered a pattern, and with it, the criteria I have used for investing. I call my criteria the 10 Commandments of the Lifestyle Investor. In upcoming chapters, I share one or more investment examples with each commandment to demonstrate how you can also apply each of these to your own investments. Before I get into the 10 Commandments, I want to mention the best deal that I've ever done. It's produced the largest return of any investment that I've ever made. It's something that anyone can do, but most people don't know about or leverage. And it can single-handedly change the trajectory of your life. Would you like to know what it is? Head to lifestyleinvestor.com/gift and download my tax strategy playbook. Here's a brief overview of the 10 commandments of the lifestyle investor. Commandment 1, lifestyle first. Your investments are truly passive income rather than a factor of time spent in the business. Passive income means you're earning income while you're sleeping or offline. Commandment 2, reduce the risk. Examine deal structures to minimize risk and maximize returns. Commandment 3, find invisible deals. Watch emerging markets and unconventional investment opportunities, including new and disruptive technologies or companies in a reinvention phase. Commandment 4, get the principal back quickly. Can you get a return of your principal investment in 1 or 2 years? The quicker you get your principal back to invest again, the more your investments compound. Commandment 5, create cash flow immediately. Can you negotiate cash flow monthly or quarterly? The more cash flow you have, the more it can support your lifestyle and eventually be used for additional investments. Commandment 6, find an income amplifier. Negotiate preferred terms or sidecar agreements to amplify profit potential. Commandment 7, plus the deal. Investigate the perks and terms to optimize the deal for lower risk, greater returns, and long-term value. Commandment 8, cut out the fat. Eliminate any unnecessary fees, whether they're through middlemen, banks, or other financial institutions. Commandment 9, use leverage to your advantage. Non-recourse loans are one strategy to protect investors if an investment underperforms. Sometimes the benefits of working with a financial institution outweigh their fees. Commandment 10, every dollar of investment gets a return. If you hire professionals to support you, i.e., your legal, tax, and financial team, ask them questions to educate yourself as you work with them. Make sure you learn what they're doing and why they think that is best for you, as opposed to just having them do the work on your behalf. The goal is to walk away more educated than when you showed up. One of the biggest keys to success in investing is to have criteria, like my 10 commandments, that guide your investment decisions. Your criteria allow you to invest based on a thoroughly thought out process and not on emotion. If you have well thought out criteria and your potential investments can satisfy each of those particular criteria, then you have a good indicator that you have a strong potential investment. What you will notice as you continue reading is that most of the investment examples I use in this book apply to most, if not all, of the 10 commandments, and not just the particular commandment they are listed under. I don't always point it out, so be sure to look at each example and see how that particular investment fits in each of the 10 commandments.
Justin, you titled the book something very unique. I think you could have switched the title and the whole book would have changed. But you call it The Lifestyle Investor. You didn't call it The Investor's Lifestyle. And now in this section where you're welcoming us to the lifestyle investor, why is it so important that the words were ordered the way they were?
Well, I think the most important thing is living the life that you desire. So to me, lifestyle is the most important thing. It's getting to choose what your day looks like every day, who you spend time with, how you spend that time, where you're spending it. To me, everything is about lifestyle. I mean, having money is great, but money is a means to an end. The goal is not to accumulate money and have no lifestyle, which a lot of people do that, unfortunately. And it makes for an unfulfilling life. the goal is to have an unbelievable lifestyle and use the resources and money that you're entrusted with to live a great life and to inspire and help other people in that life.
I know you talked also how some people almost suggest this denial life, where I've heard it before, hey, don't drink that smoothie or that latte because in 10 years or 20 years, that's going to be a $200 smoothie or something like that. It's almost like this deferring of the life until you reach the very end, where a lot of times you don't even have the health or even the ability to enjoy the resources. How unique is that to basically blend both together, the money, the investing part, but also enjoy it now? That sounds so contrarian to so much of what we've been taught growing up.
Well, the reality is we don't have to do it as extreme as maybe what people in the past have said. I think that there are different groups, different institutions that want our money, and so it might be to their advantage to encourage that everything that we make go to them. And I just don't see it that way. I also don't want to live out of a scarcity mindset. I don't want to think that because I gave up, having something that I want today, that I now have ruined my future. I don't believe in that, and I'm never going to believe in that, because I know that the better I feel about my life today and the more abundantly I live, the more opportunities it's going to create for paving an even better life and an even greater wealth and net worth. There are just more opportunities.
It's almost like I've been taught that it's the people who are wealthy who are all consumed with money, but I think it's actually the opposite. I know a lot of people that don't have money. They're more focused on money. They're more greedy than the person who has a lot. Talk a little bit about that, how that's so different than what we've been taught growing up.
Yeah, I think there is an aspect to trying to control something too much, and it goes back to scarcity and abundance. But if you're trying to grab a bar of soap and you're in the shower and you're squeezing that thing as hard as possible, that bar of soap's going to shoot out. You can't control a bar of soap by squeezing it. What you do is you kind of methodically, hold it loosely and kind of move it back and forth in between a couple of hands, and it doesn't shoot out. Instead of squeezing it so tight that you thinking you can control it when you can't, you recognize you can't control it, and the goal is really to just do the best that you can.
Oh, I like that. So it's kind of like the lifestyle investor recognizes the power and potential of money, but they hold it loosely, as opposed to the person, if you would have flipped the order of the words, the investor's lifestyle. I mean, that's when you could have talked about the penny pinching and the always getting one over on somebody else. And that really is destructive, and it kind of destroys the whole point of living.
It does. And part of living a great life is what you can do for others. So if we're pinching pennies for ourselves, imagine what we're doing for others. So the goal is to live abundantly today and help others too. And I do think that is part of the lifestyle. It's leading a great life, but part of leading a great life is having impact and influence in a positive way on other people that are within your sphere of influence.
Well, let's talk about who the book is for, because I know when you write a book, there's all kinds of things you need to almost check off. Demographics, what are the characteristics of the person? And then psychographics, what are the motivations? So who is this book actually for?
So this is a unique question, and I feel like I can answer it in two different ways, because the book is really for anyone that's looking to get ahead, that's looking for a change, that's looking to create a better lifestyle, even if it's one step at a time and one day at a time. But the actual genesis of the book did not have to do anything with who the book was for demographically, I actually wrote this book. Well, to even give you more backstory, I've had friends for years that have said to me, Justin, would you just write a book or capture this or teach a class or do something like, I want to learn more of what you're doing. And for a while, I just wanted to make sure that it worked. I don't want to teach things that don't work. I've got a couple of decades now. And so I've just had a lot of people over the years say, Justin, teach me, write a book, get all these thoughts down. And I have wanted to, but it's such a tough thing to wrap your mind around, to write a book. And one of my friends said to me, well, what happens if you died and your daughter never got to learn all these things that you could teach her?
Wow.
And that was the dagger. And I said, you know what? Okay, I'm motivated. I'm going to write this thing. And so it really started out as, let me capture all these ideas in my head. Let me just get down my framework. So in a worst case scenario, something happens to me, my daughter can learn all these things and she can apply them in her life. And hopefully that's not the case. Hopefully I live to a very old age and, so does my wife, and my daughter lives to a very old age and far outlives us. But that was really the motivation to get this book done. And as I've been writing it, I've just had so many interactions with people and so many experiences with clients and friends that it's really allowed me to color in so much more to make it applicable to truly anyone.
Well, speaking of your daughter, you talk in this section about how your family felt like last week's leftovers before you really cracked the code on the lifestyle investor. You would come home from work exhausted, irritable, trying to juggle the business demands. Talk about that point in your life.
So that was a really interesting stage in my life because the lip service that I paid said I put my family first, but my schedule and the energy and attention they received clearly said that they were second. And that was something that I realized in time, that I'm showing up with whatever's left at the end of the day. And that's not what's best for them. And so that was kind of my first wake-up call to say, hey, I actually need to steer the ship a little bit more. I can't just show up with horrible energy, or, I'm frustrated from the day because of things that are taking place that have nothing to do with them at all. And so that was the big shift. It was, okay, I actually need to plan my family first, and then I need to plan work second. And it's tougher to do with a more traditional job. There are ways to do it. There are ways to at least get your day started with family and quality time, and to finish it that way, and to get home for family dinner every night. And that was the number one priority to me. And once that was clear, that was kind of like the short-term fix, where I made some adjustments for my family now around a busier work schedule. I just capped how busy that schedule would be. But I knew it was the beginning, because I knew there had to be a longer-term fix, which would allow me to be in the driver's seat of how much I'm working, when I'm working, where I'm working. I mean, I wanted to be in full control, have total autonomy and agency in my ability to run my life, run my business, and give my family the time they desire and deserve.
So it's almost like you had this initial wake-up call where you realized your family was getting last week's leftovers. Then you made the short-term fix where you capped your schedule, but then you really woke up and said, hey, now I need to create a new type of life. You also mentioned how vacations used to be kind of tacked on to company trips. I know that your life is very different now. Give us the end of the story as we begin this picture. Like, what is your life like today? Not that every listener will want your exact life, but I think there's this theme and thread of freedom running throughout.
Yeah, that is. So I worked really hard to be in a place where I could wake up whenever I wanted to wake up. I generally get up early, so I spend time in my thoughts, journaling and in prayer and reading. And to me, that is just a great way to start the day. And when my family wakes up, I like to spend quality time with them before my daughter goes to school. I like to get a workout in, and I like to do it after that. At one point in time, I woke up as early as I could to squeeze the workout in before work and rushed off. And, I don't have to do that anymore, thankfully. I can work when I choose to work, which is nice. I work from home. If I want to go to a coffee shop for a little change of pace, I can do that. And really the difference is I enjoy what I'm doing because I don't have to do it. I'm choosing to do exactly what it is that I want to do, which is nice. And I finish early. Sometimes I'll finish in the afternoon and hang out with my family. Other times I'll finish, a little bit later, and we always do family dinner together. And then when we put my daughter down, I get quality time with my wife. And so that is just really important in my family for how I spend my time. I wanted to create the ideal schedule. And we travel, whenever we want to travel, which is fun. We stay extended summers in Europe or, in all across the U.S. actually is what we did this year. And just really enjoyed quality family time in a few different fun locations.
So to wrap up the lifestyle investor in a nutshell, you talk in the book about the 10 Commandments. We're going to get started in that in a moment. But it's really about having all of your investments pay for the expenses of your life. Talk about that, because let me tell you, they do not teach that in Economics 101. Can it actually be done that you can make enough money so that all of your needs are cared for?
Well, it's really a shame that it's not taught. I mean, what is taught is education that comes from the place that wants your money. Financial institutions, Wall Street, whoever wants your money, they're giving you all the reasons why they should have it and they should control it.
Wow.
And for me, I knew it's not that that's not a place that I want my money. It's just not the place I want it first. I think that my expenses should be covered. I think I should have assets that produce income, and that income should cover what it costs me to live. And it might start out that it covers just the bare minimums or just a portion of what it costs me to live, but over time, it can add up to being the full amount of my current lifestyle, my exact expenses to match my current lifestyle. So to me, I wouldn't want to really do anything risky with my money until I have assets that, and I don't believe, buying assets that produce income are risky. I think they're the least risky, especially as they're diversified across multiple asset classes. So it's definitely possible, and it's actually definitely something that the ultra wealthy do. It's just not communicated and taught very much.
It's so foreign because we know that in scary times throughout our history, many times people can't even make it in life if they miss a paycheck. The amount of people who are living, quote, paycheck to paycheck is astronomical, but you're really talking about an entire new way of life.
Yeah, and when you think about it, doesn't it make more sense? To me, that is the common sense, that why not build an income that covers your expenses so that way you can choose to work when you want to and on whatever things or topics or passions that you have. And then from there, if you want more exposure to risky vehicles, you can invest in companies directly. You can invest in the stock market. You can invest in other places where you don't have as much control. And, the economy can, basically cut the stock market in half based on something that happens that is out of anyone's control. That to me is risk. And it doesn't mean that I don't want exposure to it. I don't want it to be the asset that I have the most exposure to or the first asset that I have exposure to. Why lifestyle investing is the answer. The goal isn't more money. The goal is living life on your terms. Will Rogers. Perhaps you've reached that point in your life where you recognize or can acknowledge that being wealthy is inextricably linked to mindset, behavior, discipline, and point of view, not necessarily what's in your pocket or bank account. By learning my fundamental principles and the 10 commandments of a lifestyle investor, you can move to the next level. Freedom from and to. Most likely you're listening to this book because you want freedom from and freedom to. Freedom from work and trading time for money, and freedom to live life intentionally on your terms. You want to have more choices and the ability to do as you desire, when and how you want to do it without restriction. You want the ability to take off when and as long as you want. You want the ability to send your kids to the best schools, buy the best brands and products, take extended vacations anywhere in the world, and buy your partner and loved ones experiences and gifts without asking how much. If you're an entrepreneur who started a business because you wanted to create the freedom to buy your time back and stop working for someone else, you may have discovered that you have unintentionally become a slave to your own business. You may be chained to a business that's producing only enough for you to cover your expenses or live your current lifestyle. Yes, you are your own boss, but owning your business can put you in and keep you in a different rat race from other means of employment. Is it a better quality rat race? Sure, but it's still a rat race and constantly leeches your time. Even worse, it's covertly stealing your time from you, sometimes without you even recognizing it. Real-life issues and problems come with being an entrepreneur, just as they do with being an employee in someone else's business. Unfortunately, many entrepreneurs never make it to a lifestyle of financial freedom, or won't make it for a long time. Here's the good news. There's a way to buy your time back and cover your expenses. And once your expenses are covered, you show up much better for your business and loved ones. Just going through the motions. If you're an employee in someone else's business, you may be just going through the motions of work and life, tied to a job or career that you don't love but feel chained to it because of the paycheck. Here's the good news for you. There's a different way to live on your terms and in a way that brings you passion, energy, vibrancy, and vitality. You do not have to wake up to an alarm clock when it's still dark outside, only to fight traffic to get to work for someone else who makes all the money at a job you don't really like anyway. Then do it all over again. Every day you go to work for someone else, you're making them and their business or organization much more money than what you're making. To make it even worse, you're expected to be so grateful for this opportunity they've provided. After you pay your taxes and bills, the leftover money is all you have to live your life. I know this because I have experienced it. Most of us have been, or still are, handcuffed to that approach for earning a living, either by a mental framework or habit and routine. Employment and earnings are on their terms, not yours. It's a broken paradigm. The way out is easier than you think. If you have a job that you love, a healthy relationship with your boss, and a strong 401k, congrats to you, at least for now. You're an anomaly inside of a rigged game. You're in the minority. Nonetheless, the game is rigged. A life of endless demands. I used to live in that broken paradigm. I'd set the alarm and get up at a certain time because I had responsibilities. I generally ran a conference call first thing in the morning, often at 6 a.m. or 7 a.m. If my day didn't begin with a conference call, I had to check in with whomever ran the operations to make sure that they were running smoothly. Fortunately, I did not always have to be physically in my office all day, every day. Often, I woke up early and went right to the gym before work because I felt like it was the only time I had to work out. In that life, everything was rush, rush, rush. I had no time to think. I went from thing to thing, meeting to meeting, with little or no time to decompress in between. Though I attempted to schedule my days proactively, I spent most of my time reacting to and solving problems. After all, I thought, that was my job, wasn't it? After work, I'd arrive home exhausted. It was hard to juggle business demands and also be home for dinner. Though I made dinner the priority because being with my family was important, I constantly felt I had work on my mind. I struggled to be fully present in other activities. Instead, I felt the consistent pressure that I could do more, was not accomplishing enough, and was potentially missing out on creating more income. Taking any time off meant double the work the next day. The demands of a large sales territory were endless. Weekday and weekend travel, board meetings, conferences, quarterly meetings, weekly conference calls, team functions, and office visits, among other obligations. The demands never ceased, even during the slow times. Then there was the summer. My wife was off from teaching and my daughter from school, but it was my most challenging season for work. When my family was most available, I was the busiest, often working 10 or more hours a day, 6 days a week. The cycle was never ending. Though not ideal, many positive things did come from this time in my life. I'm thankful for the opportunities, growth, knowledge, skills, and amazing people I met. Many of these people remain some of my closest friends. This stressful period prepared and shaped my thoughts and choices about life. It forced me to align my lifestyle with my values. My life on my terms. Now, instead of waking up and going to the gym before heading straight to work, I take some time for myself to think, journal, and read. My faith is really important to me, so I spend time in prayer and devotions because they are a good foundation for how I want to show up in life. By the time my family wakes up, I'm ready to hang out with them. We have time each morning to play cards, talk, listen and dance to our favorite music, or read a book together. I head to the gym after my daughter goes to school. I have mental self-care, daily quality time with my family, and then physical self-care. These times are the most important parts of my day, and I accomplish them before I do any required daily work. Whole body health is important to me. Therefore, I stay informed on new studies and concepts like intermittent fasting and eating primarily whole foods with each meal. Typically, I get a deep tissue massage each week and chiropractic adjustments as needed. I play volleyball at least one morning a week, and I trail ride one morning a week. The other days, I lift light weights, followed by some form of cardio. When my workday ends, which can happen as early as I choose, my wife and daughter and I have a family dinner. After dinner, I spend as much time with my daughter as I can. After we put her to bed, my wife and I spend time together. The greatest benefit of this routine is the exceptional relationship my wife and I enjoy today. Becoming a student of my wife allows me to focus on her, our marriage, and our family, which fulfills her love language needs. That's how we do it. As for my weekly schedule, I like to start and end my week in an inspiring way. I keep my Mondays open for thought-provoking activity. Fridays are reserved for fun events such as travel, family outings, date days with my wife, and spending time with friends. Tuesdays, Wednesdays, and Thursdays are when I work most on my projects. However, I also schedule lunch or coffee time at least one of those days to meet with someone I can learn from. I like to meet people who pique my curiosity, which is imperative for me. As I mentioned earlier, curiosity keeps me open to learning. My goal is to meet one or two new people each week. If I can do that, I feel like I've had a successful week. Living in Austin, Texas, I find plenty of opportunities to continue growing and learning from creative entrepreneurs, investors, tech pioneers, other gifted professionals, teams, and companies. I look for inspiration, new learning opportunities, and other investors who do what I do so we can learn from each other. More important than anything is how I prioritize my days. I try to be intentional with my family time instead of working first and then trying to juggle everything else. I used to do what I needed for work and then tried to fit in everything else, including family time, working out, and relaxing. That didn't work for me, nor did it create the vibrant life I wanted. Family comes first now. followed by my physical health and self-care. Before, I worked like a machine. All that mentally and physically consuming work came at an expense to my health, my family, and my life and didn't allow me freedom. Not anymore. These days, when I travel, I bring my family with me so we can incorporate some fun family adventures together. It creates a much cleaner, healthier, better dynamic for everyone. Also, my wife and I do quarterly overnights and annual week-long trips to new and favorite locations to make sure we have good quality connection and fun experiences. We schedule our family trips throughout the year, often for extended periods of time. Sometimes we vacation with another family or close friends. My wife and I also think it's important that we each take a trip by ourselves. She has some annual girls' trips, and I have some guys' trips. We enjoy taking these trips so we can maintain strong relationships with our closest friends and family. As an entrepreneur, I schedule at least 2 uninterrupted hours each week for technology-free thinking to proactively create the life I desire for my business, family, and personal life. The bottom line is I take my spiritual, mental, and physical health seriously. When I do, I show up better for my family, friends, business partners, and work associates. These practices provide the energy to show up well in every situation. As for work itself, I love what I do because I get to choose what to work on, including who I work with and when those projects happen. I get a sense of fulfillment and satisfaction from learning and teaching others. My lifestyle allows me to live life on my terms. Of course, it comes with a component of doing some work, but it's work I choose to do and enjoy. Life on your terms. Some people don't realize they're a hostage, but it's only a matter of time. A new job feels good until it's not new anymore, and then the reality of being in chains sets in. It's good to be grateful for a job, but it's also good to be smart about choosing the better and best opportunities for a life on your own terms. Here's another way to look at it. You don't have to have a job that provides income to live your lifestyle, and you don't have to have a lifestyle that meets or exceeds the income you're earning. These mindsets create a real mental handicap and can keep you a slave to the business or the amount of money that you make. The more you learn about choosing how you want to work, how you want to spend your time, and how you want to earn, and what it costs to live how you want to live, the more clarity you'll have about your decisions. Don't be held hostage by your day job or your business. My mission is to help you buy back your time so you can proceed with intentionality on how, where, and with whom you spend that time. I want you to live life on your terms as well. I believe anyone can make this shift. It begins with a commitment to gaining your life and time back. In the beginning, it's more of a mental shift than anything else. But once you flip the switch mentally, your behavior changes. You start taking actions to pave a clear path for the life you want to create. I'm looking for people who are open and willing to consider living life differently, who think that the status quo doesn't have to apply to them, and who are open to making choices to life on their terms. I want you to experience the autonomy and the liberating feeling of living your dream life and finding the passion to create your ideal lifestyle now, not when you're retired. Retirement, Social Security, investments, nest eggs, and your health, none are guaranteed. You could spend significant time neglecting your family to gain financial freedom, but when you finally do, your family might no longer be at your side due to death, divorce, or other unforeseen circumstances. You could chase something you consider important at the time that becomes the reason your family is no longer there with you. Why wait when you could have that dream lifestyle now and enjoy the most fulfilling years of your life today and throughout your retirement? The information in this book will help you make a transition like what I described in my life if you apply it. Chances are it won't happen overnight. It may take a year, 5 years, or even 10 years, but at some point, you'll be able to step off the proverbial treadmill and create your success, and do so on your terms. Why not become a professional financial athlete now while you have years to enjoy a new lifestyle of success? Yes, you'll face hurdles to overcome, so good training is essential to win financial freedom. In my case, it wasn't until my investment income replaced my earned income that I could see how to buy my time back to focus on what I enjoy most in life. The abundance of time I bought back then allowed me to redirect my energy and focus into creating more income, all the while enjoying my personal life. Today, I don't have to work. I get to work. I wake up without wondering how I'm going to make money. The activity I choose to focus on doesn't have to produce income because my passive income exceeds my lifestyle. Take charge of your future. A gentleman who listened to an interview I did recently and wanted me to coach him, he said, "I've had a tremendous amount of success in many areas of my life, and by most people's standards, I have achieved great wealth and status in the business world. But I don't have your lifestyle." By now, you might be able to guess what I told him. Though the possibility of upgrading your lifestyle may feel out of reach, it is doable. You control your future based on the decisions you make and the actions you take. In this book, you can expect to hear a different way to invest and live. It's not as hard as you think it might be, and it doesn't take as much money as you might think. It's not about accumulating millions of dollars in a nest egg approach. Instead, it's about investing into assets one at a time that produce the amount of passive income you need to cover your lifestyle, whether you invest in these assets directly yourself or you invest through a partnership as a limited partner with an experienced team that professionally manages and operates these assets. If you break down how much it costs to live right now with your current lifestyle every month, the amount needed to cover those expenses is probably much less than what you think it costs. It's inspiring and eye-opening to understand what it really takes to cover your lifestyle expenses and get out of the rat race for good. Take charge. Debunking the most common myths about investing. Risk comes from not knowing what you're doing. Warren Buffett. What I used to believe about money and what I know now are two different things. Before we go any further, pay attention to this. Don't follow the crowd. The majority of people are in debt, not building wealth. My goal in this book is to show you how to become a lifestyle investor no matter your current financial status. If you're the kind of person who is comfortable investing in something and waiting 10 or more years for a return on your investment, I'm probably not your guy. I focus on getting results fast and making money as rapidly as possible. I found super creative ways to discover out-of-the-box deals, negotiate unusually favorable terms, and generate cash flow in months instead of years while creating long-term equity, always focused on reducing risk at every juncture. This strategy stack is how I multiply my net worth and the net worth of the people I coach. What I do and coach others to do is radically different from the traditional financial advice you may have heard. It's time to address 6 of the common misconceptions people have about investing. Myth number 1, you will become wealthy by building your 401k, following traditional investment advice, or investing in the stock market. These approaches for wealth building and retirement are flawed and outdated. Almost everything you've been taught over the years is now garbage. Throw it out. Qualified plans don't work. Social Security is going to run out. Medicare isn't sustainable. What if something happened and the economy was down right when you wanted to retire? What if half of your retirement income was wiped out? You wouldn't have enough time to build it back, and you would have lost way too much of your nest egg to ever recover during your retirement years. Now think about this. Why is the government giving you tax breaks now? It's because they're going to make their income on your savings later on when you retire, and they take a big chunk of your money. Most people look at the nest egg that they're accumulating without realizing that probably close to half of it will end up going to the government. The tax structure works for them, not you. For anything the government says, hey, we'll let this compound in a tax-free growth vehicle and you can pay tax up front on it, they limit the amount you can contribute. For example, $7,000 in a Roth IRA or $69,000 in a solo 401k in 2024. You're limited because the government wants a piece of the growth, and they will get a piece of it. Oh, and the government can change the rules at any time. If they want the money early, they'll take the money early. If they want to push the retirement age back, they can. They are in control. To become a lifestyle investor, you must change your mindset. You must think about investing differently. You can live life on your terms, but getting there will take a different approach. Calculate actual rate of return. Earlier in my investment career, I got quarterly and annual statements from my financial advisor and the investment and financial institutions I was investing through that reported a strong average rate of return anywhere from 7 to 10%. For years, I never questioned these numbers and just felt good about how much I thought I was making. Then one day, because I wondered why I didn't have more money if the average rate of return was so high, I dove into the numbers. Luckily, I'd kept a record of how much money I originally contributed into each investment, and I had statements showing my starting and ending balances. With that data, I realized that I could track how much I actually made rather than the average rate of return that was listed on my statement. I needed to calculate my actual rate of return, not my average rate of return. My actual return wasn't printed anywhere, so I had to do my own math. To my surprise, my actual return was much less than what these institutions were trying to lead me to believe. In fact, at the time I checked my investments for the first time, doing my own math, I found out that I had actually lost money due to a bad stretch in the stock market, though my statement still said I had a positive average rate of return. What these financial institutions were giving me in their reports was deceiving. They were using a smokescreen and distracting me from what I was actually making by telling me it wasn't as bad as it was. I was losing money, yet somehow I had a positive average rate of return, which made it seem like I was making money. The average rate of return is the only calculation many financial planners discuss, because if you think you are making money through them, you'll keep your money with them and, they hope, add to it. That's a recipe that doesn't work for me. Commandment 7, plus the deal, and Commandment 8, cut out the fat, elaborate on the flaws of this strategy so you can truly understand what is happening and how to avoid having a similar situation happen to you, if it hasn't already. I know you know this, but I want to point it out here. Financial planners still make money on your money even when you lose money. According to S&P Indices versus Active 2019 year-end report, in the last 15 years, the fund managers you pay to manage your investments do a worse job 95% of the time than if you invest in an index fund yourself. In other words, you are paying fees to have someone manage your money when it's likely they won't make you more than if you invested it wisely yourself in the S&P 500 index. The reason? No one can predict the future. So you can pay financial professionals to manage your investments, and statistics show that only 5% of the time they actually beat market indexes. And that rate is considered normal. Make indexes your new normal, where you pay the least amount of fees to invest in the stock market. 401k flaws. Pension programs no longer work, so many companies have quit doing them. They are opting for 401k plans instead. Soon people will realize that 401k plans don't work either. When it's time to cash in on their retirement income, the government will get a third or more, up to 40%, or maybe even higher, depending on the tax rate and how much income they've earned from that accumulated nest egg. If you have a 401k, you must consider that they traditionally have the highest fees of any other investment. You typically pay 3 to 4%, which doesn't sound like much until you realize that each percentage over time, depending on how much you make, can be millions of dollars. And mutual fund fees aren't much better and can often also charge over 3% in fees. That's real net worth that people are losing. In addition to losing a large part of your nest egg in taxes when you draw it out, keep in mind that once you retire, you lose your three most significant tax deductions: dependents, mortgage interest, and business expenses. These deductions are likely a significant part of helping you earn the after-tax income you currently have become accustomed to. And maintaining that same lifestyle once those deductions are taken away is harder to accomplish. Also, chances are the taxable income rate then will be higher than it is today due to the massive amount of debt the U.S. has accumulated. Social Security is not security. On top of all these factors is Social Security, which may or may not be around in the future. You're paying into a system that may not exist. Less people are paying into the Social Security system today than the number of people who collect on it currently, and the number drawing Social Security will continue to grow. The current financials released from the Social Security Administration say that Social Security is going to run out in 2035. This is not an opinion. People working in this government agency and managing these financials and the national budgets are the ones who are saying it's going to run out and is unsustainable. What's worse, the financials released in 2020 by the Social Security Administration that projected the timeline when Social Security will run out were released prior to the stay-at-home orders due to COVID-19. The newest estimates at the time of this writing have projected it to run out as early as 2032. The reality is that Social Security in itself is a Ponzi scheme. A Ponzi scheme takes new money to pay out a promised return to someone else. That scheme cannot possibly work as is, and it's going to fail. It's just a matter of time. The framework of our financial system, from education to financial literacy, is outdated and broken. Unfortunately, it's based on a follow-the-herd mentality that says people just do whatever everyone else is doing. However, if what everyone else did worked so well, the distribution of wealth wouldn't be so lopsided. Trust me when I say that the wealthiest 1% is not investing in 401ks, in the stock market, and in qualified plans. There are a handful of anomalies able to do that, but the people living the lifestyle they desire are not clipping away at their 401ks to do so. Nest egg stock investment flaws. The whole idea of nest egg investing in stocks is a flawed concept. For most people, that's primarily or exclusively where their money is. Anytime the stock market takes a hit, they lose a big stack of money. It creates a huge risk profile. Many people think they are mitigating risk by following professionals' advice, but what they're really doing by having all their money in the stock market is putting all their eggs into one basket, the U.S. economy and U.S. companies, or their respective countries. When inflation is happening, the dollar isn't going as far. Through quantitative easing and continued stimulus packages, our government is increasing the amount of fiat currency being pumped into our financial system. Fiat currency is money that is not backed by a physical commodity like gold, but has still been declared as legal tender by a government, such as the U.S. dollar. All this money printing dilutes the value of the dollar and also penalizes people who save money, making their money much less valuable. Most people aren't getting pay increases at the rate of inflation, so not only is their purchasing power shrinking, but also their overall net worth. During times of inflation and even in normal times, one of the best places to invest is in cash flow producing assets. The value of the dollar decreases with extra money being printed, but the value of assets, and especially cash flowing assets, increase because they appreciate in tandem with the supply of money being added into our financial system. As you add value and increase profitability in cash flow producing assets, they appreciate twofold. So not only do you get the cash flow they produce that keeps up with inflation, but you get asset appreciation and a hedge against the devaluation of the dollar in a physical asset. In other words, when the monetary supply expands, your assets expand. There's no guarantee that the U.S. is going to remain the superpower that it currently is, or that the massive stimulus packages aren't going to have long-lasting negative effects at some point. There's no guarantee that the economy is going to be stronger when you retire. There's no given that if you take a hit, you'll have enough time to recover. Look at all the drags slowing down the growth and compounding of your investments. You've got inflation, volatility, taxes, and fees for anything and everything out there. The amount of fees being paid to financial advisors is a total drag on your wealth accumulation and exponential growth. If you're not focused on enhancing your financial literacy and you're leaving the decision making up to others, in most cases, they're going to do what's best for them, not what's best for you. Here's a summary of what I've said to debunk myth number 1. Conventional financial education says to save money in tax-advantaged vehicles and invest in the stock market and hope it works out. It's all about the rate of return, and it's all product-based. This product or that product is what's going to get you there. Your plan needs to be more holistic. There are many different ways to skin a cat. Run from anyone who tries to sell you a single product-driven strategy. Run, too, from any plan that is average rate of return driven, because the average rate of return doesn't matter. The average rate of return is a slippery, manipulative, and slimy phrase to make people feel good about not making money, and a smokescreen so people won't realize they're not making as much as they think they are. What matters is actual rate of return, because that's real money. Myth number 2. You can't spend money freely today and grow your wealth at the same time. Money and wealth typically don't result from a nest egg accumulation approach, in which you build a nest egg of millions of dollars, draw from it when you retire, and live a happy life. This strategy relies on endless hope. Hopefully, you'll be able to accumulate this large amount of wealth. And hopefully, by the time you do, the stock market will be in good shape. And hopefully, you'll be able to retire in a good season for the economy. If all these hopes are fulfilled, hopefully, you'll be in a good place and physically well enough to enjoy retirement. Notice how many what-ifs and conditional statements are the basis for the way the average person invests. The reality is, if you distribute from your nest egg and doing so takes down your principal, then at a certain point, your nest egg is going to deplete to zero. Yes, the goal is to build up that nest egg, never touch the principal, and live off the interest. That goal, however, hinges on the belief that you have investments that will continually generate enough interest to live on, something that, in fact, can change at any given moment. Your returns could change, the market could change, and the cost of living will certainly change. Calculate your monthly cost of living. What makes more sense is to consider how much it costs you to live from a monthly cash flow standpoint rather than an annual income standpoint. Look at what it costs you to live on an annual basis and then break that number down to what it costs you to live on a monthly basis. That total is the amount of income that you need to earn to cover your monthly expenses. This is an actual strategy that relies on numbers you can figure out and doesn't revolve around hope or unknown income in the future. Here are some important questions to ask yourself. How much does it cost me to survive at a bare minimum and cover all my basic monthly expenses, such as rent, mortgage, food, utilities, transportation, etc. How much does it cost me to live my current monthly lifestyle? How much does it cost me to live the monthly lifestyle I aspire to live? How can I create an income to cover those lifestyle costs without using my time? Most importantly, how can I cover my bare minimum basic monthly expenses to survive on passive income alone? Answering these questions can provide some clarity on the next steps you can take to create the lifestyle you want today that doesn't rely on income from your job or your business. Once your expenses are covered, one of two things can happen. You can enhance your lifestyle. If you choose to do that, you'll want to increase your income. Ideally, you can do so through passive investments and owning assets and not through earned income. The other thing that can happen once your expenses are covered is you can take your extra cash flow that exceeds your expenses and reinvest it into additional investments that continue to produce income. Concentration risk. As you start to create your passive income, take the necessary steps to diversify your cash flow across many different asset classes, sectors, and industries. Should something happen that negatively impacts one of those areas, you won't suffer as much loss because you will not have all your cash flow concentrated in that one area. This strategy mitigates concentration risk, which is the risk that exists when too many investments have the same exposure to economic forces. During my journey to financial freedom, I worked hard to keep my family's expenses the same for a long period of time so that as our income increased, our lifestyle didn't consume that extra income. As a rule, I'd take whatever income was above and beyond our cost of living and invest it in a variety of new ventures and investments that generated even more cash flow. Starting out, I was conservative with the investments I made. I focused entirely on investments that produce cash flow. Once all of our expenses were covered, I became more liberal with my investments. This strategy has allowed us to live a great lifestyle, and it also has given us the ability to be generous with our income as well. Once our expenses were covered, I felt comfortable venturing out of the box a bit to see if there was anything I could improve upon or hadn't yet considered from an investment standpoint. I started meeting with and learning from other experts and professionals who shared additional strategies and investment opportunities that could help me reduce risk and increase returns, as well as help me diversify asset classes. My risk tolerance has shifted. Financial freedom has given me more options of where to invest. For example, I had saved stock market investing and equity investing, especially angel investing, which I'll discuss later, until I was sure my cash flow was more than enough to cover my lifestyle expenses. Those investments are riskier than highly vetted real estate rentals directly or through a fund, or senior secured credit funds that produce predictable cash flow. I now like to use the extra cash flow that I earned above and beyond my lifestyle expenses to invest in equity investments, stock market indexes, other stocks I like, and other options I consider to be riskier than strong cash flow producing assets. Those options include investing in operating companies and creating unique terms, structures, and one-off deals, something I do frequently today. Once you have your basic lifestyle expenses covered with passive income, you can spend more time figuring out the different investment vehicles you may want to add to your portfolio. Great questions to ask yourself are, what gives me the best return with the least amount of risk? What emerging market should I consider that didn't exist that long ago? How can I diversify my investment even across other cash flowing opportunities? As you can see, my philosophy on investing is different than most people. Here it is in a nutshell. Focus on passive income first to cover all expenses, and then diversify that passive income to have multiple income streams so you aren't reliant upon just one asset for income. After that, stock market index investing is the cheapest way to invest in the stock market, having the lowest fees. Invest for the long term into the stock market because emotional investing causes loss over time. and avoid buying and selling at inopportune times and during times of crisis, which could wreak havoc on your portfolio. Investing in operating companies and structuring unique investments to gain cash flow, as well as participate in the upside, is another strong investment opportunity that can become part of your passive income strategy, both before or after your expenses have been covered. Reserve straight equity investments until all your expenses are covered, since these tend to be the riskiest investments of all. Seed round investments, which are the first round of funding for a startup, are the riskiest of all. I only allocate a small portion of my portfolio investments to them. They can be very lucrative, but the odds are not in your favor. Typically, if there's a big payout, it won't be for decades. Whenever you do invest in anything that is a riskier investment, like seed round investing, make sure it comes from the cash flow produced by passive investments and it's income that exceeds your lifestyle expenses. If the investment doesn't work out, then you only lose the cash flow from that asset as a one-time distribution, not the actual principal you could be earning cash flow from. This hierarchy of investing has proven to be a critical component in the success of my investment strategy, and I will explain each type of investment in more detail. Myth number 3. The best investments are tried and true choices that you've already heard about. 15 years ago, there was no such thing as single-family home rentals as an asset class. Around 12 years ago, they became an official asset class and one of the fastest-growing asset classes in the U.S. The cannabis, CBD, and hemp industry is taking off right now. It is one of the fastest-growing industries in the U.S. The music industry has royalty investment opportunities that are now more prevalent than ever before and with easier access for investors. They've always been there, but now there are new ways to monetize effectively and track those royalties, especially with the boom that is happening and the lower barrier to entry on both the artist and investor side. There are more opportunities to invest in original production content. Think shows, movies, music, and so on, which is a very brand new booming category that a decade ago was basically limited only to HBO and a few other producers. Now there are many competing companies offering fantastic investment opportunities, and the barriers to entry are much lower. Many other emerging markets exist from international opportunities. Most people only look into the country where they live. But there are opportunities outside our borders in countries that most people don't even consider. If you educate yourself or find people who are educated about them, opportunities are everywhere. Technology is another market with investment opportunities. They can be hit or miss, but there are always new, innovative, and disruptive developments worth paying attention to. Financial technology, or fintech, is blowing up. Software as a service, or SaaS, is taking off. Crowdsourcing and crowdfunding are becoming more popular and mainstream. E-commerce in general is revolutionizing the way people shop and conduct business. Even the trend of marketplaces is becoming the norm for where people shop. Healthcare and senior living are other sectors with booming opportunities. Hotel conversions to condos and apartments are in high demand. Industrial distribution centers and warehouses are growing tremendously with the boom of e-commerce. The list goes on, and that's my point. All these new, booming, and emerging markets have opportunities where most people aren't making the time or don't have the confidence to look. Myth number 4, you can't upgrade your lifestyle without sacrificing profit. Lifestyle inflation is a threat to long-term financial freedom. Let me say that again in another way. Nothing is a given. Being a lifestyle investor means that while your income increases, your lifestyle doesn't increase linearly. Those I've trained, coached, and developed understand this rule. Your lifestyle doesn't change dramatically until you have enough repeatable investments to sustain your desired lifestyle change. Remember, you become a lifestyle investor more than you live an investor's lifestyle. When I get extra income, I am free to choose whether or not to improve my lifestyle because I've already bought another asset that produces the income to cover that expense. For example, if I want to get a new car, I'm methodical in my approach. Instead of spending my money to purchase that car, I know that it's smarter to buy another asset that produces the income to cover the car payments and expenses of owning it before I make the car purchase. If I just spend the money on a car, I lose the total amount of principal to something that does not generate cash flow. A car generally isn't an asset, it's an expense. It just makes sense to put the principal to work to earn the extra cash flow that will cover the car's expenses and liabilities. This approach also gives me the opportunity to earn even more cash flow on the principal I invested when the car is paid off. When I mention this strategy to clients, they're blown away. You can do that? I've never even thought about that. How would I do that? To me, it's a smarter way to make that purchase. Home improvements are also a good example of where you can cover your expenses in advance by buying assets that produce income. The extra income allows you to pay for new furniture, home remodeling, or even a bigger or more expensive home. My family's current home is in a hotter market than our previous home. The home cost twice as much as the last home, but I bought an asset that produced the income to cover more than twice the cost of the mortgage before I purchased the home. We didn't upgrade our home until we upgraded our real estate portfolio, which covered the income needed to upgrade our home and cover that new mortgage. The new home was then a safe, smart investment. Anytime my family wants to increase our lifestyle, buy something new, upgrade our home, do a remodeling project, or whatever, I want an income-generating asset producing the cash flow that will cover the new expenses. The same strategy applies to travel. We've taken many trips around the world, visiting numerous countries along the way, and we're able to cover those expenses with cash flow from investments. During our last trip to Europe, we spent 6 weeks visiting several countries in the Mediterranean and traveled along the different coastlines. Everything was 100% covered by cash flow from another asset we purchased. Another tip, when you have the right tax strategist on your team, vacations can be treated as board meetings as long as you take minutes to prove what you've done. Another way to utilize this strategy is to create new cash flow whenever there are business upgrades or growth opportunities. I've done this in several businesses. Here's how you can do it. Let's say that you need to invest in your business in order to create more scale and overall growth by adding more employees, increasing marketing, buying more specialized equipment, or building a bigger office space. If the business profits support these added expenses, you can have the business purchase a cash flow producing asset to cover the new expenses. If the business profit doesn't fully support the increased expenses, you may need to take out a loan. Here's the twist. What if that loan was to yourself? You can invest personally in cash flow producing assets that cover the additional expense to scale the company and have the loan paid back with interest. This is a win-win scenario for both you and your business. Plus, you accomplish it while buying more cash flow generating assets. Myth number 5. Most investing experts give good advice. Did you know that the vast majority of people in the financial services industry don't operate under a fiduciary responsibility? Fiduciary responsibility means that whoever is investing your money has an obligation to do what's best for you, because many financial planners don't have to do what's best for their clients, only something that's good or that they think is good. They typically do whatever is best for themselves. Also, the advice you get from these advisors is often biased because they have incentive to act in a certain way that may not be in your best interest. They'll then invest in products to inherit extra bonuses, commissions, or kickbacks. Unfortunately, this behavior is extremely common in the financial services industry. Countless news articles and publications have uncovered this behavior over the years. I want to say it again. Financial freedom does not come in the form of IRAs and qualified plans. Financial freedom generally doesn't come in the form of any books touting these methods. Many professionals who have become rich in the financial services industry didn't make their clients much money, but they had a large number of clients who made money for them. Most experts in financial services or investing don't make their money based on principles they preach. They make it selling an idea they didn't follow. Dave Ramsey and Susie Orman are two examples. They make money from their platforms, selling financial products and services from their TV and radio programs. By the way, these experts do a masterful job of helping people get out of debt. Unfortunately, they don't teach people how to create wealth. And they're also not skilled at creating a wealth mindset because their mindset is scarcity. Don't buy that latte. That latte worth $5 could be worth this in about 50 years if you save that money instead. It's total scarcity mindset. If you want to be a lifestyle investor, don't focus on following the norm because you aren't after normal. The average person doesn't know what they're doing with their finances. Whenever you see what most people are doing, run in the opposite direction because most people don't have it figured out. Why copy a bad example? Do copy the people who do have it figured out and have the lifestyle you want. Copy the people that have accomplishments you respect and practice what they preach when they're teaching what they've done personally versus how the market trends. Get a financial coach who is transparent with their earnings and who has recently done what you want to accomplish. Myth number 6. You need a lot of money to start cash flow investing. In this book, I share a variety of investments. The most important thing for you to know is that all of the strategies can work for you no matter what you have to invest. How you decide to get started may depend on your knowledge, risk tolerance, and investable capital. The good news for you is I have a number of strategies to use as a starting point. Also, whether you're an accredited investor or not makes a difference in certain investments. An accredited investor is an individual or business entity that is allowed to invest in certain investment opportunities based on satisfying at least one requirement regarding their income, net worth, or professional experience. For an individual to be accredited, they either need to have a net worth of at least $1 million or have an income of at least $200,000 per year for the last 2 years, or $300,000 combined annual income if married. The Securities and Exchange Commission, or SEC, has these requirements in place to identify sophisticated investors that have a reduced need for the protection of regulatory disclosures. Basically, the SEC tries to protect uneducated investors against fraudulent and manipulative investment practices. What most people don't realize is that there are a tremendous amount of investments that exist that don't require becoming an accredited investor. Investment requirements vary based on the type of investments and the sector. For example, a lot of real estate investments don't require being an accredited investor. An important decision you need to make is whether you prefer to make a direct investment versus investing in a fund that has a collection of investments. If an investment is a strong opportunity, then it makes sense to go in the deal directly. Sometimes, however, it's nice to remove some of the risk by adding multiple investments. That way, if one of the investments goes bad, it can still be offset by the other investments that go well. I will cover these strategies in much more detail in the chapters ahead. Another decision is what platform you are using. Several platforms, including CrowdStreet, PeerStreet, and Fundrise, among others, are crowdfunding based. Non-accredited investors, as well as accredited investors, can participate. These platforms create plentiful opportunities and are a nice option for people looking for smaller investments, starting with as little as $1,000. They have good deals to find if you do the research and dig through them. Not all investment offerings on these platforms are great, but if you learn how to evaluate investment opportunities, there are plenty of good deals. I've invested in deals through some of these platforms, so I am a believer in them for the right deal. Besides crowd-funded platforms, there's also a standard syndication, which is a partnership between several investors to combine skills, resources, and capital to purchase and manage a property they otherwise couldn't afford. If you're looking into that sort of investment where there's an operations team, look at how much experience they have. Find out and take into consideration how much they charge in fees. Some people don't know that there can be hidden fees in private placement memorandum documents, or PPMs. So you do need to read the fine details. I will cover syndications in more detail later in the book. If you have $50,000 or less to invest, one option, besides investing in index funds, is to invest in real estate. I like real estate in general because intrinsic value is built already into real estate, so it won't go to zero like stocks can. Real estate has value, so it can be used as collateral to get a bank loan for purchase. This asset class can be easier to finance than other investments, such as businesses that don't have collateral to pledge. Investing in real estate rentals is attractive to a lot of people because it often produces cash flow right away. It includes investing in single-family homes, mobile home parks, apartment complexes, industrial distribution centers and warehouses, and self-storage units, as well as other real estate options. When you find the right deal, it will cash flow on day one. It is a little riskier if you are a new investor, and some real estate won't cash flow immediately, so make sure whatever you invest in does have cash flow. Senior credit funds are another interesting option. You can have a first lien position on real estate or other collateral, so it is much less risky than other investments. These funds also produce consistent and predictable cash flow, typically on a monthly basis. There are plenty of other good first investments if you have $50,000 or less, but I've highlighted a handful that I know can work. If you have more than $50,000 to invest. I remember when I made my first big investment of just over $50,000. It kept me up at night. I thought, oh my goodness, what if this fails? This is a lot of money. I could lose it all. But what I wanted to do was stop the limiting beliefs in my mind. So I thought, you know what? If there's any way I'm going to learn, it's going to be when I have my money in the deal. After doing that deal, I was much more confident in the next deal and didn't lose sleep over it. I understood the process better and had an education of what happened. The experience really mattered. Another option to consider is diversification. You could take a larger investment like $250,000, and instead of investing it all into one deal, you could break it into several $50,000 investments and go into a handful of different deals. Diversifying your investments like this is a good idea if you don't have expertise in a particular asset class, so you don't have all your eggs in one basket. My advice to you, if you feel the way I did when I first started investing, is to remember that most people also feel the same way when they start investing. You have an opportunity to educate yourself. Your task is to do your due diligence on the front end to determine if you are investing in a good deal. If you are unsure if it is a good deal, run it by people with expertise in that area. Have some good advisors around you. Once you start investing and learning as you go along, investing becomes easier. You're less emotionally involved and tied to the outcome. Keep these myths in mind as you go. Myth 7. The upcoming generational wealth transfer won't impact me. The largest wealth transfer in history is upon us. Over the next 10 to 15 years, baby boomers are projected to pass down over $100 trillion in assets to younger generations. To put this sum into perspective, it's larger than the entire current economy of China. This unprecedented shift will reshape philanthropy, investing, entrepreneurship, and more. But most importantly, it represents a once-in-a-lifetime opportunity for financial freedom. With preparation and foresight, this wealth transfer can be a catalyst to achieve your lifestyle goals. Don't assume that this will only impact the ultra-wealthy. Here are realistic ways to capitalize on this historic opportunity. Invest in sectors like senior care, medical technology, and transportation that will boom because of this demographic tidal wave. Explore commercial real estate and other investment opportunities related to aging life care management. Demand for these services will surge exponentially. Research causes you care about and get involved. Major donations are expected to these areas. If you have aging parents, help them put legal protections in place to safely transfer wealth. Learn about their investments. Build relationships with affluent yet aging business owners looking for business partners and liquidation partners to eventually pass the torch. The odds are high that you'll intersect with the transfer in some way. Take steps to educate yourself on the impact and potential opportunities. The decisions you make today will determine whether you're a benefactor or a bystander.
Justin, I love how part one you've named the conflict, and we're actually getting into the very end of this section, but it's huge. There's myths all around investing, and one of the myths is you need to have a ton of money. Another one is it's super risky. But before we get into part two, the commandments, let's talk about myth number one. You will get rich investing in the stock market or from your 401k by following traditional investment advice. Those sound like fighting words to most brokers that are going to hear this, but what is the myth and why is that true?
Well, the reality is this is the main education that people have had, the way that it is that you just invest in a 401k, you just put it in the stock market, and you just hope that it works out. And there's a lot of hope in that you hope that economical times are good and that there isn't a stock market crash and that you aren't retiring at a time where your total net worth is cut in half. There's hope that it grows at the rate that you want it to grow at. You know, there's a risk in the stock market. You know, if you're investing in specific stocks, companies can go to zero. The reason I like a lot of assets like real estate is because they can't go to zero. There's always intrinsic value that exists. It's never going to be a $0 asset. And so I think that's important. But there's just this misinformation, this manipulation that comes from Wall Street and from the financial planning world. And I do want to say, I don't want to paint a picture that all financial planners are bad, because that is not true. There are great financial planners out there, but there are a lot that are not good at what they do. And in fact, a lot of them don't even do what they say to do, what they recommend to do. So they may be saying to their clients, you should do this or you should do that. But the reality is they're not doing the same thing. They're not following their own advice. They're selling something because it's a higher commission and they're incentivized that way. And their company is incentivizing it because they want that money to be directed into that product in that particular way. But at the end of the day, a 401k vehicle is taking over for a failed pension plan. So the pension plan is what originally existed, and during that, people didn't really think as much about lifestyle investing because they had a pension to fall back on. And they didn't have to have all that money saved themselves. The 401k came around to solve the pension plan, but the pension plan didn't work. And the 401k plan is not going to work. And in fact, most people don't know this. It is the highest feed product that exists. So most people don't know they're spending 3 to 4% in fees, closer to 4% most likely, on their 401k. That doesn't sound like a lot. It is a massive amount.
Could be like millions of dollars.
Millions of dollars. Every 1% could be millions of dollars.
Wow. Also, you mentioned, and this is mind blowing. I'm so glad you're sharing this because it is a conflict. But the government caps certain things like the Roth or the solo 401k, they cap it. Why do they cap it?
So this is very unknown. First of all, most people don't even realize that 1/3 to 1/2 of their 401k is going to go to the government. That is taxes. And people look at their 401k and think that all that money is theirs. It is not. The government is going to take their portion, and they're happy to have it grow and take it, come retirement time. So a Roth IRA is different and interesting because you're paying tax on it before it goes in, and then it grows tax-free. But because the government doesn't get a piece of that growth, they cap you at $6,000 as of today. And that's all you can put in. And there are some other Roth products, but those are also capped as well. So the government really wants their piece. But the other thing is we don't have control over government qualified products. So this has already happened. It's going to happen more. They can change the rules of when you can take your money out, how much money you can take out. We don't know what tax rates are going to be at that time, how much you can put in. I mean, all the rules can change. They already have changed, even just in the last few years, and they're going to change more in the future. And imagine what happens as the U.S. continues to use more stimulus dollars and devalue our currency. It's going to force the government to look for funds somewhere, and I predict it's probably going to come from the qualified plans that they have the most control over.
Wow. This is amazing. And so what really is unpacking the lifestyle investor, the point is that the lifestyle investor is in control. They are the ones who are determining their own destiny. They are the ones who are making up their minds, as opposed to everyone else who's basically throwing the dice and saying, I hope the government doesn't change rules. Is that what you're saying?
Yeah, I am all about being able to influence my destiny and not relying on someone else or something else. I think that there are a lot of great things about our government, and so I'm not a naysayer to the government, but I do think that when the government gains too much control of things that people should have control over, whether they recognize it or not, that's a recipe for destruction and for retirement, for the way that money grows over time, for net worth. These are all things that I believe people should be directing that ship and not relying on the government. I hope for people's sake that the government can continue with Social Security and all the things for people that are really, truly relying on it, but the reality is even Social Security is probably going to fail, or at some point there's going to be more funding that needs to take place, that money's going to have to come from somewhere, and the current numbers show it ending in about 13 years, 14 years from now. So we just have an obligation, I believe, to make sure we're looking out for ourselves and not just hoping that the government does it or the stock market does it or our financial advisor does it. I hope that works out, but that is a lot of hope.
Wow. You also talk about how we would have more success just putting our money in an index fund rather than investing it with a certain broker. Talk about that, because I know that the lifestyle investor is really about using multiple vehicles. But you're saying that some of that conventional wisdom that we've heard, basically 96% of people are going to struggle or get worse results. That was eye-opening to me. Can you share about that?
Yeah, so this is a really crazy stat, and there are a couple of stats that I'll share. One of them is that 96% of the time, financial advisors cannot outperform just the market indexes, and that's just a collection of companies that anyone can invest in on, say, TD Ameritrade or whatever platform that they want to use. And so as an investor, I can go in and I can invest in that, and it is the lowest feed opportunity for me to invest in something on my own, not through someone else, not incurring additional fees. It is the cheapest way for me to have exposure to the stock market. And that exposure is actually probably the safest type of exposure. So, that's the first part is only 4% of financial planners actually outperformed that. Wow. So most people are paying 2 to 3% to have a financial planner, advisor, manage their money and do worse than the stock market and then pay them more than what you could do if you just did it on your own, significantly more. You're maybe paying, 0.5% to do the index where you're going to pay, 2% more than that, possibly more, maybe a little bit less to have someone who may or may not perform well. And it's not even aligned. Whether you make money or you don't, that advisor makes money. They make their percentage.
Wow.
You can lose money and they still make just as much.
And that's where in a recent chat we had, you said it's almost rigged. You said that the government wins if you win and the government wins if you lose.
That's right. Yeah, it is very interesting. It's the same thing in financial services, the way that it's set up most of the time. And then here's the other head scratcher, is that only 97% of the financial industry are not fiduciaries. A fiduciary is someone who has to look out for your best interest as an investor. So that means 3% of the people that work in financial services are actually a fiduciary and have to make decisions that are best for you. Otherwise, they can actually make decisions that are best for them that could also look like they're good for you.
That almost sounds illegal.
Totally.
Wow. So fiduciaries are about 3% of the entire landscape of investment choices. Why do you think it's not required? I mean, why do we live in a world where you don't have to have the client's best interest in mind? I mean, that's ridiculous. You look at healthcare or mental health care, we would never say that. We would never say that, a doctor doesn't have to act in the patient's best interest. Why do you think it slides in the financial area?
Well, I think that the companies that want our money the most tell the story that they want to tell to get it. So there are probably several reasons for it, but if it benefits the company that, the financial institution that's getting that investment and gets to reinvest those dollars, then that to them is a win. And so that's why there's manipulation, even with reports showing your average rate of return, for example.
Yeah, talk about that. How do those numbers get skewed, the average versus the real?
Yeah, so if you add up all the averages of how the stock market performs or how your portfolio performs over a period of time, you're going to get an average percentage. But you can't take that percentage and apply that evenly over your portfolio and say this is the exact amount of money that you made. It doesn't work that way.
It's going to be down times.
Yeah, there are down years and up years. So when you lose a lot or when you make a lot, it distorts it. So people know this. The people in financial services know this. Though on your statements it says your average rate of return is 10% or 12% or whatever it is, and it looks really nice. But if you do the math and you say, I actually put in this much money and I have, X more or X less, this is what I have. Generally, you're going to be like 5 to 7% under what that average rate of return as a real return. It's a really disheartening figure because most people don't know it. I just ran a master class where I taught people all these different concepts and I had them pull out their statements and they looked and people literally saw on their statement average rates of return anywhere from 7 to 11%. But when they calculated what the real rate of return is, it was anywhere from 2 to 4.4%.
Oh, man. Let's get into myth 2. Free. And by the way, there's good news coming. So this is the conflict. We will get to the commandments. But let's go to myth number 2. You can't spend freely and gain financially. I mean, I've been told for years, you got to get this nest egg, you got to get this principal up so high that you can live off the interest. What does that mean with this myth?
Well, the goal in conventional investing is having this large amount, your nest egg, that you hopefully have accumulated enough money that you can live off of just the interest of that principal that it kicks off. The reality is that's probably not going to happen. It's going to take more than what you think it's going to take. And at the same time, prices are rising due to inflation. So it makes it more and more challenging. So the reality is people are going to be spending down that principal as they live off it in retirement. And at a certain point, it's going to go to zero. The problem is people are living longer than they ever have before. You know, we've got our medical and science is the best it's ever been. We've got innovations with people living longer lives and healthier lives. And so that to me is more of a hope again. It's not based on science. It's not based on numbers. This is hoping that number ends up being big enough, but you never know if it's going to be big enough until you get to that point, which doesn't sound like real good planning to me.
So it's almost a losing game because we don't know our life length. You shared in a chat recently about actuaries and how they know this. I mean, this is their absolute science. And again, it almost sounds like the game's rigged.
Yeah, it is the way that people are learning to invest and where to put their money. It is rigged, and it's rigged for the companies that want the money, that can then take it and turn around and make tremendous wealth on that money, all at the expense of the person that they're not paying very much. Or subjecting them to a lot of risk. So the interesting thing is most people don't realize that it doesn't cost as much to cover your expenses as you think. You know, I did an exercise with people here recently where I had them break down how much it costs them to live, just simply to survive, like bare minimum. And what is that per month? And then what does it cost them to live the current lifestyle that they have per month? And then what does it cost them to live the lifestyle that they would like to have per month? And as it's broken down monthly, it's very unintimidating. You look at that number and you say, oh, wow, I could actually do this. And it might not happen in one investment. It might be a series of investments that produce the cash flow to get there. But that, to me, is a lot safer of a plan, having an asset that can be sold, that holds value, that kicks off cash, enough to cover what it costs you to live. And in retirement, you can just live on the cash flow and you still have the asset. And if you ever wanted to, you could sell the asset for a lump sum and utilize that income as well.
Sounds like a great exercise for people to do. What expenses could they live on? What is their current and what do they want for the future? Let's go to myth number 3. The best investments are tried and true choices you've already heard of.
Well, you think about the market today and the swings that we have seen, and this is just normal. It doesn't matter. Over the course of history, the stock market's going to go up and it's going to go down. And the way people have done things is one way of doing it, but it's not necessarily the best way, or it's clearly not the only way. But if you think about all the emerging industries, if you think about the world of technology and the world of software and the world of science and the world of cannabis and hemp and CBD and the world of music and the world of original content, which is, has greater importance today than ever before. All these areas are opportunities for investment. You could even look at real estate, and some of the real estate that is getting clobbered right now, where you can get these assets for pennies on the dollar. They can come back in time. So you're buying an asset that's going to hold value at as discounted of a price as you're ever going to get it. You can look at the retail industry getting hammered right now, and you can pick up brands for pennies on the dollar and scale them online. There's just so many opportunities that if you're only focused on what has happened in the past and investing in blue chip stocks, and that's your only solution, it is outdated and antiquated.
Wow. It's really reactionary instead of being proactive. And it gets into that point where, once again, you're not being a lifestyle investor, someone who controls your own destiny. You're sailing on the seas of the past. Let's go to myth number 4. You can't upgrade your lifestyle without sacrificing profit. You hear this all the time, especially from some of those financial advisors that you kind of say don't even drink their own medicine, but they talk about how really you can't enjoy life unless you're going to drain your principal. Talk more about that.
Well, there are a few different ways that you can go about buying things. You can either pay for them from money that has been saved up, you can finance it, or you can use cash flow from an asset to purchase it. And something that I learned from Robert Kiyosaki over the years, and he's been a great influence in my life just because I've read everything that he's put out. He's a big fan of buying an asset and having the cash flow of that asset pay for whatever the expense, or as he calls it, liability, is for whatever you're purchasing. So instead of going in the hole and spending principal or savings on something, why not invest it in something that will produce income now to pay for it, and then once it's paid off, we'll continue producing income? It's just a better way to do it.
Makes total sense. Myth number 5, most investing experts give good advice.
So this one is interesting because we want to believe that that's the case, but the reality is the information is probably coming from a source that wants your money. So one of the things that I like to do is I like to say, who benefits the most from this? Why do they want my money? And how do I benefit? Who's benefiting more, me or the people that are getting my money or getting my investment? And I think that that's a hard look that everyone should make at some point in time. I mentioned this a little bit earlier. Most of the time, people that are asking for you to invest with them are not even investing in the same thing that they're asking you to invest in. So if you said, hey, show me your portfolio, where are you investing money? It's an interesting thing because a lot of the times, most of the time, they're not even investing in the same products. They've got their money somewhere else.
It sounds like hypocrisy to me.
Yeah, it's exactly right. And you'll see this. So part of why I like, even in the real estate world with some of the syndications I invest with, is they all put money into the exact thing that they're investing in. And if they don't, by the way, I'm not going to invest with them. But I like seeing them having a strong percentage, 5 to 10% of their own money inside of every deal that they do, or inside of the fund that they're promoting, because they've got skin in the game. And in the investment space, I can tell you countless people who I know personally, firsthand, are not investing in the products that they're recommending their clients invest in.
Myth number 6, you need a lot of money to get started in cash flow investing. I think if you can share that that's not true, there's going to be a lot of listeners who find hope in that, because I think, man, that's one that slows so many people down. They think they need to be almost inheriting millions of dollars to essentially create a new wealthy legacy. How little money do you actually need?
The interesting thing is, any amount of money that is invested can be invested in a way that produces cash flow. And you have to start somewhere. So I have never had inheritance. I have never had a large exit. And I started investing when I was 18 years old. it could have been easy to argue and say I didn't have the money to invest, or I had college to pay for, or whatever argument that you want to make. But I made the decision that I was going to start investing with however much money I had. It didn't matter. I was going to take 15 or 20% of the money that I made, and I was going to invest it. I knew it was a good habit for the future, and I just figured I should start it as early as I could. And so when I started investing, I didn't know exactly where to put it. So I saved some of it, and some of it I put in the stock market, and some of it I put in qualified plans like a Roth IRA. And I did that with small amounts. I mean, probably anyone listening is making more money than I was making at the time that I started investing. Now, I didn't know then what I know today, and I would put it in different vehicles today, but I at least had the discipline to invest money so that when I got the right education, I could get it working for me in the best way.
Can you give me an example?
Yeah, one of my clients just recently talked to me about this. It was such a cool story. He said that his granddaughter came to him and said, "Hey, Grandpa, I want to become a businesswoman. I want to start a company. I don't know what to start, but I want to get my money working for me. I want to build something." And he said, "You know what? You should become a lifestyle investor." I've been working with this guy, Justin Donald, and he has exposed me to all these ideas, all these neat things. And my client is 57 years old. So he has gone most of his life never having heard of any of this. And so he is so excited to be sharing this. But he basically told me the story of how he shared with her. She could put away enough money right now where it's not necessarily a lot of money, but the figure that he gave me had her earning about $120 per month, but as a 10-year-old.
Oh my gosh. That's fantastic.
Isn't that great?
So you honestly can't start too early and you can't start too late with this concept.
There's no doubt. I have people in every age range that I've worked with in some capacity, and a lot of people say, "Gosh, I'm so glad I've learned about this now, but man, if I had learned about this 30 or 40 years ago, imagine where I'd be." But at the same time, I've got other people that are like, "Hey, I don't have a whole lot of money. I wish I had as much as your other clients." And I have to remind them, you're starting at 20 or 25 or 30, and a lot of these people are older than you. So there's always a pro and a con, or a series of pros and cons to your situation, no matter where you are, whether it be age, net worth, education. We could all have the story, but if you keep the pros in the front of your mind and move towards what it is that you do have, the gifts that you are allotted, that's when you can make good financial decisions. Murphy's Laws for the Lifestyle Investor. I really believe it's better to learn from other people's mistakes as much as possible. Warren Buffett. Every investor makes mistakes and loses money at some point. However, if I can prevent you from making one stupid investing mistake, like the one I'm about to share with you, I can save you hundreds of thousands or millions of dollars of your money. But more importantly, I can save you years of your time. After all, this book is about becoming a lifestyle investor. In the military, most soldiers see some variation of Murphy's Laws of Combat in their barracks as they go through basic training. I originally found this information on a Reddit post. Some of the comments by men and women who served in the military said one or more of these laws even saved their lives in armed combat. You can find hundreds of these so-called laws online, but I picked 20 of my favorites for this list. Murphy's Laws of Combat. Number 1, friendly fire isn't. Number 2, field experience is something you don't get until just after you need it. Number 3, no matter which way you have to march, it's always uphill. Number 4, odd objects attract fire. You are odd. Number 5, if it's stupid but it works, then it isn't stupid. Number 6, Try to look unimportant. The enemy may be low on ammo and not want to waste a bullet on you. Number 7, never share a foxhole with anyone braver than yourself. Number 8, never forget that the lowest bidder made your weapon. Number 9, there is no such thing as a perfect plan. Number 10, 5-second fuses always burn in 3 seconds. Number 11, the important things are always simple, and the simple are always hard. Number 12, incoming fire has the right of way. Number 13, no combat-ready unit has ever passed inspection. Number 14, no inspection-ready unit has ever passed combat. Number 15, if the enemy is within range, so are you. Number 16, the only thing more accurate than incoming enemy fire is incoming friendly fire. Number 17, things that must be shipped together as a set aren't. Number 18, things that must work together can't be carried to the field that way. Number 19, anything you do can get you killed, including nothing. And number 20, professional soldiers are predictable. The world is full of dangerous amateurs. Whether you are or were in the military or not, you can see some of the wisdom in these laws of combat. The danger of ignoring them, it turns out, can be deadly. They have led me to develop my own set of laws I call Murphy's Laws for the Lifestyle Investor. The danger of ignoring the laws. I'm going to tell you about one of the greatest investing mistakes I've ever made to prevent you from falling into the same space. Do you remember the Ponzi scheme perpetuated by Bernie Madoff and discovered in late 2008? I got caught in a Ponzi scheme that cost me almost $1 million. A few years ago, I heard about an amazing opportunity. I'd always wanted online real estate and found out about a company that built websites and would generate passive income from multiple income streams, including advertising revenue, affiliate revenue, and e-commerce revenue. It was said that it would ultimately build an audience list, and I would wind up with not only income, but an asset that could be sold. The deal seemed awesome because it paid 20% per year on my money. Plus, when the site sold, I would get to split that amount with the company 50-50. Sounds productive so far, right? Better yet, the investment required no work on my side, just capital. One of my good friends had invested in this company back in 2012, another in 2014, and the company had never missed a payment. From every perspective, it looked like a sure thing. Let me tell you the bad news first. I wound up investing $300,000 and made $60,000 the first year, exactly as promised. The business never missed a payment. Then, when the site was sold, my profit was $200,000. I chose to reinvest that money plus another $100,000, effectively doubling down. At that point, I was in for $600,000, my original investment of $300,000, plus $200,000 from the sale, plus another $100,000. I had another year and a half of returns that paid me a total of $200,000. Since everything to that point had worked like clockwork, I made yet another investment of $200,000 for a total of $800,000. I have a very thorough due diligence checklist that my team, including my attorney and I, go through before we make an investment. When I shared this deal with my attorney, he immediately tried to convince me not to get involved. He said, "It looks too good to be true." Sadly, I went ahead anyway. And so began what I call Murphy's Laws for the Lifestyle Investor, the checklist that shall not be violated. Number 1, if it looks too good to be true, it probably is. Number 2, if anything feels creepy, it probably is. Number 3, beware of name droppers and name dropping. Number 4, the important things are always simple, The simple are always hard. Number 5, when in doubt, review the principles and 10 commandments of lifestyle investing. Number 6, beware of abnormally high returns, regardless of how much you would like it to be your reality. Number 7, beware of dying industries. Number 8, beware of dying markets and cities. Number 9, if there's only one major employer in a city or town, it's probably too risky to invest there, no matter how good the deal looks. Number 10, investing in something just because your friends did without doing any research yourself isn't smart. Number 11, don't invest in something without considering how much it will cost you to own it and operate it. Number 12, do your due diligence. Don't trust their numbers. Remember, they are the ones that want to sell. Compare your notes with fellow investors to ensure you're hearing consistent information. Number 13, research customer reviews online. Number 14, run background checks on all sellers and partners. Number 15, get legal advice. Professionals will see things you don't. Number 16, make sure other experts like the investment. Number 17, interview several investors who have been longtime investors. Number 18, beware if there are no longtime investors. Number 19, never meet a person on their own battlefield. In other words, don't go to battle with an attorney who can drain you both energetically and financially. Number 20, let the party you are buying from underestimate you. Get your ego out of the way and don't act smart. Number 21, never sign a contract without reading it first and have your attorney approve it. Number 22, never assume the contract you're signing is the same one you approved. People can insert sneaky clauses at the last minute. Number 23, know which opportunities are built by professionals. Those are usually predictable. Some are built by amateurs. Those are dangerous. You need to know who you're dealing with. Number 24, the bank doesn't care where the money comes from as long as it's legal. And number 25, sometimes the best investment you'll ever make is the one you don't do. Let me give you a few specifics to fill in the blanks. My attorney said, it looks too good to be true. It looks like a Ponzi scheme. He was creeped out by the deal simply because of the way the company's legal counsel worded the contract. Eventually, when the deal fell apart and the auditing began, I found out these facts. The company lied about having third-party auditing and the prestigious firm they said did the auditing. They were an Inc. 5000 fastest-growing company for several years, and they continued to sustain their status with fraudulent financials. The founder was constantly name-dropping several online celebrities who were involved as investors and consultants to add further credibility. Eventually, when the company missed a payment, the owner wound up going down for paying investors with incoming investment money, which made this whole deal a Ponzi scheme. Unfortunately, the owner was given bad advice. The legal contract I signed, and all the other investors signed, stated that the company had discretion for how they would use incoming investor money. A portion would go to paying a guaranteed return, and a portion could go to other expenses they had. Part of their expenses included payouts to old investors. Although the owner maintained that he didn't know it at the time, paying old investors with new money is against the law. As my attorney and I started uncovering more, we found out the banks the company used should have known what was going on because the warning signs were present all along. Ultimately, the owner scaled too quickly and spent too much money. He brought on a CFO and a CEO too late to make meaningful changes. It was a 27-year-old business that worked until it didn't. I'm limited in what I can say at this point, but the owner is probably going to go to prison for a long time. The average sentence for a business Ponzi scheme is 8 to 12 years, according to my anecdotal online research. There is a happy outcome to the story, at least for me. It turns out a Ponzi scheme is 100% tax deductible according to the IRS, much more advantageous than writing off a typical business loss. The way the deal was structured, I received accelerated depreciation, which circumvented what would have otherwise been a large tax bill the year I invested. I can't disclose any more details because of the ongoing investigation at the time of this writing. Here's the moral of the story. Never let your ego and fear of losing money cause you to do illegal things that can land you in jail or ruin your relationships, reputation, or marriage. You can always earn back money, but you can irreparably destroy your reputation in minutes. Here's the gift of learning in this financial mistake. I'm a fool for losing the money, but I'm a greater fool if I don't learn the lessons inherent in the deal gone bad. Surround yourself with people infinitely smarter than you. Heed their advice and protect your risk. You may lose a battle, but be sure you win the war. My goal is to give you the guidance and support you need so you don't make stupid decisions that cost you money, and so you can protect yourself using the strategies and commandment stack to reduce your risk and make a good return. If you've lost money in the past, it's not your fault. You didn't have the right guide with the appropriate toolbox to help you reach your financial freedom. 2024 update: The dangers of ignoring Murphy's Laws for the lifestyle investor. In the 2020 version of the Lifestyle Investor, I wrote about the danger of ignoring Murphy's Laws for the lifestyle investor and talked about one of the greatest investing mistakes that I've ever made, getting caught in a Ponzi scheme that cost me almost $1 million. It's the checklist that shall not be violated for good reason. Recall the first law: if it looks too good to be true, it probably is. Or the sixth law: beware of abnormally high returns, regardless of how much you would like it to be your reality. By request, here is the update on that terrible deal and its aftermath that I couldn't publish in the book. An elaborate ruse. As I was writing The Lifestyle Investor, the owner was being tried for criminal fraud after independent investigations from the Federal Bureau of Investigations and the Securities and Exchange Commission. The court had appointed a receiver to take control of the remaining assets, and profit shrank to a minimum. I was called in as a key witness by federal prosecutors to testify against the owner in court. I worked with the prosecution team and federal agents to hand over the incriminating evidence that I had gathered: recorded phone conversations, video calls, email correspondences, financial statements, screenshots, and more. During the trial, I flew into Chicago to take the stand. I was grilled for over an hour, not including a lunch break in the middle of my testimony. The owner's legal team tried aggressively to rattle and discredit me. They questioned my credibility, character, and motives in an attempt to poke holes in the information I provided. I stuck to the facts and timeline of events without getting defensive or emotional. Even when I was frustrated by their tactics, I knew I was on the side of truth and didn't let them rattle me. It was a very interesting experience to look in the eyes of the guy who made so many poor choices and flat out lied to hundreds of people. After deliberating, the jury found the owner guilty on all 7 charges of wire fraud, each punishable by up to 20 years in federal prison. His sentencing is scheduled to take place in 2024. While justice was served in this case, nearly 500 investors also affected by this scheme are in the same position as me, learning the hard way. Here's a lifestyle investor lesson. Keep a meticulous digital paper trail. Archive all communications involving financial and business deals. A silver lining emerges. In mid-2023, I received an email noting that there would be a distribution from what was recovered by the receiver that took over. Though these receiverships often spend substantial money on forensic accounting, there was still some underlying value in the assets. We've received an initial 10% distribution with a second distribution due in the future. The key takeaway is that even disastrous deals can have a silver lining if intrinsic value exists. By investing in companies with tangible assets, you secure a senior position to recoup losses if things unravel. Though it took several years in this case, we're finally seeing some money returned. It pays to think through worst-case scenarios and ensure adequate remedies are in place. Staying focused on value positions you best in any outcome. Here's a lifestyle investor lesson. Seek companies with tangible assets, securing senior creditor status to get repaid, even in worst-case scenarios. A shift in mindset. Here's another really good lesson that I've learned. I used to make investments thinking, this is a really good deal. Let me see if I can prove otherwise. But the reality is that most deals are actually not good deals. Even good deals can turn bad in certain economic seasons. So now I enter every deal thinking, this deal is likely not good unless I can actually prove otherwise. Instead of entering a deal thinking, I want to invest in this, let me see if there's any reason not to, I now assume it's a bad deal unless I can poke holes and find truth that makes it a good deal. This mindset shift in how I evaluate deals has helped me say no to more deals and spend less time on the ones that aren't worth pursuing. It impacts my filtering process so I can more quickly filter opportunities. Here's another lifestyle investor lesson. Enter deals with intense skepticism, scrutinizing weaknesses until they're proven a wise investment. Hard-learned lessons from a cautionary tale. With time and reflection, I extracted invaluable insights from this catastrophe. Number one, our minds can rationalize away even the brightest red flags when we want something. I ignored expert warnings and my own intuition. Number two, my perspective has changed on how I approach deals. Instead of assuming a deal is a good deal, I now assume most deals are flawed and scrutinize them intensely. Number three, trust must be complemented by rigorous due diligence. Number four, a good reputation takes a lifetime to build, but moments to destroy. One bad decision can undermine years of goodwill. Number five, the choice to do right when it's uncomfortable defines who we are. Number six, mistakes and failures can be our greatest teachers if we extract the lessons. My responsibility is now to share my learnings with humility. Safeguards and best practices to mitigate investment risks. Based on the hard lessons I learned, here is a checklist of safeguards and best practices you can implement to mitigate investment risks moving forward. Number one, rigorously vet every deal with qualified experts who offer unbiased counsel, even if it means losing the opportunity. Slow thinking beats speed. Number two, do not ignore red flags or suspend disbelief regardless of how promising an investment appears or who is involved. Trust facts over emotions. Number three, assume most deals are bad from the start and scrutinize them intensely before considering the investment. This perspective allows more objectivity and prevents you from being seduced by superficial strengths. Number four, foster a contrarian culture on the team and make it okay to critically challenge each other's assumptions to avoid groupthink. Number five, maintain meticulous records should issues arise requiring investigation or litigation. An impeccable paper trail protects all parties. Number six, develop contingency plans to rapidly respond when investments show early signs of issues. Nimble course correction can save so much frustration later on. Number seven, remain hyper-vigilant of blind spots fueled by ego or greed, as they can make it easy to miss crucial warning signs. And number eight, hold yourself and your partners accountable to the highest ethical standards, especially when stakes are high. Reputation lost is nearly impossible to restore.
Justin, I love how you take something that we've all heard of, Murphy's Law, which means what? It means if something can go wrong, it will go wrong.
That's exactly right.
Yeah, and you take that concept, you not only tell us the actual Murphy's Laws of combat, and I think you and I were joking. I mean, some of these are funny. Which one is kind of funny for you?
friendly fire isn't the very first one.
There you go.
I mean, it's scary, but it's comical at the same time.
Yeah. Oh, yeah. And man, I liked one where it said something about like, if the enemy is within range, so are you.
Exactly.
Right?
Exactly.
So these are funny and comical, and yet you talk about how actually you had a situation in your life where you didn't pay attention to Murphy's laws of investing. And I love how you share the honesty and authenticity in this book, because you could have came off like a bulletproof, never made a mistake type of guy. But instead, there was a situation where you invested in something that turned out to be, was it like a legit Ponzi scam?
Yeah, that's it right now is in kind of the final stages of it. But yes, that's that's where we're at, unfortunately.
Yeah.
Fortunately and unfortunately, I'll say. It kind of sounds weird me saying fortunately, but sometimes it takes a wake-up call like this to help someone like me and maybe others learn important lessons. And trust me, I learned a lot of lessons.
So I think you said your attorney basically advised against it, but talk about how every deal, I mean, by its very nature, has to have some risk. Is this true?
Yeah, I mean, virtually everything has risk. I mean, there are some arbitrage opportunities, and in the definition of an arbitrage, it would be a riskless or risk-free opportunity. So they do exist, but there's not many. So virtually everything has risk to it. And then it's also important to recognize as an investor, you're going to lose money at some point. And hopefully it's sooner than later, because then you can learn valuable lessons. So as your wealth accumulates, you don't make the same mistake again.
I know the first time you told me that, it just kind of stopped me in my tracks, because in my business, I teach people all the time. You know, you're going to fail as an author. You're going to fail as a coach. You're going to fail with a sales presentation. I teach that, and you're a parent. I'm a parent. We each teach our kids, hey, you're going to go out on the basketball court. You're going to make a mistake. But yet, when it comes to money and investing, I almost don't. It's like you said that, and it freaked me out. Like, I'm sure it freaks out a lot of people listening to this audiobook. But are you telling us that A, we're going to lose money, and B, like, accept it?
Yeah, you're going to lose money. Everyone loses money at some point. The goal is to just make sure you're making more than you're losing. So if you're making sophisticated investments and you're being wise, not only should you learn lessons every time you lose money, but you should be diversifying the investments so that as you lose in one, you make money in another. And so the overall net gain is a win. So it's kind of like, we're talking about a war analogy here. So you may lose a battle, but you just want to make sure you win the war.
Ooh, that's good. I like that. So on that point, what you're basically saying is that we need to accept that, and that's going to free us up, and it's going to make it so that we're de-risking. That concept is fantastic. De-risk. Everything has risk, but according to the commandments and some of these Murphy laws of lifestyle investor, we can actually stack the deck in our favor. How did you not stack the deck in your favor when it came to that Ponzi scheme?
Well, I should have, first off, listened to my attorney. My attorney is just one of the most brilliant people in the world, and I have a philosophy when surrounding yourself with advisors. First of all, you want to surround yourself with the smartest people that you can find, people that are way smarter than you. So my team of experts, my advisors, my legal counsel, they are all infinitely smarter than me. But at the same point in time, I have to recognize that if I listen to them on everything, attorneys are risk averse. So if I were to listen to everything that my attorney says, I probably wouldn't do much investing. So I've got to use some of my own judgment as well. And where he sees risk, I just need to do my best to protect against it. In this particular instance, I did not protect against it. I did not heed his warning. And I mean, luckily he doesn't rub it in my face, but I mean, he called this ahead of time. I should have had better eyes and maybe a little more skepticism. What he tells me I need, I'm a half glass full kind of guy. He said, when you're looking at a deal, you have to be a glass half empty kind of person and look at it as if it's not going to work and figure out how to prove that it could. So you assume it's not a good deal. You assume that they're lying to you. You assume all the worst. And then if you can still make it work and prove that it is a viable option, only then do you invest.
That's great, man. And that is an adjustment for a lot of us because we are big positive people, but the risk component is true. Let's go into the actual laws now. You have the Murphy's Laws for the lifestyle investor. Some of these are just funny too, but they're true. If anything feels creepy, it probably is. Beware of name droppers and name dropping. Why do you think those types of laws made the list, the name dropping?
Because it is so prevalent, and often people can fool the investor by having prominent other investors or prominent groups or big name celebrities that are involved. And each of these rules that I have here, this checklist, they come from actual experiences. And so when I look at deals that went bad, and luckily, knock on wood, I haven't had many of them. The one I share in this is a big one, but luckily I haven't had too many. But I got to tell you, the moment that money is in a deal, that's when I think most people are willing to learn. Their money is at risk. They have skin in the game, and so they're willing to learn. So at that point in time, I think people are the most ready that they're ever going to be. And then if they lose money, then there are so many lessons. Sometimes people just get hung up in not, making a good choice, or maybe they're playing the victim. For me, I want to find the lesson and seek out the lesson. So these all came from scenarios that either A, I invested in and it went bad, B, I didn't invest in because of this, or C, I invested in it because I didn't have one of these.
Wow, that is awesome. So let's talk about the upside of this choice that you made that wasn't ideal. It all worked out. You say that you actually could use it as a tax write-off. So even though it sounds devastating, you actually turned it into a win, or you at least made the loss not as horrible.
Yeah, and that, I've got to give credit to smart advisors around me, because I am a student and I soak up everything that they say. And so a lot of this investment on the front end of it was for the purpose of some tax write-offs. When you're investing in software, for example, you can have accelerated depreciation on it. So I was able to utilize that. There were some unique ways that I was able to buy and sell the company with different entities and kind of start that over and take a loss in a lower income year and write off more in a higher income year, just depending on when investments kind of come due and when I have returns. Additionally, the IRS says, if there's in fact a Ponzi scheme, you can write off the full amount of the investment, which is different than just a typical investment loss. And so if you compound not only the cash flow that I got during the time that the investment was good, in this case is a very unique scenario, because for almost 28 or 29 years, this was a legit company that did the right thing and paid out investors, and everything was great. It was really just a few years ago where everything kind of started falling apart. So I actually made money for a period of time. And then additionally, I got to take the deductions, and then I'll get to take this full amount as well. So it sounds like a big deal, but at the end of the day, I really am probably going to walk away pretty even.
Wow. And with a ton of lessons and now more confidence. I mean, it makes it sound like you really approached the entire lesson with the desire to learn. Whereas, like you said, some people would have said, I'm done, I'm out of the game, and it would have knocked them completely out.
Yeah, there's no doubt that it was like a punch to the gut, only it wasn't one where you were able to breathe real quick after. I mean, this is one that it's not like in that moment I was like, what are the lessons? I mean, it was very painful. And once I could then pull myself out of that, once I could get my breath back, only then did I really say, okay, there is a gift in this. What is the gift? There are lessons. I'm a fool for having lost the money. I'd be an even greater fool for not having learned the lessons. Mm-hmm. And so that to me, I mean, there are so many lessons I've learned in this that have helped me on all my future investments. And the reality is exactly that. When your money's in the deal, you're going to learn. When you are at risk of loss or you do lose, you can learn the most. There's so much opportunity because whenever your livelihood is threatened, that's when you are actually the most open to learning if you choose to approach it that way.
Sounds like everyone, including me, we need to apply the Murphy's Laws for the lifestyle investor, the checklist that shall not be violated.
Part 2, the commandments. Commandment 1, lifestyle first. My definition of success is to live your life in a way that causes you to feel a ton of pleasure and very little pain. And because of your lifestyle, have the people around you feel a lot more pleasure than they do pain. Tony Robbins. As of this writing, I no longer coach one-on-one. All my advisory activities take place through the Lifestyle Investor Mastermind, a community of lions and my trusted, vetted financial experts. Let me tell you a story about my first lifestyle investor lion. Lions are my high net worth private investor clients who coach with me one-on-one over the course of a year. Each lion receives personal coaching on high-level investment strategy that includes mindset, deal structuring, deal filtering, and negotiation with real investment opportunities. My goal is to help each lion build a portfolio of investments that mirrors my own, providing cash flow with the least amount of risk that is lifestyle compatible. After a year, each lion has the knowledge, wisdom, and understanding of how to stack strategies that provide the highest return on investment. More importantly, during that year, each lion gains access to my huge network of over 20 years of relationships with professionals who specialize in creating unique structures to protect their assets and provide high-level tax strategy and advice. The lions also gain ongoing access to deals that are often invisible or difficult to access without an introduction. My first lifestyle investor lion now wakes up when he wants to wake up and hasn't used an alarm clock in years. He has no boss or job that demands his time. He spends his first hour of his day reading, praying, meditating, and journaling. Last year, he read over 150 books. Then he spends an hour working out. At age 40, he has chiseled abs, and his wife of almost 10 years still thinks he's hot. After his workout, he reviews his 8-figure portfolio and 7-figure bank accounts and reflects on his lifestyle vision. It includes family vacation goals consisting of 2 months of travel and international trips, one to Europe and another to the Caribbean. It also includes him taking at least 2 business trips with ultra-high net worth individuals who have become close personal friends. Over the next 2 hours, he joins video calls with the CEOs of his most recent investments, takes a leisurely lunch, and quits his day around 2 p.m. He and his wife have customized an educational solution for their daughter that includes homeschooling and private instruction so he is available to spend time with her. He and his wife also spend hours together, walking and talking. The three of them have regular family meals. After they've tucked their daughter into bed, he and his wife enjoy a bottle of wine to connect and reflect. This lion chooses to work 3 days a week, takes 3 and 4 day weekends, and knows he could stop working for years if he wanted. And he has an abundance of time to think, which he uses to listen to inspiring podcasts that help him strategize for the long term and then journal his insights. Now he earns more in his sleep in the first week of the month than he used to in a month's worth of 50 to 70-hour work weeks. Back then, he was a high income earner with a multiple six-figure income. Today, my client has total agency in his life. He has the freedom to choose how he spends his time, both with his family and friends, and pursuing his passions and purpose in life. He pursues mental, physical, emotional, and spiritual growth by placing his relationships and overall health first. He has given his wife the freedom to not have to work and to pursue her passions. At any time, if he and his wife choose to stop sending their daughter to one of the best private schools in the U.S., they have the ability and time to homeschool her. They do not live a conspicuous, flashy lifestyle. No one could guess his net worth just by looking at him and his family. Not only does he have the same friends from 20 plus years ago, but he has access to a whole new level of relationships with multimillionaires and billionaires that he once only dreamed of. He and his wife tithe to their church and give generously to several philanthropic organizations every year. His life is filled with choices and freedom. He could buy whatever he wants for his family at any time, but what drives him is impact, connection, giving back, and making a difference. The first benchmark to financial freedom that he set was for his wife to stop working. She was a talented high school business teacher, but as a family, they wanted a higher quality lifestyle and more flexibility in general. She was making $36,000 a year, so he knew if he wanted to replace her income, he needed to earn $36,000 a year from an asset that produced the same amount of income. Technically, he could invest in an asset that produced less income than $36,000 a year because her after-tax income was much less than that. Plus, investment income is taxed at a much lower rate than earned income as well. He broke down what he needed to make per month, and then he decided to buy a mobile home park. This first purchase nearly covered her salary, and it was enough that she didn't need to work anymore. It was a smooth transition for her to step away from teaching, to spend more time as a family, travel, and do other things the family wanted to do. It bought her time back and created that freedom of time in her life. Then he did the same thing to replace his income just a few years later. Full disclosure, my very first lion was me. I had to live the lifestyle investor vision before I felt comfortable teaching it or sharing it with someone else. My rule is never to take financial advice from someone who isn't currently doing what I want to do and experiencing the lifestyle I want to live, so I had to live it first. For me to have total confidence in my ability to coach and teach everything you're about to hear in this book, it's critically important that I live by example, and recency matters. If I were writing this book 10 or 20 years after my last failure and hadn't recovered, I wouldn't trust myself to give you good advice. Plus, I'd never work with a financial coach who isn't earning more than I am. The Freedom Formula. Before you go any further listening to me, take a moment right now to do this Freedom Formula exercise. Check your highest priorities in each Freedom Formula category to help you design your perfect lifestyle. To download your free copy of the Freedom Formula checklist, be sure to go to lifestyleinvestor.com/gift. At this point, you may be listening to this audiobook while you drive or while you work out, and I want to encourage you to pause it for a second, go to lifestyleinvestor.com/gift to download your free copy of the Freedom Formula checklist. If you're unable to download it now for whatever reason, let me read through the checklist for you. Time plus money plus relationships plus impact equals lifestyle investor freedom. Freedom of time. What's important to you? Time to wake up when you want. Time to exercise and get in shape. Time to pray and meditate. Time to journal and reflect. Time to homeschool your children. Time to listen to inspiring podcasts and read inspiring books. Time to strategize and do long-term thinking, planning, and goal setting. Time for family dinner and uninterrupted quality family fun. Time to vacation several times a year or even more based on your dreams. Time to travel for months at a time. Time to take a class or learn something you have wanted to learn. Freedom of money. What's important to you? Choosing to work or not work for years at a time? Buying whatever you want, whenever you want? Writing a giant check or making a frivolous purchase without noticing the balance in your bank account? 7, 8, or 9-figure net worth? 7 figures or more in liquid assets? Anytime, anywhere vacations? Extended worldwide travel in the nicest hotels and homes anywhere in the world for as long as you want? Paying for any professional or service to buy more time? Giving generously and freely? Using money as a tool to accomplish more dreams and goals? Or creating a trust fund for family, friends, or others? Freedom of relationship. What's important to you? Taking courses or classes to connect more deeply with your spouse and children? Working with people who inspire you? Choosing who to spend time with on a regular basis? Scheduling dedicated quality of time with the 5 to 10 most important people to you? Scheduling epic experiences with the people you love most in your life? Pursuing relationships with anyone that elevates you or any social status or ability to connect with influencers? Courage and confidence to connect with celebrities? Building relationships with ambassadors, individuals who can influence influencers and help you gain access to affinity groups and organizations? Participating in your children's hobbies or sports teams, parent-teacher association, or other groups? Media, increasing your visibility online, in media, and in the press so you can share your message and easily connect with more people? Or elevated groups, joining high-level professional groups such as Tiger 21, EO, YPO, Strategic Coach, Genius Network, Wellspring, or Front Row Dads to meet and connect with high-functioning, high-performance individuals who can mentor you and help you grow. Freedom of impact. What's important to you? Doing inspiring, energizing work? Supporting a nonprofit, 501c3, or charitable organization? Being able to directly help people in need? Mentoring students eager to learn? Setting up a foundation? Volunteering to serve your church, community, career groups, or charities? Establishing a grant fund for a school, university, or charitable group? Donating your expertise? Pursuing your passions without factoring in money? Being able to give back or support an organization dedicated to animal advocacy, ecological conservation, or another cause that benefits the planet? Or artistic expression that positively affects an audience or group that matters to you? Notice that the freedom formula begins with time. If you had the ability to buy more time, you'd have the life you've always dreamed of. That is what being a lifestyle investor is all about. It's about owning your time and buying more time and freedom to do whatever you want to do, whenever you want to do it, with whomever you want to do it with, for any reason, as well as using your unique gifts in a way that brings the most passion in your life. Your next step is to write a brief paragraph based on your values, considering the model of the lion lifestyle I described earlier. What does your perfect day look like? If you had days like it for the rest of your life, would you feel like you are living your happily ever after life? After you've written that paragraph, here's one more exercise. I call this my freedom from and freedom to. If you could do one thing that would move you closer to your happily ever after, what would it be? Pause this audiobook now and use this time to describe your freedom vision. You can also download your Freedom Vision worksheet at lifestyleinvestor.com/gift. If you're unable to download it now for any reason, take this time to journal your thoughts on a piece of paper or in your note tab on your phone. I strongly encourage you to take the time to write this down before you move to the next section of the audiobook. Are you pleased with what you've written? Hopefully today represents the first day of the rest of your life as you become a successful lifestyle investor. You've discovered your freedom vision. Now it's time to find out what you need to do to achieve it. The first step to becoming wealthy and becoming a lifestyle investor with the ability to live life on your terms is changing your mindset. Adopt the mindset. I'm a huge advocate of personal and spiritual development. If it weren't for pursuing this work personally, I wouldn't have the lifestyle freedom, money, or ability to share my system with you now. But I do, and I can. It all begins with adopting the lifestyle investor mindset. Wealthy people think like wealthy people. They have the disciplined behaviors and thinking processes, and they practice the habits of wealthy people. People without wealth are the opposite. They're stuck in a cycle of undisciplined behaviors, wrong thinking, and bad habits. They don't see or understand the nuances and distinctions that wealthy people do. My stories in this book are one resource for you to use to begin to think like wealthy people think. Please refer to the additional tools in the resources you can download for free at lifestyleinvestor.com/gift. The lifestyle investor mindset includes believing in and acting on the discipline that each investment must truly represent passive income in which your earnings don't depend on the time you spend working. Adopting this discipline means your income becomes fully independent of you and happens whether you're asleep or on vacation. We've all heard the adage that time is money. Most people believe that you have to be working in your business to make more money. The truth is, even outside the realm of passive income, it's still not the best protocol or value to follow inside a business. Another myth is the idea of building your nest egg and living a frugal life. You can't even go to Starbucks to get your latte because you've got to save every extra penny you can to build a bigger nest egg. Both of those are total myths, wrong ways of thinking that keep you from becoming wealthy. When you change your thinking to make lifestyle your priority, you can approach every element of a deal differently than a conventional investor. When you stack my strategies and commandments together, your investments can offer you additional levels of freedom and income. One example is learning how to structure loans properly. Instead of going for a conventional loan where I put 20% down and the bank covered 80%, I actually negotiated a deal with the owner and seller of a mobile home park to finance it. We talked about it, and he felt comfortable with me putting 15% down with him, which was my goal. I wanted to get a better deal than if I used a financial institution. The out-of-pocket cost on the first mobile home park was a down payment of $65,000. I then bought a second park with the same loan structure and a down payment of $75,000. My family lifestyle at the time cost $110,000 a year, so both of those down payments combined covered a little more than our annual lifestyle expenses, which is relevant because my first goal was to have 12 months of living expenses saved in case we ever needed it. As I mentioned earlier, I wanted to replace my wife's $36,000 of income. The cash flow from the $65,000 down payment on the first property nearly accomplished it. I typically enter into deals where the cash flow is immediate, so we were cash flowing positively the first month. It's important to note that although the number needed to cover our lifestyle at that time was $110,000, we could have covered our bare minimum expenses for about $52,000 a year. Knowing that, I made sure the cash flow from my second deal, combined with the amount from my first deal, would cover those bare minimum expenses. It did. As a lifestyle investor, I often tried to prepare mentally for worst-case scenarios so I would have a good plan in place in case my family needed it. In this case, if I became injured and even couldn't work, I knew we'd be covered and could survive, even if it wasn't at the same level as our lifestyle that we had become accustomed to at that time. Wealth optimization. Let's talk about the concept of wealth optimization. When I look at wealth, my mindset is to take a holistic approach. First of all, I don't look at wealth as only money. Money is one component of wealth. A healthy physical body, emotional state, and spiritual strength are all parts of wealth. So are relationships and purpose. Therefore, when I look at wealth, I want to optimize every component of it. Being in a good place financially, which is a big component of wealth, buys your time back to do other things. You can make sure you're mentally and physically strong, intellectually growing, and stimulated. You have the time, space, and finances to eat the right food, which could include buying organic or having your meals prepared for you. You can schedule regular adjustments, acupuncture, or massages for your physical health. You can give attention to your emotional and spiritual health. All these components work in tandem with each other. When you think specifically of wealth creation and wealth building from a financial sense, there's a holistic way to look at the overarching picture. Most people look at the little snippets they've learned from someone who probably isn't educated holistically or even qualified to share high-level strategy, and the information they get is mostly propaganda. Most of the information comes from Wall Street and banks that cultivate and curate the content and education going through our universities and colleges. These sources steer people to give them money. The people at these institutions teaching you to invest have the same mindset as the information sources that want your money. Once you give these sources your money, i.e. banks, other financial institutions, they make a multitude of money on it, give you low returns, and pay themselves first, regardless of whether they're making you any money. It's crazy. And if you continue this insanity of giving them your money without results, you're as guilty as they are at perpetuating this craziness. I have two snippets tried and true about lifestyle first and how much time is involved in earning a return. First, some investments require no time at all. They are truly what most people are looking for once they learn they exist. Second, in some cases, it may make sense to invest a little time at the beginning to supercharge your return. When I first started investing, I was willing to invest a little time at the beginning to get a higher return. Now my investments don't take any time. They truly are passive investments, and I'm willing to take a lower return in exchange for my time. One of the reasons I bought mobile home parks is that they have the highest cash-on-cash return and the lowest commitment of time in the real estate rental space. Starting out, it made sense for me to spend the 5 extra hours a week it took to run the rental business myself. I needed to learn how to do everything anyway, so at some point I could replace myself. By running the business myself first, I was able to make a much stronger return than if I paid someone else to run it for me. Eventually, I hired some amazing people that I loved to work with and trained a team to take over all operations. In doing so, I knew I would make a smaller return than running it myself, but I also knew my end goal was to buy back my time. My director of operations is a wonderfully amazing woman who has worked with me for over 15 years now and does an infinitely better job running my real estate portfolio than I ever used to do. If your objective is the highest rate of return and you're willing to invest a small amount of time in the beginning, investing into some sort of real estate rental like mobile home parks is one of the easiest ways to start lifestyle investing. Being willing to invest a little time at the beginning is an important mindset and discipline so you can become consciously competent at finding the balance that's right for you. If you have more money and don't want to spend the time in the beginning, here's an example of how you can leverage both your time and money to create true passive income as a lifestyle investor by using hard money loans. The example shows how each of my principles of investment comes into play. Here's an example of hard money loans. A hard money loan is a loan that is secured by real property. Often it is considered a last resort loan in the event that someone can't get bank financing. Many people use these loans as a short-term bridge loan or construction loan before they refinance a property with long-term financing. Hard money loans typically originate from individuals or companies and not banks, so they have a higher interest rate and a shorter duration than a typical loan. Mindset. Let me give you my mindset on this particular example. I am a big fan of mirroring others who have a successful process. It's part of my lifestyle investor mindset. If someone else can do it, then I can too. I have a few highly successful friends who have done hard money lending most of their careers, so I've modeled their approach and terms to do hard money loan deals. This approach allows me to earn a great return in a safe investment that requires little to no time, so I can genuinely put lifestyle first. I like the short duration of the hard money loan with a high interest rate and points or fees charged on the front of the loan. These investments, when structured correctly, have little risk but a high return. Plus, due to the short time frame and front-loaded fees, I'm able to easily structure additional loans to compound my return. Here's the structure of this particular example. The right structure is essential to a good deal. Here are some of the specific terms I use to create a strong return and protect my investment so I don't lose money. 1. A 6 to 12 month loan. 2. Balloon payment at the 6 to 12 month term, which is a repayment of the loan. 3. Monthly interest-only payments. 4. 12% interest. 5. 2 to 4 points, or 2% to 4% of the loan paid up front. 6. Investment backed by collateral that is at least 2 times greater than the loan. In most cases, it's collateralized by the deed of trust on the property, and you assume ownership of the asset and can sell it if the borrower defaults. 8. Use experienced operators and real estate professionals with a proven track record to avoid a default. Here's my filter for this particular example. Remember, a filter uses criteria to sort through and narrow down an investment opportunity. While it might sound negative, what's most appealing about a hard money loan deal is if the borrower defaults. In that case, my investment becomes infinitely better. My hope is that the borrower doesn't default, but the deal is structured in a way that is very attractive to me if they do. If they do default, my investment improves exponentially. I can take possession of the asset that it's collateralized against. As you can see, my investment terms create a double win scenario where no matter what happens, I earn a solid return, which is my favorite type of investment. Next, I negotiate the deal. Here's my principle of negotiation at work. When I make the deal, I negotiate more collateral than the value of the loan. If a borrower defaults, I come out ahead with another real estate asset greater than my investment. I also like to negotiate a high point total, such as 4%, to be paid on the front of the loan to reduce the risk of the deal. Additionally, I like to charge a high interest rate, such as 12% or greater, and to have a short duration of the loan term. These elements of the deal are to ensure that I gain my principal back within a year or less with strong cash flow for my monthly payments. Additionally, I only release half of the loan amount in the initial installment until certain criteria is met. Then I release the rest, which helps minimize the risk involved, making sure the borrower uses the capital in the way they're supposed to and that the loan performs well. Okay, so here's the deal in review. Commandment 1 is lifestyle first. It is important to me that all my investments enhance my lifestyle in some way. Not only do I want to have strong cash flow from most of my investments, but it's also important that my investments don't require much, if any, time. This commandment enables my goal to earn income that is independent of my time. To follow this commandment, I look for investments such as hard money loans and variations of hard money loans that give me more freedom of time without sacrificing a high return. A hard money loan is just one of many investments that satisfy lifestyle first.
Justin, that example that you gave in this very first commandment, I'll tell you what, it totally had me. Because as I heard you describe your first lifestyle investor lion, I found myself saying, ooh, I want that. I want to be that guy who's reading those books and praying and vacationing and this type of thing. And then all of a sudden, you pull back the curtain and say, hey, that first investor was me. I think that starts out with such authenticity because so many gurus, experts out there, they really talk about this life that they haven't even achieved yet themselves. And you could just sense how inauthentic that is. How did you start this chapter, this story? I mean, what gave you the idea to just start the first commandment that way?
Well, I had a client recently say that they've been very successful with investing and building wealth, but they don't have the life that I have. And they thought it was really appealing. And he specifically said, I'm so busy, my time is so tied up, I don't even know how I would do that. But hearing what you have, I know I need to work with you. And so I thought that if this guy who's ultra successful, if that was a story or it just kind of resonated with him so well, I was like, well, that could be a real good way to start off the most important principle, which is, having lifestyle, putting lifestyle first, because everything else is going to contribute to lifestyle. So I want to keep that on the forefront of the listener's mind. So it's just it's a real blessing to have what I've built, but it hasn't always been there. It took a vision and it took time to think and to schedule and to strategize, but it's really neat to see that full circle and what it looks like. And really, I had to be authentic to myself, and I didn't believe that I should be teaching what I'm doing until it's actually proven, actually replicatable. So I had to put in a couple decades of time to show that what I do works, more to myself than anyone else. And that's why I feel so good teaching and sharing and coaching the investment strategies that I utilize.
Well, in that first commandment, let's even talk about commandments, because your subtitle says it all. I mean, you have this very fun, attractive title called The Lifestyle Investor, which, man, it sounds like people would be attracted to that. But then you have this very dogmatic subtitle that basically talks about the 10 commandments, and specifically the 10 commandments of cash flow investing for passive income and financial freedom. Commandments aren't up for debate. Commandments are something that is essential. Why did you pick such a dogmatic subtitle with this kind of fun title? It almost seems like the two are opposed, but when you really unpack it, they complement each other.
Yeah, that's exactly it. They do complement each other once you really dig into it and understand the criteria that the Ten Commandments represent. So I wanted to give actual certain details on if you do these things, you can get good results. So that was the goal. I didn't want to give a passive strategy. I didn't want to say, well, you could do this or you could do that. What I wanted to do is say, here's what I have done. This is exactly it to a T. And because of following this, it has created the lifestyle that I live today.
And as we dive into these commandments, they build on each other. In other words, it's kind of like the 10 commandments of the Bible. You can't say, well, I'm just going to follow 9 and skip 1. You almost have these commandments, they build on each other and they're interdependent. How important is it that we really consider all 10?
Well, I think the more that you stack these, the greater the impact. So there's a magnifying effect. So you can have great success just utilizing some of them, but the more you utilize, the greater of a return it's probably going to produce, the greater of risk protection it probably has. So this is something where I can look at it and say, okay, if this investment lines up and I can check the box on all 10 of these, that's got to be a really good investment. If something maybe checks 7 of the boxes, then I really need to spend a little more time to see if that makes sense for me. You know, if it's less than 7, it probably doesn't get a whole lot of my attention.
And most books I could see starting out with first commandment, money first, or profit first. Yours starts with lifestyle first. I think that automatically says this is a unique model that you've probably never heard of. How much does that first commandment surprise clients and surprise individuals who might be listening to this audiobook?
It surprises them a lot because I don't think that they ever thought it could be true. So it's almost like, is that too good to be true? Explain it to me. Help me understand how this is the reality. But what I really want to help people understand is that most people go through life reacting. My goal was to live it proactively. I wanted to take the time and create the space to figure out how I wanted to live and what I wanted to do and who I wanted to spend time with and how I wanted to spend my time. So the whole idea of lifestyle is being proactive and being intentional and figuring out what it is that I want and the listeners want out of life. And that creates a lot of passion. It creates a lot of energy and fun. And that replaces being reactive, just doing something in response to something else. That involves carving out time and being intentional versus being reactive is kind of being unintentional and almost walking aimlessly through life, which I know and can relate to well because I was once there.
I love how you finish this particular commandment with design your perfect lifestyle, those instructions. And then you give us 4 quadrants of our life. And if people want to access this, I know that they can go on your website. What is your website one more time?
It's lifestyleinvestor.com.
Lifestyleinvestor.com. So whether people have the physical book or are listening to the audiobook, if they need to access this assessment, they can do that. But let's talk about those 4 quadrants because I think it's so important. You have freedom of time, you have freedom of money, you have freedom of impact, and you have freedom of relationship. I know we had a chat recently and you talked about nobody says on their deathbed that they want certain things. Talk about those 4 quadrants and why they matter so much.
So with freedom of time, that's really what most people want is they want their time. They want to buy time back. That's what I wanted. I wanted to buy my time back so that I could live in a way that was inspiring to me and that was inspiring to my family and to my friends and to those that are most important to me. So everything else is a means to an end. So one of these is freedom of money. Well, freedom of money is great. Having money solves financial problems. It's not going to solve all your problems. There's no amount of money that can solve all your problems, but it most certainly can solve your financial problems, which feels really good. And it creates a lot of space to be able to do the things that you want to do. So I think freedom of time is most important. That's why I list it first. And a lot of the other freedoms kind of funnel into time. Most people probably, some people probably realize this. I really don't think most people realize what they really want is freedom of time, not freedom of money. But I have on here freedom of relationship because when you talk to people on their deathbed, the number one thing they talk about is the people in their life that mean the most to them. And it's either a story of how grateful they are for the relationships they have and the time that they spent forging and deepening these relationships, or it's the opposite. And it's, I wish I would have spent more time. I'm kicking myself. I was too focused on earning money and not focused enough on the people who love me the most that I also love the most. You don't ever hear someone on their deathbed say, I wish I made more money. You just don't, because you can't take it with you. And so the most cherished thing are the relationships that you have and the time that you had to be able to spend with those people. And then beyond that, it's the freedom of impact. And the freedom of impact is everything that creates the energy and passion and excitement that someone wants to have as they wake up every single day. It's the positive influence that we can have on the world. It can be done through charity work. It can be done through profit work. It can be done through no payment at all, just doing something that you love. But everyone needs that. I had a friend share with me recently that his mentor was really big on people needing three things, the three most important things. Number one is something that they can be passionately excited about the moment they wake up and get out of bed. Number two is someone that they can love deeply and live and do life with. And number three is something to look forward to in the future. And I think of that as a compelling vision of the future.
Fantastic. And you talk about, in this particular commandment, the freedom from and the freedom to exercise. What does that mean?
So the freedom from portion of it is gaining freedom from whatever it is that is enslaving you. So there's something for most people, a lot of people are a slave to the money they make. They're a slave to the business that they work for. They're a slave to the business that they have built. For a lot of people, they've maybe moved on from working for someone else to have their own business, but maybe don't even realize that the business actually owns them and that they still are a slave in some capacity. And, the freedom from really is that. It's to get away. It's to buy your time. And then the freedom to is to be able to do what it is that you want to do and to live life on your terms and to figure out who you want to do life with and how you want that life to look.
Let's talk a little bit about this section where you say that each investment must truly represent passive income in which your earnings don't depend on the time you spend working. It sounds to me like that's one of the most foundational, I would almost say like principles of the lifestyle investor.
Yeah, so that one is really important to me because the goal is not to create another job. Most people have a job that's already pretty demanding on their time. And if it's not a job, maybe it's children, maybe it's something that has a strong demand on their time. But to have an asset that produces income that is independent of your time is a very powerful vehicle, and it's a very empowering opportunity. And I will say that there are different levels and tiers. I should probably clarify that at some points in life, so for me early on, I was okay exchanging time for dollars. And I did that in the form of a job. I did that in the form of starting a business, starting a couple different businesses. And then for me, I was able to invest time into passive income. But at first, I had to put time in it, but it was less time than I was putting in earned income. So it was still an upgrade for me. Now, I put in the time so I could learn how to do it, and I put in the time so I could earn a better return. So later in life, I was in a situation where I didn't feel like I needed to exchange time for money, and I would just rather have an asset do it. Now, I probably make a lesser return than if I were spending my own time doing it, but I'm totally comfortable with that because I don't have to spend any time. It is truly a time-free investment that funnels cash flow every month, and that, to me, is a great win.
Yeah, you give some great examples coming up about Orange Theory and how time and money went into that filter. You also talk about mobile homes and how you can pay for a management property. I love that you're giving in this book so many options. You don't say it's just one way and everyone fits into this mold. You're really giving these commandments, and there's fluidity with how it fits each listener. Is that intentional?
Yeah, because there's a lot of different ways to do it. There's no one way or one right way. And the methodology that I have, even around my 10 commandments and investing in cash flowing investments and building that cash flow up, it doesn't mean that investing in other ways are bad. I just would choose a different order of doing them. So I like to have passive income, and then I like to diversify that passive income across multiple assets or multiple asset classes just for de-risking the passive income. And then from there, once my expenses are covered, then I feel a lot more comfortable investing in some of what I consider riskier investments, such as equity investments or angel investments. This is when I would invest in the stock market, because that to me is a lot riskier than buying an asset that produces cash flow. So it's not that these are bad investments. I just think that there's a time and a place for each investment. And I want to do it in a way that supports me and my family the best way. Commandment 2, reduce the risk. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Warren Buffett. What if you could go to Las Vegas, gamble, and lose a game of poker, roulette, or blackjack, but still walk away with positive cash flow? Does that sound impossible? When you invest and know how to negotiate using the strategy stack to reduce risk, you'll discover opportunities to win in a way that you come out cash flow positive, even if part of your investment fails. Warren Buffett's first 2 rules of investing sum up this chapter nicely. The hard part is implementing those rules and preventing yourself from violating them when you get emotionally involved in a deal and let fear or becoming overwhelmed get in the way of discipline, experience, and wisdom. If you lose money, you have to work twice as hard to replace it. Plus, you have the lost opportunity cost of what that money could have been earning. One goal of reducing risk is to have your principal investment and any potential downside associated with it protected from loss. Another goal of reducing risk is to have so much leverage that whomever you're investing in or lending to realizes that they have so much more to lose than gain if they default. And so they will do whatever it takes to honor your agreement. In other words, if you can lend a company $500,000, but you collateralize the loan with assets that are worth $10 million, then the owners will do whatever it takes to pay you back because they don't want to lose a $10 million asset over just a $500,000 loan. One of the facts about investing is that there's no such thing as a sure thing. Eventually, you're going to lose money. However, when you apply the principles and commandments of being a lifestyle investor and understand how to stack the strategies, you'll dramatically decrease risk and your downside. Let's begin with a list of strategies to reduce risk. Here are a handful of ways to reduce risk. 1. Educate yourself on investing and in the particular investments you decide to do. 2. Collateralize the loan, ideally with at least 2 to 3 times the loan amount just to play it safe. 3. Be creative with all the different ways you can collateralize loans, such as using real estate, accounts receivable, inventory, equipment, intellectual property, stock, and notes receivable. 4. Have strong legal documents that protect your risk and secure the terms. 5. Make sure you have a senior secured position or first lien position on the asset. This means you are first in line to get paid back and are in the safest position in an investment. 6. Improve proposed terms to be favorable to you and reduce some risk right out of the gate. 7. Find a way to get points or fees paid to you up front. 8. If lending, limit how much of the loan someone has access to by using performance metrics that need to be hit first in order to release portions of the total loan amount. 9. Put covenants in place that act as a guardrail to prevent deterioration of value. If the business starts to slip, you can change the terms of the agreement for immediate repayment of your loan. 10. Use a personal guarantee as a way to secure an investment in which, if the other party defaults, you have the right to go after other assets they have to get your investment back. 11. Try stock pledges as another great way to secure an investment and increase the likelihood the contract terms are honored. 12. Add a default interest rate provision into your contract so if someone defaults, there is an automatic increase to the interest rate. 13. If you are the borrower rather than the lender, use non-recourse debt so in the event of a default, no one can come after any of your assets besides taking back the asset associated with the default. 14. Accelerate the distribution schedule as a way to increase the speed with which an investment or loan is paid back in order to get your money out of an investment in a much quicker time frame. Lifestyle Investor Mastermind Preview: Due Diligence. Conducting proper due diligence is essential to reduce risk and enhance returns. Inside the Lifestyle Investor Mastermind, members gain exclusive access to experts that I'm constantly meeting in my network. Our mastermind calls are an opportunity for all of us to learn together from these world-class specialists. In January 2022, the leadership team from Venturi Wealth presented the art and science of due diligence. Chris Schelling specializes in vetting alternative investments in private equity, and I was thrilled to soak up his 6 P's formula alongside my mastermind members. Here's a preview of his system. Performance. Performance begins and ends the evaluation. While past results don't guarantee future performance, they provide perspective on outcomes, skill, and total return. Look at alpha generation as a sign of investment acumen. Consider risk-adjusted returns like the Sharpe ratio, and remember, total return is the ultimate goal. People. Focus on the team behind the investment. Assess trustworthiness by looking for integrity, ethics, and transparency. Review competence via track records, education, and relevant expertise. Ensure alignment of interests through co-investment, compensation incentives, and other skin in the game. Analyze stability by learning how long they've worked together and their dynamics. And consider diversity of perspectives and backgrounds. Philosophy. Philosophy reveals foundational principles and investment beliefs. Look for consistency versus drastic changes over time. Understand differentiation, what makes their philosophy unique. Assess believability. Is it grounded in reason? And ensure philosophy aligns tightly with process. Process. Process demonstrates repeatability, scalability, adherence to philosophy, and risk controls. Walk through a deal life cycle to understand their approach. Examine how investment decisions are made. Is there a checklist? Review risk management protocols. Portfolio. Portfolio offers perspective on concentrations, liquidity, risk profile, and fit with philosophy and process. Check sector exposures, ease of liquidating holdings, and the alignment of actual risk versus stated risk appetite. And finally, price. Price is at the center of it all. The P's provide a principle-based framework to conduct thorough due diligence. This was a small taste of the exclusive training Lifestyle Investor Mastermind members receive to expand their knowledge and reduce risk. Be sure to visit lifestyleinvestor.com/gift for a video excerpt from this masterclass. As I share in Commandment 8, Cut Out the Fat, one of the biggest ways I reduce risk in my investments is by investing in relationships that provide me access to specialized expertise and wisdom that is nearly impossible to find or replicate on my own. If you want to take your investing knowledge and results to the next level, the first step is to book a free strategy session with my team at lifestyleinvestor.com/strategy to explore which of our courses or masterminds are right for you. Employ different risk strategies. You could look at a deal and say the default terms are what they are. Someone has come to you with terms, and it's your choice to invest in it or not. Sure, some deals are that way, but most deals are not. It's a myth that investing, in general, is really risky. You only hope that it works out, or you decide it's so risky that you don't even want to get in the game. Don't automatically accept the terms. Be creative to reduce your risk. Good investments are not that difficult to negotiate once you're educated. You can't just hope for the best results. You need to do enough due diligence to feel comfortable with most investments out there, and then you need to structure your investments properly. I liked my first mobile home park deal because it was a seller-financed situation. It was a non-recourse loan, which means if I defaulted in any way, the seller didn't have the right to come after my other assets. He could get his property back, and he'd get to keep the down payment and the interest. For me, I knew if everything went wrong and I totally screwed up the deal, I wouldn't risk the rest of my assets. I like seller finance deals because of this non-recourse aspect, but I also like them because the process is much cleaner and quicker. You don't have to go through all the underwriting and jump through all the hoops that you would with a bank. When you can establish good relationships and have good credit, a bank can be helpful, but I try to avoid them if I can. If a seller will do a 10-year note at 5% interest, amortized at 20 or 25 years, that is a very attractive deal. I don't have a lot of skin in the game, so to me, that's a true win-win. I discuss non-recourse loans, seller finance, and other lending options in much more detail in Commandment 8, Cut Out the Fat. I'm going to show you a couple of real-life examples and deconstruct how they came together and how each investment works. I want to give you an idea of what a super low-risk investment looks like when you apply my principles, commandments, risk reduction, and the strategy stack all together. I mentioned the term strategy stack at the beginning of this chapter, which is a way of combining multiple non-obvious approaches to earn an even greater return with low risk. The example that follows might be a bit technical for you, but one of my objectives in this chapter is to show you in detail what a typical low-risk deal might look like. You'll learn how to use a system that consistently produces measurable results as long as you keep your emotions out of the way, stick to the fundamentals, and find creative ways to stack these strategies. My intent in sharing this is for you to start recognizing how you can examine any deal, no matter how simple or complex, in such a way that you can always stack the odds in your favor. That means you can walk into a situation that might look like a gamble, but always walk away with money in your pocket. Let's discuss an example of a cannabis, hemp, and CBD investment that I made. One of my favorite investments right now is a senior secured credit fund that specializes in lending in the cannabis, hemp, and CBD industries. Since banks can't lend in these industries, this fund produces some incredibly high returns for its investors with monthly distributions because the fund can charge high interest rates to these companies borrowing the capital. Additionally, the fund can collateralize each loan many times over because the people who own these companies have no other options for getting capital, and they would rather pay a high interest rate with collateral than give up equity in their company. They'll do what they need to do to scale their company. It presents a perfect storm for an investor in a unique season of abnormally high returns in a high-growth sector. Eventually, interest rates will drop back down to normal levels once these industries are federally legal and not just legal in certain states. Some of the states that have legalized cannabis restrict the number of licenses they'll give out, so these licenses become more valuable. You might have one company that has a $3 to $5 million loan, but they've pledged their license as collateral. That single license will sell anywhere from $10 million to $60 million. Owners of these companies will often personally guarantee these loans and even set up a third-party escrow account where they pledge stock to automatically convey if they default on their loan. So there's very little risk of a default, which is good for the investors. Let me explain my mindset on this particular investment. The emerging cannabis, hemp, and CBD industries are ones I've been studying for a while, and I concluded that I wanted some sort of exposure to this market as long as it was legal and ethical. Because it's a relatively new space, there are still unsophisticated investors and deals available that are ideal for my strategies. Also, these industries are uncorrelated to the overall economy, which means it is expected to grow for many more years to come, even if the overall macroeconomic conditions enter into a recession. Having uncorrelated investments, meaning investments that are not tied to the movement of the stock market, in your portfolio is important so that you have defensive positions that do well even if the stock market or your other investments go down. This particular investment came from my network, and the co-founders of the business are friends with my attorney. My law firm did all their subscription agreements and vetted them, so I felt very comfortable with this investment option and my strategy. Plus, the industry as a whole has been seeing growth in the 25% plus range quarter after quarter, so the returns look to be exponential. Additionally, the investment was through a fund which helped mitigate some of the risk. Here is the structure of this deal. 1. 8% preferred return, though the actual returns have been paying at 15%. 2. Distributions paid monthly. 3. Total projected IRR, or internal rate of return, is between 20 and 30%. 4. 2-year hold on capital, but you can take money out in the event of an emergency with notice. 5. The ability to participate in equity and warrants negotiated in certain deals. 6. The opportunity to co-invest on many deals outside of the fund to gain more exposure to certain companies with even better terms. 7. The ability to go public for a 3 to 4 times multiple above and beyond the projected returns. Let's look at the filter I used for this investment. This investment was offering one of the highest overall risk-adjusted returns I'd seen for a senior secured credit fund, meaning the investors were in the most secure position in the investment and the first in line to be repaid if anything ever went wrong, and yet still earn a high return. Plus, each loan was collateralized, often by 5 to 10 times or more the loan value. Additionally, this investment has a 2-year lockup on the principal investment, and after that 2-year time frame, the principal can be returned or remain in the fund, Most investment opportunities similar to this one have a much longer lockup period than 2 years. Because it's not federally legal, banks aren't allowed to lend in this space, which has created a very high return for the companies that do decide to lend in this market. Also, these companies are highly vetted. A company isn't even considered unless they're working with one of the 600 regional and local banks in the U.S. that allow cannabis, hemp, or CBD companies to have a bank deposit account with them to verify their financials. Because these companies are highly vetted and extremely successful, they have large amounts of collateral to pledge, such as land, real estate, equipment, other assets, accounts receivable, stock of membership interests, and even the cannabis license itself. Also, many of the short-term loans come with equity and other warrants to improve the deal. There is a lot of downside protection in this investment, plus strong monthly cash flow and the ability to have big upside returns. Let's next talk about negotiation on this deal. I negotiated a sidecar agreement with preferred terms for anyone in my Lions Network and Lifestyle Investor Mastermind that invested. A sidecar is effectively a bonus addendum or an additional agreement with special terms for an investor or group. I discuss sidecar agreements in much more detail in Commandment 6, Find an Income Amplifier. I also negotiated the first right of refusal, the ability to be the first person the fund managers ask to co-invest on many deals they do outside the fund. Let's discuss this deal in review. The Warren Buffett quote that opens this chapter sums up the concept of reduce the risk perfectly. Don't lose money. If you can set up an investment with a strategy stack, you can generally negotiate great terms and reduce the risk at the same time, such as earning high interest payments with regular distributions, having a balloon payment at the end of a short note term, find creative ways to have the borrower personally guarantee the deal, and find a way to get paid as a vendor or advisor too, among various other strategies. Many of my students and clients have successfully shifted their investing mindset from being equity investors previously to becoming cash flow investors. An equity investor is someone who risks capital for an eventual payout, but most of the time, the deals are basically zero interest loans for an indefinite period of time, which is incredibly risky. Cash flow investing is better overall. This next example is a perfect blueprint for reducing risk that you can use as a model in your next negotiation. It is a super low risk investment in which you can apply my principles, commandments, risk reduction, and the strategy stack all together. Cannabis, hemp, and CBD investment 2024 deal update. 2024 update summary. This is a private credit cannabis deal that's averaging 15% or greater in cash flow with projected 30% or greater IRR once funds are fully realized. This leverages valuable licenses and assets for security and collateral. It's among the largest investment allocations, and it's a compelling passive income source. I first got into the cannabis, hemp, and CBD space a few years back when a friend introduced me to an investment group. This group was run by some really sharp investors who had both a private credit fund for cannabis companies as well as an equity fund. Given that cannabis was still in the early growth stages and companies couldn't access traditional financing, the opportunity for private credit lending at attractive interest rates was enormous. The equity side also seemed promising if we could get in early with the right companies. So I decided to invest in both their credit and equity funds, which gave me exposure across multiple companies in the space. Over the last few years, private credit investments have been knocking it out of the park. Despite the challenges in the public markets for cannabis stocks, these private debt deals have consistently delivered over 15% in annual cash flow back to me and other investors. Many of the companies we lent to are profitable, have valuable licenses and other assets, and have continued to thrive. We've even had some single off-balance sheet direct lending deals that have produced over 30% returns in less than 12 months. While the upside of the equity deals is still unknown, if this performance keeps up, I expect that we could see total internal rates of return in the 30% plus range once the funds are fully realized. For a relatively new high-growth sector that faced regulatory uncertainty, the private lending side has been a home run. Given the outsized returns and the fact that these investments comprise a significant portion of my overall portfolio, cannabis remains one of the most attractive areas I'm focused on. I expect it to continue playing a prominent role in my holdings given how well it has performed. The private lending cannabis deals exemplify lifestyle-first investing. The hands-off debt structure requires no time from me operationally. I simply collect my 15% plus annual cash flow returns quarterly, and I'm projected to see a total IRR around 30% plus over time. This passive income gets generated predictably without ongoing active involvement. Here are some key insights. Private credit cannabis deals have consistently delivered 15% or greater cash flow. Private lending proved more resilient than public equity cannabis investing. Valuable licenses provided security on debt investments. Profitable companies and valuable licenses provided security on debt investments. Expected 30% plus overall IRR once funds fully realized, and remains a top investment focus given strong returns. In this next example, I had an opportunity to invest in American Airlines' former headquarters in Dallas, Texas, through a commercial real estate company in Austin that I've done several investments with. The former headquarters is a premium-grade, high-end campus comprised of 3 buildings totaling 1,388,727 square feet, along with 2 structured parking garages. Its estimated construction cost in the late 1980s of almost $490 million can be contrasted with today's replacement value of over $400 million. American Airlines outgrew these headquarters and elected to build a new 2 million square foot campus. The sale included a leaseback of 2 of the 3 buildings for 6 months while construction finished on their new campus, reducing the investor's risk of holding costs for the duration. While the building was fully marketed, there were a few value-add office operators willing to take on the heavy lift associated with restabilizing large corporate campuses. The general partner was able to negotiate a discounted purchase price of $57 per square foot, which is just 12% of replacement cost. The low basis afforded the general partner the ability to offer compelling lease terms compared to market rates. During due diligence prior to closing, the asset was soft marketed to find premier tenants that are some of the largest and most well-respected companies in the U.S. Since very few large commercial block spaces were available in the entire Dallas-Fort Worth market for tenants seeking space in excess of 200,000 square feet, the deal was even more attractive. The site had not just 1, but 3 buildings that could meet those prospective tenant needs. This pre-closing strategy allowed the operator to sign a lease within 6 months of closing for 1 of the 3 buildings, reducing the lease-up risk on the remaining 2 buildings. Let me discuss my mindset on this particular example. I had the opportunity to buy a high-end Class A campus of 3 buildings in one of the strongest markets in the U.S. for just $72,950,000, which was an extremely discounted rate. These buildings are what Fortune 100 companies, government agencies, and high-level security clearance defense contractors use as their headquarters. The opportunity was unique to participating investors because of the market timing and closing in April during the 2020 stay-at-home orders. Several other factors helped me acquire this asset quickly and at a great price. Here's the structure of the deal. Number 1, a 10% preferred return. Number 2, return of capital projected to be 2 years or less. 3, the projected return was 3.5 to 4.5 times the initial investment. 4, this investment projected a 4 to 5 year time frame. However, I was confident with the demand and pricing that it would be much shorter. 5, a $250,000 investment was estimated to return $875,000 to $1,125,000 in just 4 to 5 years. Here's the filter I used for this particular investment. This property was a top quality asset in one of the best markets in the U.S. at a great price and with plenty of opportunity to add value and increase profit. The buildings had qualities that made them attractive to tenants that require security clearance, which increased lease terms and real estate values. Big-name tenants were found with government backing before the deal was even completed. The general partner had a great reputation and over 600 individual investors that had never lost money in over 28 years of investing in real estate with this company. The partner also has a historical internal rate of return, or IRR, of 32% with an average hold time of just over 4 years, with investor principal typically being paid back in 1 to 2 years. Here's the negotiation that was done on this deal. During due diligence prior to closing, the general partner immediately began negotiating with two of the largest government defense manufacturers and contractors, one of the largest hospital groups and healthcare systems with dozens of offices, one Silicon Valley's largest companies, and one of the largest e-commerce companies in the world to rent the available space. This move reduced my risk even more. In addition, the general partner offered all new investors a put option that allowed me and all of the other investors I brought into the deal to get back all the amount invested within 30 days at any time for any reason with no expiration of the put option for the duration of the investment. The founder and president of the commercial real estate company personally guaranteed the investor put option with his own assets, so even if this investment failed, he'd still own the liability and pay investors with his own money. I was also able to verify that he had the liquid net worth to be able to cover 100% of the put options if all investors redeem their put options at the same time. Let's look at this deal in review. If this were an ordinary deal with an ordinary investment group, the group would probably collect some money, pay some interest, and get their money back in 5 to 10 years. For this deal, however, the general partner structured it so investors would get their initial investment back in 1 to 2 years and have a 400% plus return on their investment. Also, investors had the put option in place to get money back at any time if there was anything about this deal or timeline that they didn't like. What many people forget is that there are thousands of ways to negotiate a deal so you don't violate Warren Buffett's rule number 1 and rule number 2. When you follow my principles and commandments and add as many elements in the strategy stack as possible, you are positioned well not to lose money. American Airlines Headquarters 2024 Deal Update. 2024 Update Summary. We acquired a Class A building at a deep discount to replacement cost. We experienced 2+ years of COVID delays, but fundamentals are still strong. We are in the final stages of major new leases right now. Projects are expected to stabilize by 2024, and strong returns are expected despite the extended timeline. A few years back, I invested in 3 massive headquarters buildings in Dallas, Texas. American Airlines had built these iconic headquarters, but then outgrew them and moved into a giant new modern campus. These buildings were architectural masterpieces, Class A trophies spanning over 1.3 million square feet in total. Since they were no longer of any use to the company that built them, it gave us the chance to scoop them up for a fraction of the replacement value, around $57 per square foot. The opportunity was incredible given the building's premier quality and location in the thriving Dallas market. The strategy was to lease to new corporate tenants wanting amenitized space at affordable rates. The plan was to have the buildings re-tenanted within 3 years or so, but no one could have predicted what came next, the COVID-19 pandemic. Everyone was shocked when COVID caused a 2+ year delay. Companies went remote, and commercial office demand plummeted. Despite headwinds, momentum resumed with major leases to marquee tenants. The timeline extended, but projected stabilization by 2024 bodes well for returns. Recently, the delays have started paying off. A major lease was executed with Bell Helicopter for several floors of one building. Another building is in final negotiations with a huge defense contractor. Despite COVID, tremendous momentum has begun again. While the timeline extended, the fundamentals remain strong. Given the extremely attractive basis that we acquired the buildings for, I'm confident this project will deliver excellent returns to all investors. The buildings are projected to stabilize by late 2024, and we expect to exit within a few years after that. The risk on this deal was reduced substantially by acquiring iconic Class A buildings at a mere fraction of replacement cost. The world-class assets in a thriving market scooped up for pennies on the dollar significantly lowered chances of issues arising from unexpected COVID delays. Even external shocks couldn't undermine such an attractively priced portfolio in an incredibly resilient area. Here are some key insights. Unforeseen external events like COVID do happen, which can significantly delay timelines. Quality assets in strong markets will attract tenants eventually. Maintaining conviction amid uncertainty is key. And the low basis acquired gives flexibility to deliver returns over a longer hold period.
Commandment number 2, reduce the risk. Justin, I know that sounds simple, and yet it sounds like a lot of people maybe have missed that. Why would someone not reduce the risk?
Well, I think a lot of people don't think about that, and they're enticed by a very high return. I think there's this aspect or this, sexiness, if you will, to these really big returns. And some people, a lot of people get hung up on what they want to happen without considering what could happen. And so that really is something to take into account. My goal is not to get the biggest return on my money. My goal is to not lose money.
Oh, that's good. And you use the quote by Warren Buffett at the beginning of this chapter. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Love that. Entrepreneur Magazine has written about you as the new Warren Buffett. I know that's a pretty big title, pretty big name, but he seems like someone that you've studied. I mean, you quote him. How important do you think this rule, reducing risk, was for Warren Buffett's career?
Yeah, the article that was written was very flattering, had a very flattering title, there's no doubt. And I'm pleased to be in any sentence with Warren Buffett because I think he is literally one of the greatest investors, if not the single greatest investor to ever live. And this is one of his biggest things. If you look at all the things that Warren has invested in, if you look at his track record of not losing money, if you look at his outlook on how he structures his deals and the way that he utilizes cash, I mean, the guy does such a great job at protecting the downside and de-risking deals. So again, if you look at someone like Warren Buffett and say, hey, I'd like to emulate what he does, it's really easy to see that he hasn't necessarily had a whole bunch of home runs. He just hasn't lost much money. So that compounding over time is just exceptional.
You know, I've read Warren's book about him, that audiobook, 40 Hours, but I do see a theme between what he says and what you say. And we're going to get into that later with the commandments about invisible deals. But it almost seems like these commandments are unknown. I mean, if everybody was doing it, the whole world would look very differently. Talk about the first mobile home park deal and how that fits in this particular commandment.
Yeah, the first mobile home park that I bought was definitely, it's one of those things where I've had friends for anything I've done say, this is a horrible idea. You know, you don't want to do this. And a lot of times I think people are swayed by what their friends and what their peer group says. For me, I remember thinking specifically, well, if most people aren't doing this and most people aren't doing well, maybe I should do the thing that I know is working for people that are investing in this asset class. And I knew some people that were doing really well. One of my really good friends invested in this and went to this boot camp and recommended that I do the same. And so I did. I learned about it. And the more education I had, it's funny, people will say, oh, this is really risky. Well, when you have an education on something, it's actually not risky. You learn what you should and shouldn't do. You learn criteria on when to buy and when not to buy. So you are already de-risking it. So buying my, first mobile home park, it was nerve-wracking. It was really, my first big purchase that I ever made, at least on an investment standpoint, outside of my own home, outside of just even a single family home rental. This one was big. So it took a lot of my time. I wanted to make sure I got it right. And thank goodness I did do it right. This was a great return for me. It was one of the best investments that I've ever made. And it happened to be my first major investment.
And some people use statements like that really to deflect. In other words, ooh, that's risky. Or, they use these cliches and really it's just ignorance. You chose to be educated and get the information that gave you the confidence to make this purchase. I know we chatted recently and you said that mobile homes are actually one of the hottest new areas. And why is that? Why is something that maybe people thought of years ago as, why would you do that? And now it's become one of the hottest markets.
Well, I think it was kind of a black eye in at least Wall Street's perspective. And when you have an asset class that no one wants to invest in, I think people consider it risky. Now it's funny because Wall Street's all over it. You're getting you're selling at your highest cap rates, which is really good in real estate. That means there's an opportunity to make more money. And you've got your private equity firms that are buying these up like crazy. And so there is just so much activity. Now, it's still the least consolidated asset class in real estate. So there's a lot of opportunity there. But yeah, I mean, I think that the rule of, I guess, don't do what most people do makes a lot of sense even here.
Justin, I couldn't agree more. I've heard it said that when everyone is zigging, you should zag. And these commandments are the differentiation because not many people are practicing them.
And one other thing that I'd like to point out on de-risking a deal, mobile home parks as an asset class are the least defaulted asset class if you talk to banks. So they may not sound the most exciting or enticing, but from a financial standpoint, they're one of the most sound and secure. So you can get really good deal terms on them, especially for banks that are familiar with working with them. So that's one great way to de-risk a deal because, number one, you get good terms on buying something with a low down payment. Number two, oftentimes there's seller finance involved, which we're going to talk about, and that de-risks it big time. And then number three, it's an asset that just holds its value. So if anything were to go wrong, you could still sell it and make money from that asset because it appreciates greatly and it appreciates in direct relationship to the net operating income or overall profit of the asset.
It's a great example of the second commandment, reduce the risk.
Commandment 3, find invisible deals. The sky is filled with stars, invisible by day. Henry Wadsworth Longfellow. It seems like everyone is looking for a sure thing in an investment, a leg up, a way to find free money, usually through a stock tip or an insider tip that's hopefully legal. But it's absolutely the wrong way to think when you're looking for an invisible deal. The best way to find an invisible deal instead is to find a distressed business that's unprofitable because it hasn't been able to get rid of dead weight, baggage, or a part of the business that's obsolete. That invisible deal is only invisible to insiders who have been looking at the business the same way or the wrong way for too long. I recently had an opportunity in my investor network to buy Dress Barn, an extremely recognizable, publicly traded retail brand business that had been suffering for years. The big opportunity was a result of their flourishing online presence, which had impressive sales. They had warehousing, manufacturing, packaging, marketing, and stable teams, but the business was floundering significantly due to a brick-and-mortar retail dragging down their margins and profits. Dress Barn's parent company, Ascena Retail Group, is the largest specialty retailer for women and girls in the U.S. Even though they own several well-known retail brands, they were focused on physical retail presence and weren't innovating with the times and growing their e-commerce presence. At the time of the deal, they were on the brink of bankruptcy and eventually did file Chapter 11 bankruptcy protection. Through my investor network, I negotiated an amazing invisible deal that even industry insiders didn't know was happening until the deal was done. It consisted of breaking apart the online from the brick-and-mortar retail and acquiring the brand. I was able to negotiate amazing terms for myself and a group of other investors I helped assemble. The final deal allowed us to take over the brand and all intellectual property, decide how much inventory we wanted to buy at a discount, establish new relationships for inventory, continue relationships with the best suppliers, get rid of all liabilities and lease commitments, and access the entire customer database, nearly 8 million customers, and all the buying behavior and customer data. The prior management had emotional attachments to the old business and way of doing things that had been done for so long that they'd become myopic. Their loyalties and habits prevented them from cutting back and seeing the opportunity. The simple but invisible deal was quite easy to manage. We got rid of the dead weight and focused on new, profitable money. One important fact that anyone going through a downturn needs to understand is that it's better to be small and highly profitable than huge and unprofitable. We investors knew it. We hired 30 of their best employees of the 9,000 they had working for them at the time. The new ownership group was filled with really smart, experienced online marketers who knew how to take the online brand and multiply traffic and income through leverage, advice, and predictable growth. And because I strategically chose my investors and partners with specialized knowledge, we hold an added unfair advantage that we bring to every deal. As an outside investor, one thing I've learned that drives me is to make sure I have a significant amount of consistent deal flow. By seeing hundreds or even thousands of deals a year, I'm able to scrape the cream off the top. And because I've built a substantial network of investors and private clients who want access to high-quality, low-risk deals, together we have a secret, unfair advantage in practically every market and industry. Let's discuss the aggregated benefits. I present dozens of deals inside my Lions network that are vetted, and compared against hundreds of other potential opportunities, we only invest in the ones with the lowest risk and the highest rate of return, with an added focus of a return of the principal investment in the shortest period of time. Here are the aggregated benefits to the investors that we are able to negotiate in these deals. 1. Monthly cash flow. With an investment as low as $50,000, each investor receives a monthly cash flow of 20% interest, which is $833 per month on a $50,000 investment. 2. A kicker. Investors receive a cash bonus of up to 20% of their investment, varying based on the size of their investment, paid at the end of the note term. 3. Principal. At the end of a 1-year, 2-year, or 3-year note term, all investors receive 100% of their investment capital back. 4. Free equity. In this case, the equity kicker is called a kicker because it's free. Most of the time, investments are in straight equity, so each $50,000 equals a certain amount of equity. In this case, principal is repaid plus equity of up to 3% per $1 million or 0.3% per $100,000 is gained, depending on the particular deal. So an investor who puts in $250,000 receives 0.75% equity for free. Let me break this deal down for you so you can see what would happen over the course of 2 years if you were one of the investors. To make the math easy, let's say you invested $1 million into the deal, even though the minimum investment was $50,000. Each month, you'd receive a dividend check of $16,666.67, which will total $200,000 annually. That's $400,000 over a period of 2 years. At the end of 2 years, your money is entirely out of the deal. There's no more risk, but you still receive an additional 20% cash bonus, or $200,000. You'll also receive equity in the form of founders' shares representing 3% of the business, without paying an extra penny. Assuming the business would be acquired for $100 million 5 years from now, that equity represents $3 million in additional profit, plus 3% of the dividends every year until the business is sold if it chooses to distribute rather than reinvest the profit for growth to create a larger exit price. Additionally, if something would go wrong with the deal, you've negotiated the first lien on the intellectual property as collateral, which is a strong position, especially since the brand was bought for pennies on the dollar. The brand and intellectual property would be really easy to sell and at least get what you paid for the brand, if not considerably more. Also, being in a debt position rather than an equity position means you'd get paid back first before anyone else, so your risk is much lower than if you'd invested directly into equity. Making $600,000 on $1 million investment over a period of 2 years with the opportunity to potentially make an additional $3 million with no added risk, since it's all house money at this point because you have over 100% of your money back, seems like a pretty good deal to me. And remember, this is a retail brand that most people would just think is on its way to the graveyard. But in reality, it's scaling rapidly through pure e-commerce versus the business being hamstrung by its existing brick and mortar operations. That's what I call an invisible deal. I love doing what I do. At any given time, I have 10 to 30 deals in my investor network ecosystem where we vet these deals together after I have done a preliminary round of vetting myself. When I'm working with my lions, I get to go out and find amazing deals like this one, negotiate incredibly lucrative terms, and then bring them into opportunities that are much better than the deals most people invest in that typically only align with one of my commandments for investing. As the mastermind has grown, I'm now getting access to deals members are bringing to the table. Truly invisible deals. 2 guiding principles of invisible deals. Here are 2 guiding principles that I look for in finding invisible deals. Number 1, pay attention to emerging markets or unseen opportunities outside the mainstream. This principle can be applied to new technological innovations or companies currently in a reinvention phase. I also like new technology that is superior to what is currently the status quo and will disrupt and transform the way an industry operates moving forward. Specifically, in real estate, I like to gain access to off-market opportunities from the many relationships I already have in the space. For example, the rise of single-family homes or single-family home rentals wasn't even an asset class a little over a decade ago. Hearing about it and being on the cutting edge of investing in that asset class has paid huge returns for investments I've made. Number 2, pay attention to what's going on with trends in the economy, what's strong and what's not. Be up to date on shifts taking place, like e-commerce, for example, which has become one of the leading industries in the world. Also, industrial distribution centers are going to be more in demand because businesses need more space to store their inventory and get it closer to the customer. The most expensive cost of getting their product to the customers is that last mile. If you pay attention to what's going on in the world, you can identify many more new trends emerging such as these. For example, in 2022, the U.S. government passed the CHIPS and Science Act into law, which includes $52 billion to incentivize semiconductor manufacturing. These chips power everything from smartphones to cars, computers, and artificial intelligence systems. Companies like Intel, Micron, and Taiwan Semiconductor Manufacturing Company have all announced plans to build new semiconductor factories. I'll share more about my approach to investing in artificial intelligence at the end of this chapter. Here are some invisible deal categories. Here's a list of several categories of invisible deals I've seen that investors are likely to participate in because these investments resonate with them. I frequently get involved in investments like these through syndicated deals, or I create investment opportunities and assemble investor groups from my Lifestyle Investor Mastermind and Lions Network. Here are some invisible deals that smart investors seek. 1. Exclusivity deals. These are closed deals that you must personally be recommended into. 2. Pay-to-play deals. These are deals you only have access to because of previous investments or you have paid some sort of fee to allow you to take part. 3. Off-market deals. These are investments that have not been advertised publicly for sale, meaning there's often no competition or much less competition to buy these assets. 4. Institutional deals. These investments are typically reserved for institutional investors, but with the right connections, can be made available to an individual investor or group. 5. Unconventional investment opportunities. These are terms, structures, and industries that are uncommon and often overlooked. 6. Government incentives, which include government contracts with preferential terms and grants that act as extra investment dollars that aren't added to the capitalization table, so investors aren't diluted. 7. Emerging markets, markets that are on an uptick that may not be common knowledge. 8. New frontiers, new ideas or industries that will likely become mainstream in the future. 9. Trend-focused opportunities, strong investments based on the current economic climate and market trends. 10. Disruptive opportunities, companies or industries that challenge the status quo and create more value than what's currently available. 11. Deal flow networks. These are massive groups of investors who see hundreds or thousands of deals a year. Number 12. Ecosystems. These are smaller groups of sophisticated and experienced investors who love sharing what they've learned and investments they are making. The following is an example of an invisible deal and the application of my principles and commandments to that deal. Stellar is a single-family home maintenance company in the home rental space for large institutional owners such as real estate investment trusts, or REITs, private equity groups, and large property management groups. This company has its own proprietary software which helps differentiate it from everyone else in the industry. Here's my mindset on this particular example. I listen to many podcasts, and one of my favorites is How I Built This. It stimulates my thinking and causes me to think deeply about entrepreneurial endeavors. I also network with a lot of successful business owners who scale businesses quickly and produce strong profits. Additionally, one of my goals is to keep an eye out for emerging markets and consumer trends that might have huge opportunities associated with them. At the time of this deal, the single-family home rental space was one of the fastest-growing markets in real estate, and the demand for reliable maintenance for the largest acquirers of single-family homes was a true need that no company had successfully scaled to meet. The obvious unmet need meant a big opportunity was available to get involved in this industry and at least get a piece of the action, and also, on a larger level, potentially disrupt the way maintenance was being performed at scale. Let me explain the structure of this deal. One of my investments with Stellar was to provide them with a credit line because they couldn't do so themselves. The two partners in this deal are brilliant and hardworking people with a tremendous vision for the future. I didn't have to invest any money directly into this business except to set up a revolving line of credit for them, one that would be repaid each month when the balance was due. I did some advising on this business and helped with hiring, training, developing teams, and creating recruiting protocols, among other things. Plus, I was able to leverage my network to offer connections that would help Stellar scale much quicker. In the early years, I also helped make sure Stellar had the proper insurance in place to protect against anything that could have a negative impact on the company. Here's the filter I used. I liked the risk profile on this investment because my downside risk was minimal and the potential for an exponential return was very strong. The most I could lose was my max line of credit that I had capped at the amount I was comfortable losing. However, if this investment worked out like I thought, the returns would be exponential. I also like investments where I have strong operating partners, and in this case, two very strong operators were in place that I knew had impeccable work ethic. Let me share the negotiation on this deal. The investment was unique because rather than being an equal one-third partner, as the operating partners originally proposed, I negotiated my equity position down to just 20%. I knew I wasn't going to work as hard as my partners, and that level fit my lifestyle investing principles. I wanted to protect my time and make sure this business opportunity didn't have a negative impact on my family, which is always my top priority. I also negotiated monthly distributions based on our equity levels for this business and any other business we invested in. Let me tell you about this deal in review. The two partners were very excited about my proposal to take less equity, and that was a huge benefit because I didn't feel like I had to commit as many hours as they did. I acted primarily as a capital partner at first and then helped build many of the systems they currently have in place. I was then able to step away again indefinitely and trust the company was in good hands. This investment was a home run. The company performed well enough early on that I was able to take distributions that totaled more than my risk exposure of the maximum line of credit I was responsible for to ensure I never lost any money on the deal. It ended up being a multi-million-dollar deal, and the company continues to grow today. Stellar has become an industry leader in the single-family home rental space. The largest Texas venture capital firm, S3 Ventures, based out of Austin, along with Brick and Mortar Ventures, based out of San Francisco, co-led the Series A round with a $10 million investment, giving Stellar a post-money valuation of $43 million. Stellar 2024 deal update. Here's the 2024 update summary. I provided a credit facility to enable a small company to scale. We grew into a large tech-enabled services firm. Multiple funding rounds increased the valuation exponentially. Our proprietary software was a competitive advantage, but being reliant on large clients poses risks. Several years ago, I co-founded a property maintenance company alongside two partners. We saw a major opportunity given the booming rental home market. Though profitable, we couldn't get traditional financing to scale quickly on our own credit, so I provided an initial revolving credit facility. I believed this maintenance company had huge potential given the booming rental home market and the proprietary software that differentiated them from competitors. My partners were extremely hardworking, and I offered strategic advice to help them expand. Since then, this company rebranded and absolutely exploded in growth. They've raised both Series A and Series B venture capital rounds from Tier 1 firms like S3 Ventures and Navigate Ventures. This propelled their valuation to over $90 million and took them from a services business to a technology-enabled company. Their software and data analytics capabilities proved pivotal in driving this transformation. Under the guidance of institutional VC investors, they've professionalized operations and expanded nationally. Their tech emphasis also opened up partnerships with companies they previously just serviced. The speed of their rise has surprised even me. However, growing so fast and being so dependent on large customer contracts puts them at risk if those relationships change. Overall, though, Stellar exemplifies how technology can reshape and revalorize traditional businesses. Stellar exemplifies finding invisible deals. I provided alternative financing to allow a small company with proprietary technology to scale. This enabled them to transition into a large tech-enabled services firm that top VC investors now see tremendous upside in. Here are some key insights. Pivoting into a tech-enabled model led to exponentially higher valuation. Prestigious VC investors provided operational improvements and expertise. Proprietary software strengthened competitive positioning, and risks being overly reliant on a handful of big customer contracts. 2024 update: AI growth investing, maximizing returns in an era of intelligent machines. Over the last decade, I've become convinced that artificial intelligence can revolutionize and reconfigure how businesses operate and pave the path to the creation of trillions of dollars in new wealth. Since The Lifestyle Investor was originally published, AI has exploded onto the scene. The AI market is projected to reach $407 billion by 2027, a significant increase from its estimated $86.9 billion revenue in 2022. This astounding 5-year projection underscores the vast potential of AI over the next decade. Of course, new technology also brings significant uncertainties and risks. Investing in unproven startups carries the danger of betting on the wrong horse, as many AI companies will inevitably fail or run out of cash. That's why I've developed a balanced strategy to gain exposure to AI's growth while mitigating risks in a way that follows my commandments and principles. At the heart of my approach is a clear, deliberate strategy. I invest in both big industry leaders and small, agile newcomers. This strategy is like having one foot in a stable place with established leaders and the other foot ready to adapt and benefit from nimble, innovative startups. It helps me manage risk while maximizing potential rewards at different stages of business growth. I've invested in the biggest 3 AI companies and also in smaller AI startups. This way, I'm ready to benefit from both established giants and innovative newcomers. Some of these smaller startups are likely to be bought by big companies, including ones in my portfolio. For example, I invested early in OpenAI as a leading natural language pioneer, and Anthropic for its human-aligned AI systems. I've also invested in the Canadian AI company Cohere. This gives me exposure as they compete for market share at the top of the food chain. I also back smaller companies like a leading open source company working on creative AI applications and another that is applying AI to data labeling for companies like NVIDIA, Samsung, and the U.S. Army and Air Force. My approach to AI investing isn't just about making big bets on what companies and industries will benefit the most from the technology in the next few years. It's about thoughtfully moving through the implications of AI while being smart about managing my risks as an investor based on the growth cycles of my portfolio businesses. I'll share more about this later as I break down how I think about venture capital investing. It's easy to get distracted from your own investment principles when a technology is in a hype cycle, as AI has been. Did you know that total spending on AI systems was forecasted to reach $97.9 billion in 2023, up from $37.5 billion in 2019? For the 5-year period ending in 2023, the AI sector was predicted to grow at an annualized rate of 28.4%. This highlights the near-term momentum in AI investments, but to me, it also shows the importance of forward-thinking investors who can see beyond this wave and anticipate the inevitable dips, spikes, and corrections. I'm convinced AI represents a step change in innovation that will influence the future of almost everything we do. By carefully selecting investments, I'm positioned to see extraordinary returns. That's the art of spotting outliers early. I spent time researching demographic changes, consumer preferences, and the factors that signal potential trends. Then I analyze if a niche today aligns with mainstream movements ahead. For example, AI exploded as processors advanced exponentially. And as Silicon Valley honed the technology, I identified leaders plus newcomers with differentiation. This balances established giants with next-gen upstarts. Another seismic shift is the giant wealth transfer from baby boomers to millennials, estimated at over $100 trillion. So I examine what millennials value. How do their habits and preferences differ? Companies catering to these changing dynamics will ride an economic wave. From niche to mainstream trends to demographic generational shifts, I concentrate capital where outsized growth should follow. This systematic approach to identifying future outliers, ones that will lead change in new business models, core systems, and everyday processes, is crucial for lifestyle investing. Ways to ride the AI wave. Now that you've learned how I developed a balanced investing approach to capitalize on the rise of AI while mitigating risks, it's time for you to create or optimize yours. Consider these strategic points and use them to craft your own AI investing principles. Number 1, investigate AI's potential. Recognize that AI represents a significant wave of innovation with the power to transform industries and generate vast wealth. Study it so you can discern marketing hype from reality. Number 2, diversify investments. Instead of concentrating on just a few AI startups, diversify your investments. This approach spreads risk and increases the potential for returns. Number 3, big and small. Consider both established industry leaders and agile newcomers. Investing in big companies and smaller startups offers a balanced strategy combining stability and innovation. Number 4, acquisition potential. Promising AI startups may be acquired by larger companies earlier than in other tech sectors as large companies fight for market dominance in an exploding market. Position yourself to benefit from these opportunities. Number 5, focus sectors. Invest in AI subsectors where a region leads globally. In the U.S., areas like natural language processing have strong long-term potential. Number 6, early stage access. Gain access to promising startups by partnering with angel groups and incubator programs, allowing you to invest at an early stage. Number 7, long-term perspective. Aim for a long-term investment horizon, holding AI investments for 5 to 10 years to maximize potential returns and ride the inevitable early corrections and dips. Number 8, U.S. dominance. With the passage of the 2022 CHIPS and Science Act, the U.S. is investing $52 billion to strengthen AI-adjacent sectors like semiconductors and electronics manufacturing. Top AI players like OpenAI and Anthropic are based in the U.S. and will likely benefit from this legislation and the commercial investment it catalyzes. And number 9, risk mitigation. In addition to a well-balanced portfolio approach, keep your eyes open for regulation and legal precedents in the AI space that may affect how companies deploy AI locally and globally. The Wild West innovation environment we're seeing now won't last forever. As always, do your own research, follow your investment principles, and conduct thorough due diligence on each AI investment, no matter how exciting or promising it sounds. This is not the time to outsource your critical thinking. By 2025, the global AI software market is expected to reach $126 billion in revenue.
Commandment number 3, finding invisible deals. This is one of my favorite, Justin, and I had no idea that it was even possible, probably because it's invisible. But you give this amazing case study about Dress Barn in this chapter and how most people, it wasn't even on their radar. Can you give us the backstory?
Yeah, so with Dress Barn, that's a really interesting deal. Just the fact that you can pick up these invisible deals is just, it's so unique and so interesting, and it is not well known. I mean, the only way you're going to get them is having the right relationships with people that have access to them. And so this is an exact situation of that. I just had access to the right people that ended up doing this deal, and it ended up just being a total home run of a deal. Now, I didn't have much time to make the decision. This was a 48-hour decision, and there's a ton of due diligence that I would normally do that I couldn't do. But I took a chance on this because my gut told me that this one made sense. And the reason for, so the interesting part about this one is there has never at this point in time been a retail brand that had closed its stores and then converted fully to online e-commerce sales. So, it wasn't really proven, but in my mind, I knew exactly where things were headed. I know the e-commerce boom that's taking place. I see it on the real estate side with the industrial distribution centers, all these warehouses. You see it just in consumer behavior. So I knew that it made sense. I knew it was the future. And additionally, we bought this asset for so cheap. I'm actually not allowed to even say how much we bought it for, but we bought it so cheap that there was no way we could lose money. We could have turned around and sold it the next day and made money on it. There were offers for this. This was a pre-bankruptcy offer. And so we were negotiating and we were competing against some other groups. And we had other groups that basically offered significantly more, millions more than what we offered, but they went with us because they liked our team and they liked our timeline better. And so we got this unbelievable deal. And then we were able to negotiate incredible terms for the deal, such as 20% interest paid monthly, a 1-year note, a full balloon of those of that initial investment after 1 year. And then on top of that, there was an equity kicker of 3% per $1 million invested. So that means a free 3% per $1 million. You didn't have to pay for that equity. So I will have all my money out of the deal and still have equity. And that to me is a really exciting recipe for success.
What was the history, the rest of the story? In other words, how did the Dress Barn deal do compared to their history?
So Dress Barn has taken off, and the online sales have just gone through the roof. We have grown every single month since we took over the company. And what's exciting is that, in the 60 some odd years that they've been in business, they probably did, e-commerce. They were probably late to the game in e-commerce, and they clearly weren't doing a good job when we bought them last year in their e-commerce strategy. But they were still doing about $105 million a year in e-commerce sales. So that's pretty strong. We have a run rate right now, and we'll probably in somewhere between 1 and 4 months, we will pass that $105 million run rate inside of our first year.
Wow.
And that's the most that they ever did in 20 years of being online, or 15 years, however long they were actually online.
So this was truly an invisible deal. How do people get access to these type of deals? I mean, do they come often? Do you have to be in some kind of like insider thing? How do you get access to these?
So these are hard to get. I mean, you really have to know the right people. You have to have the right relationships, or you have to know someone that gets these types of deals that will let you in. So this is a unique deal because this was one where basically I just reached out to a bunch of my friends, and as investors, we all went in on it and bought it. And so there were not very many people. We were able to take it down for a very small amount, which is cool. A lot of the time, that's the way the deals are. There's not many investors, or maybe it's a big institutional deal. And because you know the right people, maybe you're let in as a single investor and the only single investor, which has happened to me several times. Again, that's just network. That's just who I know. So most people cannot do this. It has to do with relationships, your inner circle, the relationship, the like how you've built your reputation over time as well impacts that relationship.
It's almost like you got to be invited to the party. How can you get into the party? How can you be someone who gets the inside tips here? I mean, if someone, wants to work with you, let's say, Justin, you get access to these invisible deals that other people just don't even see. How can they do that from a practical standpoint?
So I have an investors club that I have people that are part of. I have a mastermind that I run, and then I do private high-level one-on-one coaching with just a select few. I actually only work with 6 people a year in that capacity, where it's one-on-one, and it's one of those type of ways where people can get access. So those would be some of the different opportunities. The mastermind's a very exclusive mastermind, so no one can get in that without interviewing with someone on our team. It's a highly curated, highly vetted group of individuals. And then there is the private client tier, which is even harder to get into. But there's also, free info and content on my website as well.
So you have a podcast. You basically have things for people at all levels. Why do you want to help people at every level and not just the extremely wealthy who already have means?
Well, my goal is to really offer value and impact anywhere. And so it doesn't matter how much someone earns or makes. I've created a program for anyone. So if someone doesn't have any money or much money, that's why I have a podcast and why I have a book. I've got an online course. I've got a class that I do. I've got a master class that I do. And each of these tiers up to, there's more cost involved in each tier up. And so then, it'd move to mastermind and investors club and on from there.
Justin, tell us the name of that website.
You can go to lifestyleinvestor.com.
I once heard it said, Justin, that the more successful you become, the less accessible you are. So basically what you're saying is you're here to help anyone at any level, but as people want more access of your one thing that you have a limited amount of, which is time, the investment goes up. I love the fact that you said a course, because I too am a lifelong learner. I love courses. What are some of the things that people can expect in this course? Is there a guidebook? Do they have the ability to plug in their information?
Yeah, so with the course, we are going to be diving a lot deeper into each of the commandments. There's going to be more formal examples, and a lot more of the strategy is going to come out. I would love to spend all the time in the book doing it. I just feel like the book would be too big. And so I really wanted to give everything someone needs in the book to have a great framework to get started. But the course is like the next level. It's like the book on steroids. And I really want to give people a deep dive into my psychology and mindset, but then also into some of the things that we discuss in here, such as filtering and structuring and negotiation, and then taking real life examples of where maybe a deal started and then where it ended upon final negotiations.
You also talk about the types of invisible deals that smart investors seek. Some of these were listed as invite only or pay to play, emerging markets, new frontier, disruption, exclusivity, trends, massive deal flow, and the ecosystem. Wow, that sounds exciting. Which are some that you find the most excitement around? Which ones in particular?
Well, there are invisible deals because people aren't looking or they don't know to look. There are also invisible deals because there's disruption happening and people don't yet see it. Maybe no one sees it or very few people see it. It's kind of like a trickle effect until, it's more of a fire hose. And so people catch it all along the way. So to me, what I love are off-market opportunities, off-market investments where no one knows that a company's for sale or no one knows that an asset is for sale. And you're able to talk the owner into selling, and no one else knows it happens until it's done. You have no competition driving the price up. You have the ability to make deals. This could be a person that's in an extreme situation where they need to liquidate. Something else is going on in their life. And so you might get terms of a lifetime. So my favorite is just when there's no competition and it's just a conversation. And ideally, even if it's in an emerging market and that person doesn't even know the market is emerging.
Wow. And these are some of the examples that you do with what you call your lions.
Correct. Yeah, without a doubt. This is exactly what we do. And I'm so excited about these deals because there's no other way these lions would get access to them, but it's also fun. There's so much educational opportunity in it. Besides what you can earn on an investment, it's the compound interest or the compounding of the education that produces the real return.
That's fantastic. And to me, it makes sense. I know why you do this, because it also helps you bring more strength to the table. If it's just an investing, it's a great thing. But if you bring your lions with you, is that an example almost of this dress barn, how you were able to gather this small group and really take out a much bigger competition because you were all single-minded?
Yeah, and also it's more fun for me when my friends can come along. That is an absolute blast. We just got word back last night on another investment that we were expecting it to be a 4.4x, which is actually discussed in the book, and I think it's going to end up being a 6x. And on top of that, what's likely to happen is we're going to get our initial principal back within a year or less, when it was originally going to be 2 or 3 years.
Wow.
So everything is very accelerated on this deal. And I have a lot of my closest friends in the world in this deal with me. So to me, it's so fun to see when my friends and when my clients can start living the life that I have been able to build for myself. That is where the real joy that I get comes from. Commandment 4, get the principal back quickly. It isn't sufficient just to want. You've got to ask yourself, what are you going to do to get the things you want? Franklin D. Roosevelt. Imagine if you could buy a house for $500,000, get all of your money back in 2 years, and be able to reinvest that money into another house while still benefiting from the equity from the previous house. Now, imagine continuing that cycle. It would be like compound interest on steroids. What if you could do all of it without the complexities of owning, buying, and selling each of the homes? I've already talked about how much I love real estate, but when you are the owner, a lot of issues arise that you need to deal with. What I'm going to share with you right now is a powerful strategy that'll allow you to have all the benefits without the risk, and all in a short period of time without all the work involved. Let me describe a perfect deal. You invest money into this deal, you get all your money out in less than 2 years, and you retain equity so that when the asset is sold, you make additional money, generate cash flow during the holding period, and have the ability to take tax deductions for an extra kicker or free money. I love free money. How about you? The big challenge a traditional investor has versus a lifestyle investor is the complexities of building and scaling a team. It's easy to get into a circumstance where the cost of a team, all the overhead, and your time can exceed the profit you'll make and the risk you have to take. Quick principal back deals. Let me illustrate how quick principal back deals work and why you want to create all the benefits I just described with very little risk. The goal of this strategy and the commandment is to get your money back within 1 to 3 years rather than 5 to 10 years as with most investments. Let's say you're able to invest $100,000 in a property worth $15 million, but purchase below market value for just $12.75 million due to it being a private off-market deal. If anything goes wrong with the investment, you have a strong likelihood of not losing money because of the discounted purchase price. In the first year, you receive a 10% preferred return on your money, paid quarterly. That's $2,500 per quarter and $10,000 per year. In this particular deal, at the end of a year and a half, if not sooner, you get all of your $100,000 principal back. And it gets better. A return of principal is not taxable. You're only paying taxes on the $10,000, but not really, Because this deal is a real estate investment, you receive accelerated depreciation, which allows you to show a loss on your taxes. You also receive equity in this particular investment, which in this case amounts to 0.75%. I actually made this investment 1 year ago, and the property is already worth a little over $21 million due to rehabbing the property, filling vacancies, and raising rents to market rates. So my 0.75% is worth $158,250 in equity. I hear all the time that it's unreasonable to expect a fast overall return on investment and a quick return of principal. So it's not what most people look for. It doesn't even register to them that there could be a better way to invest than just investing in a traditional real estate deal that takes a long time to see a return on their investment, and their money is going to be locked up for an extended period of time. Another thing I hear is, I hope that I see it in this decade. Or, I may never see it again, but this seems like a good investment. That thinking perpetuates the myth that reflects a lack of education to the options that actually exist. Yes, there are plenty of investments where you can invest now and may never see that principal again. And there are plenty that may take a decade or longer to see the principal because you have to wait until a company has some sort of liquidity event if you're investing directly for equity. The truth is, several other ways exist to invest where you can still have equity while receiving cash flow now. My clients and I are in several deals right now that return our principal investments at the 1 year mark. Some are real estate deals, some are debt deals. Some are unique structures investing in operating companies. A few of them are in the final month or two of the term before the principal is paid back in full. Other deals have already paid back the principal in full, so now we have no risk at all in the deal and are just participating in the upside. Investments structured this way are some of my favorite investments. They fit the model of a lifestyle investor. The velocity of money. Something that's really important to me is allowing money to move, or the velocity of money. 2 of my commandments specifically address it. Commandment 4, get your principal back quickly, and Commandment 5, create cash flow immediately, are important because both of those criteria create velocity of money. You can take your cash flow payments that come in on a monthly or quarterly basis and reinvest them. You can get your principal back and reinvest it. Ideally, whenever you invest principal in the first place, you want to try to get some form of equity in return. It allows a portion of your investment to continue to compound over time, and then you get to participate in the upside, even when you have all your initial investment out of the deal. So you have house money that continues to compound on an ongoing basis. In other words, you have a tremendous amount of upside in your investment, but zero risk once your principal is out. By now you know this already, since we covered it earlier. Let's take the return of principal investment one step further to really see the impact on the velocity of money. The way most people invest is in long-term deals where money is either locked up and they can't touch it, or they know they aren't supposed to touch it for over a decade at a time. Examples of this are stock market investing through both retirement accounts and buy and hold strategies for the long term, venture capital funds, new real estate developments that don't have cash flow and may never have cash flow, and equity investments that won't produce a return for decades. In each of these scenarios, your money is not being fully utilized. It's just sitting idle. You hope you get a good return, but you won't know for a while. Instead of having money tied up for 10 years and waiting to see how strong the return is, I'd rather take that same money and invest it in 5 or more deals with 1 to 2 year terms that produce cash flow immediately and can buy me some sort of equity position so I have upside in several deals. Let's say I structure each of 5 investments to get the principal back within 2 years. Doing so allows me to invest in 5 different opportunities during the 10 years that most people have their money tied up. Notice the outcomes, especially as they relate to velocity of money. I have earned cash flow the entire time. I have de-risked the investment because I have my principal out of the deal, and I have been able to get some equity even though all my money is out. And on top of it, I can participate on any big exits over the long haul. What's more, I've used the same strategy with the same money for all 5 deals, since I'm reinvesting the same principal that gets returned to me on each investment. I am confident that my return on those 5 investments, when I consider both the short-term and long-term potential, is going to significantly outperform the return of just one investment held over that same 10-year period. In the one investment approach, all eggs were in one basket. In my approach, I have been able to compound my income and returns because I put that money to use again and again. Additionally, I'm able to de-risk each investment every time I'm able to pull my initial investment back out of the deal. For example, Dress Barn is in the fashion industry and a very well-known household brand. I've already covered that deal in the previous chapter as an example of applying Commandment 3, Find Invisible Deals. The business was sold in a fire sale, more of a liquidation event. The deal was structured around a 1-year note paying 20% interest with a monthly distribution. At the 1-year mark, a balloon payment took effect for the return of the principal. This example perfectly illustrates how you can earn a great return on a company which provides strong monthly cash flow, get your full investment back in a year, maintain long-term equity, and then reinvest that same capital in another deal to do it all over again. This next example also perfectly illustrates these points and explains how you can get your principal out of an investment quickly and repurpose it. I have invested in many multifamily private syndications over the years with various different operators. One investment syndication in particular has 2,600 apartment units in several states, $39.6 million in capital under management, and $225 million in assets under management, with a total of 427 loans and over $51 million in funded loans. Investing in a private syndication that has a strong track record and strong operators local to that market is an easy way to invest in real estate without the complexities of traditional ownership. If you're interested in learning more about investing in syndications, be sure to watch a free training I did with franchising specialist Eric Van Horn at lifestyleinvestor.com/gift. Here's my mindset for this particular deal. Always meet with influencers who are in the middle of maximum deal flow. Finding the right opportunity and taking the time to meet in person is critical to me in my research and decision-making process regarding new investments. I had just attended an investment conference, met many smart investors, and made it a point to connect with many of the investors and syndicators who spoke during the event. I'm proactive about meeting anyone who I think would be a great fit for my network or that I'm just interested in getting to know better and learning what they specialize in. So I tracked down this syndicator after he spoke, developed a relationship with him, learned his areas of expertise, and researched it to figure out if it would be a good fit for me. Here's the structure of this deal. 1. A 10% preferred return. 2. Quarterly distributions. 3. Return of principal in 1.5 years. I had previous deals where my principal was returned in just 1 year. 4. Refinance proceeds at that 1.5 year mark, pro rata to the investment. All tax-free because of how it's coded. 5. Equity payment each year in perpetuity for the percentage of equity owned. 6. Equity proceeds if the property is ever sold. 7. Long-term appreciation. 8. Depreciation passed on to investors. And 9. Annualized return of 41.35% in 1.5 years. As I reviewed this deal related to my desire to get my principal back quickly, I knew this particular investment was a solid addition to my portfolio because of the associated great return yet low risk profile. Here's the filter I used for this deal. The secret to learning how to filter is to spend your time around smart investors who are actively making and not losing money and in the midst of large volume of deal flow. This particular investment was in a strong market. It was a value-add project, which in this deal meant that the operators were going to take an existing property that was already performing well and improve it and be able to charge higher rent. Occupancy was already over 90%, so demand was strong and in a market without much competition. I also liked the fact that I would get my principal back quickly and still have equity in the investment for the long term. Here's the negotiation on this deal. Private multifamily syndication deals are often difficult to get into, so I worked hard to move myself to the front of the line by developing relationships with the best general partners and operators to have access to their exclusive deals. My relationships allowed me an opportunity to invest before the general public and bring some of my friends into the deal as well. I had developed a healthy relationship with this particular syndicator already, and many other syndicators as well, by offering massive value above just investing. Because of that relationship, my network and I earned the opportunity to invest in all future syndications before they were offered to any other investors. It was a massive perk for my network and me. I also negotiated preferred terms for our group for this deal and many of these types of investments. Let's check out this deal in review. In this particular real estate deal, I received a preferred return of 10% paid quarterly until my principal was returned with a target of less than 18 months, and it ended up being closer to 1 year. Once the property was refinanced, not only did I get my principal returned, but I also made my pro rata percentage of the proceeds of that refinance tax-free. But even when my principal was returned, along with over a 41% return, I still had long-term equity in the deal. In fact, I'm going to have equity into perpetuity because this group likes to buy and hold, so I'm getting the best of all worlds. I have equity I didn't have to pay for that will continue to appreciate, and I got my principal investment back quickly. More importantly, I'm getting that equity without locking my money up and with some cash flow today. At some point, if they do decide to sell, I will make my pro rata percentage on the sale as well. Private multifamily syndication 2024 deal update. Here's a 2024 update summary. We executed a business plan and refinanced quickly to return principal. Many syndicators used risky bridge and variable rate loans. Vetting debt terms helps reduce downside risks, and working with experienced general partners is key. Real estate syndications allow investors to participate in large commercial properties that would normally be inaccessible. I've invested in a number of great multifamily syndications run by top-tier general partners. One syndication I invested in owned a portfolio of apartment communities across several states totaling around 2,600 units. The business plan was solid, and the market had strong tenant demand. Within 18 months, they successfully executed their value-add business plan and refinanced the portfolio. This enabled them to return my entire principal investment, plus deliver an annualized return exceeding 40% over that short period. While this particular syndication excelled, others have faced challenges in the current rising interest rate environment. Many syndicators relied too heavily on short-term bridge loans or variable rate debt. As their loans expire and need to be refinanced, they are unable to find attractive financing, causing deals to unravel. Thankfully, I steered clear of deals using those risky loan structures. A decade ago, I had friends aggressively pursuing syndication deals using short-term bridge loans and variable rate debt structures. They implored me to pursue the same high upside strategies. In the bull market of the last decade, those risky structures paid off handsomely for them. However, I maintained discipline to only invest in deals using fixed-rate, long-term financing. Maybe I sacrificed some return, but I also avoided calamity when markets shifted. As expected, when their bridge loans expired, the turbulence of rising interest rates detonated those deals. They faced disastrous outcomes, some total losses, some marginally surviving after years locked up. Unlike them, my approach insulated me from any blow-up risk. My criteria allows me to earn consistent, healthy returns across economic cycles without threat of loss. Some call that boring. I call that sustainable and critical for enduring turbulent times. I have conviction that rigorous analysis and finding the right partners means no regrets in any decade. The market conditions underscore the importance of working with general partners who have experience across economic cycles and understand financing. Taking the time to understand the debt terms can help prevent nasty surprises and preserve your investment. A key focus in any syndication is commandment number 4, getting my principal back quickly. I target sponsors to be able to execute business plans and refinance within 12 to 18 months to return capital so it can be redeployed sooner. Anything longer, and I'd rather invest in a fund for diversification. Even though these types of partners are scarce nowadays, it's worth the diligence to find them. The rewards can be tremendous when you land partners capable of navigating turbulence and delivering solid, executable deals. Maintain conviction during uncertain times. With rigorous analysis, you can find the right teams. Here are some key insights. Many syndicators use risky variable rate or short-term bridge loans. These loans can blow up deals when they become due in rising rate environments. Working with experienced general partners is crucial, and vetting financial terms is important to reduce downside risk.
The 4th commandment, get the principal back quickly. Justin, that's another commandment that sounds simple, but I'm sure there's some story behind it. Can you tell us the story?
Yeah, this one is one of my favorite commandments because most people do not even consider this. Most people, they invest for the long haul. They invest in the stock market to the day that they retire, or they invest in some sort of company where they don't see a return maybe ever, or if they do, it's like a 10-year hold or a 15 or 20-year hold. And so this one's really fun for me because it is not a commonly thought of commandment or principle or criteria, but to me, this is everything because this is where I can get some velocity of money going. So if I can get my principal back in 1 year or 2 years, I can reinvest it and I can get another return with that same money. And the goal as I'm making these investments is to keep getting some sort of equity in each deal or additional kickers, which we'll talk about. So every deal I'm putting money in, I'm getting some upside. I'm taking all my money out as soon as possible. So now if things go well, it's total upside. If they don't, I have all my money back. Right? So I'm playing with house money, but then I'm reinvesting it however many times. You know, if the average person leaves an investment in for 10 years and I'm reinvesting every 2 years, I'm getting 5 times, 5 different deals with 5 different equity sources and probably 5 different other perks that go along with it.
That sounds fantastic. I was chatting with my kids the other day, and one of them came home and said, Dad, would you rather have $1 million or would you rather have, I forget, like $1 or a penny doubled every day for a month? I mean, that's the classic example, and they thought they had one over on me, but I knew the law of compounding. But once people get a hold of that, I mean, that's really what you're saying. You're saying take that money and invest it, essentially double it and double it and double it. What is the actual power of compounding in this type of example?
Well, there are a lot of different type of taxation that can happen, in your investments. And so we'll talk about this more later, but tax-free growth is really the goal. And from a compounding standpoint, if you are compounding inside of some sort of tax-free growth vehicle, you can get no better. But with the example that you gave, I love that example. It's interesting, though, because most of the time when you look at the calculations, it looks like you would have been better off taking the $1 million than the 1 penny doubled until literally like year 29,
yeah.
year 30. It's literally like the very last years of it where the compounding really starts to take effect and to shoot way past whatever the other offer was.
Wow.
And so knowing that, the biggest thing that I've learned in the world of compounding, so this goes back to don't lose your money, but at the same time, don't have interruptions on the compounding of your money. And there are a lot of interruptions that could exist. Taxation is your largest interruption of your money compounding. But you've got inflation, which is an interruption. What if you need money for an emergency thing? You pull it out and then you put it back in later. That's still an interruption. I mean, there are a lot of different interruptions. Fees that you would pay every single year. I mean, these are interruptions to the growth that would happen through compounding. So I would call it a lost opportunity cost.
Wow. That's fantastic. So I hear you saying get the principal back quickly. You say 1 year would be great. How fast are we going for?
Well, each investment is a little different. So sometimes if it's a debt deal and it's, some sort of a note structure, I can get it for 1 year or 2 years. It depends what is able to be negotiated and what can create a win-win situation on both sides. Sometimes in real estate, it might take a little bit longer. Sometimes it's 3 years. But to me, my goal, my ideal is 1 to 2 years. In real estate and the deals that I like to do, generally I try to work with groups that will do a fast refi. So that way, inside of 1 to 2 years, maybe 2.5 years at the latest, we have a refi on the property where they can pay the investors back their original principal. So as long as I can have that principal back, it makes me feel really good because my risk is totally de-risked the moment I have all my initial capital back. And then everything else is just upside. Now, conversely, if you're in a good enough deal that you want that money to sit longer because you're getting a good preferred return, which is what you're paid while they're holding your initial principal, sometimes that's a really good payment, or sometimes the equity split is really good. And so it doesn't feel as bad having them hold your money longer to pay you back. I think that's fine. I know a lot of investors kind of want their money held longer for that reason, and there may be good, perks to that strategy. For me, I just know I have enough deal flow and I have the ability to negotiate good enough deals that I want my money back sooner because I know I can make a better return than if I just left my money in that deal. Commandment 5, create cash flow immediately. I'm a cash flow guy. If it doesn't make me money today, forget about it. Robert Kiyosaki. When you think about mobile home parks, what's the first thing that comes to mind? Do you think about wealth? Keep listening. Your first thought was probably not mine. Not too long ago, my wife and I woke up saying, "You're never going to believe what happened." She'd just received a call from her parents with a horrible report. A special unit of the SWAT team dressed in hazmat suits had just shown up at a mobile home park in her hometown in the southern Midwest. It turns out that the SWAT team had been casing the park based on a report that in it was a meth lab. The story was all over the news, on the radio, and on the front page of the city's largest daily newspaper. I felt like someone had kicked me in the gut. It turns out that I owned that mobile home park. The last thing I needed was negative public relations. First, the good news. Upon further investigation, the police and SWAT team didn't discover a meth lab at all. No problem and no drugs. The bad news is the news media never made a retraction or reported the good news. What was done was done. Other good news. Over the next 3 months, the park added 5 new tenants, making the old saying, any public relations is good public relations, and any marketing is good marketing, came true in this case. Why am I telling you this story? Sometimes the best and easiest income and the simplest deals aren't obvious. This story illustrates how I've made millions of dollars in real estate, specifically in mobile home parks. Mobile home parks as real estate investments. Before you think to yourself, people who live in mobile home parks must be difficult to deal with, hear me out. Mobile home parks are a great investment. Here's the first reason why. When you know what to look for and craft a smart deal, one with a low down payment and immediate cash flow, and you can do seller financing, it means no banks. In my case, I put down 15% or $65,000 on my first mobile home park. It immediately produced $2,000 net every month or $24,000 per year. This asset secured a cash-on-cash return of 36% the first year. A cash-on-cash return is just the return calculated solely based on the actual cash invested in the deal from the down payment. And in this case, it's just the return on the investment before improving the property along with a rent increase. My second mobile home park, which I negotiated from the same seller, had another down payment of 15% or $75,000 and immediately produced $3,375 per month, which was $40,500 per year, or a 56% cash-on-cash return. Cities typically don't want mobile home parks and often try to redevelop them into other forms of real estate because of how much they cost the city, so they're a limited resource. There are only 44,000 mobile home parks in the United States. Approximately 100 per year are rezoned and redeveloped into more valuable property. Since mobile home parks are real estate rental properties, they fall into the IRS class allowed to utilize accelerated depreciation, which means you don't get taxed on all the profit you make. Also, you can buy mobile home parks at the highest cap rate in real estate, which basically means that they produce the best returns at the lowest price. And on top of that, they have the lowest risk. Plus, if you need to use a lender, a mobile home park is an asset class that has one of the lowest default rates in all real estate, so it's relatively easy to get a conventional bank loan if a seller finance opportunity doesn't exist. Passive income and the IRS. An interesting fact to keep in mind on your journey is that earned income is the highest taxed income in the United States and most other countries. In other words, the income you earn from your job or your business is taxed more than any other income you earn. Passive income, on the other hand, is one of the lowest taxed incomes. Often, depending on the investment, many ways exist to substantially reduce the amount of passive income that is taxed, including depreciation and deductions. It is even possible to completely eliminate taxes altogether on your passive income. Did you know that the IRS has a passive investor designation that exists if you don't have any earned income and all of your income is derived from investments? Passive investors actually pay the lowest percentage in taxes legally. Most people look at the IRS tax code as a bunch of rules telling you what you can't do. If you study it, it can guide you to certain investments the government wants you to make based on the incentives in place. One of the reasons I like real estate in general, and especially real estate rentals, is because the government wants adequate housing for its citizens. It incentivizes anyone who wants to invest in housing, among other investments, by giving tax benefits not available if you just work for someone else. If you follow the tax code and what the government wants you to do with your income, you can save a lot of money and help your country at the same time. I could write a whole book on tax strategy alone. For some of my favorite strategies, head to lifestyleinvestor.com/gift. Back to the mobile home park example, your risk is reduced further because you have multiple tenants. So if one or two tenants miss a payment or get evicted, you don't feel the pain the way other investors feel it when they have just one total tenant that doesn't pay rent. Even when evictions are necessary, due to the inexpensive rent and limited space, parks fill up quickly. For most tenants, a mobile home park is more desirable than renting an apartment because they have a yard, land, more living space, and no neighbors upstairs or sharing adjoining walls. Many mobile home park owners are unsophisticated and cash poor, so it's easy to walk in, make simple and basic improvements, and increase the value of the property and implement incremental rent increases, which is almost all profit. For an investor, they're great as a buy and hold strategy, yet also easy to flip and turn over, especially when you know how to find a right fit buyer. For example, let me break down another one of my mobile home park investments. Buy to flip. My third mobile home park investment deal was a bigger deal than my first two parks. I found this mobile home park and negotiated directly with the owners, a husband and wife who wanted to retire. We decided the value of the property, which also included 28 homes and a large workshop, was $960,000. I was able to split the deal into two parts, with the bank financing the land itself and the homes being sold separately, which were considered personal property. The bank valued the 13-acre parcel of land at $800,000 with a $160,000 down payment at 4.5% for a 10-year loan amortized for 20 years. My monthly payment was $4,000. Next, I negotiated the 28 homes to be an extremely reasonable $155,000, which is about $5,535 per home for homes that were worth anywhere between $10,000 to $20,000 per home. Additionally, I was able to negotiate a $0 down payment on a 10-year note that was amortized at 13 years and interest-free. That monthly payment was just $1,000. Here's where things get really exciting. The property cash flowed immediately, and after some initial improvements and a rent increase, it was profiting $14,000 per month. At the end of the first year, my cash-on-cash return was 105%, producing a total profit of $168,000 on a down payment that was just $160,000. I sold the property for $1.2 million exactly 1 year and 1 day later, which produced $240,000 in profit plus the $168,000 cash-on-cash return from the first year for a grand total of $408,000 in profit in just 1 year. Because I timed the sale for 1 year and 1 day, I was able to avoid short-term capital gains tax that would have occurred if I sold it in less than a year, which is taxed at ordinary income rates. Long-term capital gains tax is discounted to just 15 to 20% depending on your tax bracket. The 1031 exchange advantage. More good news for real estate investing. There is a way to reinvest the profits into more real estate to avoid owing a long-term capital gains tax. It's a financial tool called a 1031 exchange that you can use to your advantage. With the proceeds of my single park sale, I purchased 2 additional parks and doubled my monthly cash flow by using the same model. A 1031 exchange gets its name from Section 1031 of the U.S. Internal Revenue Code, which allows an investor to defer paying capital gains taxes on an investment property when it's sold as long as another like-kind property is purchased with the profit gained by the sale of the first property. In essence, an investor can avoid paying capital gains tax indefinitely on selling investment property by continuing to utilize this strategy. Lessons learned. There are 2 big lessons you can learn from this chapter and this example. The first is that when you understand and combine principles and commandments, it multiplies your profit and reduces your risk. You can find a plethora of ways to negotiate amazing deals as I did in this one. The second lesson you can learn is what I did to educate myself on how to invest in mobile home parks. I hired and paid a mentor who taught me the tricks of the trade and how to structure a basic deal, one that I expanded as I grew my skill set. Unfortunately, my mentor didn't bring me any deals, which I would have loved because he was busy running his own business. Several reasons why my Lion clients love working with me is that I actually find deals that I share with them, help them structure and negotiate those deals, and find creative ways for them to reduce risk, increase cash flow, quickly return the principal, and avoid tax consequences. I decided to start coaching and teaching because if I would have had someone share strategies and principles like this with me years ago when I started investing, I know I would have built a significantly larger and more profitable portfolio and in a much faster time frame. Private real estate fund investing. In the last chapter, I discussed investing in a private multifamily syndication, which is an example of a direct real estate investment where you invest directly into a specific deeded property that you own. For example, a house, apartment, mobile home park, storage unit, etc. In that example, I acquired an ownership interest in an entity that directly owns that asset with a goal of producing cash flow immediately. Here, I'm going to discuss investing in private real estate funds, which, like the last example, many people may not realize is even an option. Investing in a real estate fund is an example of an indirect real estate investment because you are not investing directly into an asset, but rather buying shares in a fund or trust that owns many assets. Real estate fund investing can be done in the public markets on the stock exchange using real estate investment trusts or REITs, but I prefer investing in private real estate funds because there is less volatility and often more cash flow and a much bigger overall return. I discuss investing in funds in more detail in the next chapter, Commandment 6, Find an Income Amplifier. Here's an example of investing in a private real estate fund. I met an operator who is a great investment analyst in an investment group I'm part of, and we really hit it off. We have many mutual friends, and he is highly regarded by everyone. He is much more analytical than I am, so we make a good team. Plus, I knew I could trust his market research based on his results and his reputation. The two of us started analyzing investments together. We figured if we both independently like a deal and it passes both of our vettings, then it's likely a good investment. He shared a bunch of his deals with me, and I did the same. So far, our approach of two minds being greater than one has worked out exceptionally well. We have invested in many private real estate funds in various asset classes with some exciting returns. Here's my mindset for this deal. I've invested time as a real estate operator and learned all that it takes to be a strong operator, so when I started investing in other people running operations, I knew what to look for. I also am a big fan of a fund structure in general. If a fund owns 100 properties and one of them doesn't perform, there won't be much impact on the overall return because the other 99 properties are likely to perform well. If I directly invested in just that one property, however, then I would be in a position to lose money. Investing in a fund is a great way to minimize risk and diversify your investment across different locations, sizes, and property types, among other factors. Here's the structure on this deal. I've invested in several fund structures over the years with varying terms, so I will give a spread of the different structures I have invested in. 1. Preferred return of 8 to 10%. 2. Monthly distributions, sometimes quarterly distributions. 3. Internal rate of return, or IRR, of 15 to 25%. 4. Return of principal in 2 to 3 years. 5. Profit split after return of principal. Splits vary on each deal and can range anywhere from 80% to the investor and 20% to the fund manager to an even 50% split. These splits are often represented as 80-20, 70-30, 60-40, and 50-50. 6. Depreciation passed on to investors pro rata, so no taxes on a good amount of the profit, and often with accelerated depreciation where you can take a larger deduction in the beginning, there's potentially no taxes on it. Here's my filter on this deal. I like the consistent monthly or quarterly cash flow of this investment, as well as it being one of the safest ways to invest in real estate because so much risk is mitigated with having so many properties in the fund. The key here is only investing in funds that have proven general partners and proven local operators who have a long track record of experience and success in operating that specific type of real estate. I also make sure the financials are very strong and reasonable for the market and asset class. The funds I invest in have operators with a tremendous amount of experience, and strong financials that conservatively show how I can earn great returns. I also like to invest in funds that have a very selective process for the assets they purchase and specialize in asset classes that are generally recession-proof. Here are the negotiations of this example. Even when investing in funds, I often negotiate many of the terms. Some funds have exclusivity, and it's difficult to get access to them. Plus, they often have high minimum investments. Everything is negotiable. I negotiate lower investment minimums based on what I feel comfortable investing, not what the fund minimum may be. I also like to negotiate preferred terms when I have the leverage of having a large group of investors who also want to invest. These terms include waiving fees, paying a higher preferred return, and improving the profit split. Additionally, I like to negotiate to get access to future funds before they are available to other investors and become oversubscribed. In the next chapter, Commandment 6, Find Income Amplifiers, I will explain in much more detail how I secure preferred terms utilizing sidecar agreements. Let's look at this deal in review. To create cash flow immediately, you've got to use all the above principles, especially filter. It is incredibly important to vet deals not only based on the financials and asset classes, but also the general partners and operators who run them. Successful investors realize that having an experienced general partner and strong operator is just as important as having strong financials. One without the other is not a good deal. You really need to have them all. Additionally, it is important to recognize that sometimes the most non-obvious and even undesirable investments produce the best cash flow. Mobile home parks and industrial warehouses are perfect examples, and these assets are often purchased in private real estate funds. At first glance, they may be unattractive and perhaps even just weird-sounding investments. However, they often require a small down payment and have minimal risk, especially if you're buying them cheaply enough. Financing is often done by the owner if they are not institutionally owned, and it's easy to make improvements, which immediately increases cash flow. In many cases, few improvements need to be made. In an up or down economy, low-income housing, such as mobile home parks, is a great investment. Everyone needs a place to live, and they are the most affordable housing in a town or city. Likewise, industrial distribution centers are a great investment. With the e-commerce boom, there is more of a demand than ever for industrial distribution centers. To top it off, these investments are real estate, so there are massive tax benefits. A smart investor with the discipline to focus on investments in asset classes such as these can make a substantial fortune in good times and bad. Private Real Estate Funds 2024 Deal Update. Here's the 2024 update summary. Funds allow greater diversification across assets and locations. Poorly structured debt amplified risks in some funds. Conservative fixed-rate loans reduce blow-up risks. Success hinges on experienced fund managers, and funds provide steady cash flow distributions. Given my positive experience with real estate syndications, I began making investments in private real estate funds focused on specific property sectors like industrial, multifamily, self-storage, and so on. The fund model allows for greater diversification across more assets and markets compared to doing individual syndication deals. It also provides access to professional fund managers and operators I wouldn't invest with otherwise. While the funds delivered excellent returns initially, some have faced challenges recently. In particular, funds using floating rate debt or short-term bridge loans have struggled as rates increased rapidly. As I covered with syndications, I had friends aggressively pursuing funds using floating rate structures, imploring me to pursue the same high upside strategies. While they benefited in the bull run, I maintained discipline to invest only in funds using fixed rate, long-term financing without major payments coming due. Maybe I sacrificed some return, but I also avoided calamity when the market shifted. Now, as their loans needing refinancing have detonated those funds, My more conservative approach has insulated me from blow-up risk across economic cycles. This turbulent environment has reinforced the need to partner with experienced managers who have navigated prior cycles. Trying to maximize leverage works wonderfully when rates decline, but can be disastrous in rising rate environments. I'm thankful for having avoided those risks by focusing on fixed rate structures and seasoned managers. The funds I invested in utilize conservative long-term fixed rate loans without major near-term maturities. This insulated them from the unprecedented rate increase that torpedoed highly leveraged strategies with excessive floating rate exposures. I have conviction that rigorous analysis and finding the right fund managers means no regrets in any decade, even if that means taking a more measured approach in the short term. Additionally, I prefer to invest in funds with a targeted specialty rather than attempting to diversify across too many asset classes. For example, I would invest in an industrial fund focused solely on that sector rather than a mixed-use fund attempting to balance industrial, multifamily, self-storage, and more. I've found that niche expertise outperforms generalized competence. Many real estate funds provide immediate cash flow through their quarterly distributions. This steady income can support my lifestyle or be reinvested to compound returns. I avoid long lockup periods so the liquidity can be accessed quickly if needed. Maintaining flexibility and targeting specialized operators have insulated me from turbulence. Here are some key insights. Funds provide diversity, but success hinges on the fund manager. Many funds use excessive leverage via bridge loans and floating rate debt. Conservative long-term fixed rate loans reduce blow-up risk. Experienced managers that have seen economic cycles are key. And max leverage works great when rates fall, but can amplify risks.
Fifth commandment, create cash flow immediately. Listen, Justin, this is one of those commandments where I think people don't even think about it because we're told set it and forget it. And don't think about it till you're 62 and a half or whatever the age is. Why should we create cash flow immediately? It almost seems like counterintuitive.
Yeah, this kind of goes against what people think is even possible. So I often get clients and friends that say, "What? You can create it immediately?" And I say, "Yeah, I wouldn't buy a real estate asset. Personally, I would never buy an asset that didn't cash flow immediately. That's just not in my DNA. And if I ever did, it would only be after I had the cash flow to support my lifestyle, because I don't ever want to bank on appreciation. I would rather buy something based on cash flow. And if I get appreciation as well, that's just an added bonus."
That makes sense. You use the mobile home example. And is that really a area of investing where you can get cash flow immediately?
Yeah, so a lot of people, again, don't look at mobile home parks as, the sexiest investment. It doesn't just, roll off the tongue. It is one that probably because it doesn't sound as exciting, it has really kind of been off the radar for a lot of institutional investors. And so you have a lot of mom and pop owners that own mobile home parks that want to retire. You've got baby boomers that they are ready to be done and they don't know what to do. They're not sophisticated in many cases and don't know what they're going to do with their money whenever they make it. And so it's a great opportunity to educate them on not only buying their property, but helping them make a return on their money. Maybe you even have them sell or finance the deal to you and you pay them interest like a bank, which is a great deal for them and it's a great deal for you. But the goal is to make money immediately within the very first month of owning it. And so far to date, every investment that I have ever bought in real estate has made money day one, month one.
And that's because of what? Mobile homes and the rental fee?
Yeah, so with mobile homes, so there are kind of two different cash flowing opportunities with mobile home parks. When you own a park, there are homes that are owned by tenants and homes that are owned by you as the owner. My goal isn't necessarily to own homes, but it is inevitable in the business because people will move out, people will get old in age and pass away, and their heirs don't want it, and you can buy the home at a pretty good price. So you ultimately are going to own homes. My goal is to sell the home back to someone and give them an opportunity at home ownership. But what I want most is the lot rent income. And that's just them renting the land for having their home on the land. But there's also the home rent income for people that are renting a home. And so, my goal for me, I don't want to do as much of the upkeep on homes. So I would rather just sell the homes so that I don't own them, that the residents own them, and they can take care of the home however they choose to. I would just rather the lot rent check, and that's it. That's a simpler, low-maintenance way of investing in real estate.
That sounds fantastic. Do you have any other examples for commandment number 5, creating cash flow immediately?
Yeah, there are a number of other investments that I do. I'm a big fan of investing in senior credit funds. And what that would be is you're investing on the debt side of a multiple deal investment. So a fund is going to have a whole bunch of different assets or notes in this case. And I like being in a senior secured position, or the first lien position, which is the first person that gets paid on a deal. If it goes bad, if it goes well, just being in that first position, there's a lot of power in protecting the deal there. But those deals often will have cash flow. Same thing with, syndications. You can get into real estate deals where, you have a bunch of people that pool money to buy an asset, and there's cash flow on that asset because the asset cash flows immediately. So either of those would be cases where you could be getting monthly distributions, you could be getting quarterly distributions. It's generally one of the two. And one of the things that I like about real estate is that you can depreciate the asset. And so one of the perks here is you have a certain amount of profit that you make, but the IRS says, hey, a lot of people look at IRS code and they say, oh, it's a whole bunch of things you can't do. Really, what the IRS code is a blueprint that says, do these things and we'll give you perks.
Wow.
So if you look at what the IRS wants, they want housing in the U.S., they want agriculture, they want energy. So they want people to invest in those things. And when you do, then they give you perks or credits or ways to help you out to incentivize that type of investment. And so there's something called depreciation, where it's basically that you own real estate that is becoming less valuable over time. It's a year older, by the end of that year. So the government says you can actually subtract that amount that it depreciated or became less new, and you can take that off of your profit. So you can actually get to a place where you're not paying taxes on a lot of that profit, depending on the situation, depending on also how much earned income you have versus investment income. So I'm a big fan of real estate from that perspective.
Wow. And one of the other things you talk about in this commandment is whole life insurance. And the first time I heard this, I just couldn't believe it. But you can actually function as your own bank. Talk about why that would be appealing, why today's banking is really rigged against the person who has money in a bank, and how there's this legal loophole that basically allows you to do whole life insurance where you function as your own bank.
Well, the banking industry in general is really corrupt, in my opinion. Well, it's corrupt according to all the different scandals we see too. But I don't trust that banks have my best interest in mind. I trust that they have their best interest in mind. I trust that they want my money as fast as they can get it, as often as they can get it, and they are going to put it to use in different ways. So part of the money they will invest in, government bonds or treasuries, because that's, kind of a sure thing type of money. And it's funny because you as an investor could actually go do that yourself. You could go to Treasury Direct and invest in the same stuff your bank does and get paid, twice, 3 times, 4 times as much as the bank's paying you. Because the bank's paying you like 0.005% or something. They basically paying you nothing, pennies for tons of money. And they're taking that money and they're putting a portion of it in these low risk, bonds. And then they're putting a large portion of it in high risk derivatives. So a lot of people don't even know that our banking industry in the US here is really, really scary. It's really unsafe. The solvency ratio is not a very strong ratio. You can look up their financials and see how much risk they have and how exposed they are. And a lot of people think, oh, it's a U.S. bank, it's safe. I would say that most U.S. banks are not safe. Even the biggest banks, even Chase Bank and Bank of America and Wells Fargo, if you look up their numbers, they're kind of scary. So, when you look at a life insurance company, and also with the banks, I should say, they do fractional reserve lending. So every deposit you make, they can loan that same amount out generally 10 times, sometimes a little bit more, but generally around 10, 11, 12 times. And so it's very risky. So you've all heard of, or I'm assuming most people have heard of a bank run where a whole bunch of people say, hey, the economy's bad, let me go and take my money out. And if there's a bank run and a lot of people want to take their money out, banks don't hold very much cash. They have it all loaned out. So it's really hard for them to be able to do that. That's even why, with some of the
scary times.
Scary times that we've had, you will see that people are saying, don't go to your bank. We're fine. We've got this. You're hearing it from the government because that's a scary thing. Life insurance companies, on the other hand, have to have in cash 100% of death benefits payable if everyone died at the same time.
Really?
Now, the odds are incredibly unlikely, but that's how financially strong they are. And a lot of people don't realize that. So I'm a big fan not only of that as an institution because they're a lot better stewards of their money from an investment standpoint, but then they're also going to pay more for the return on investment. So they pay a dividend, and these dividends are, 5.5 to 7% per year, which is incredible compared to a bank. And it's also growing in a tax-free growth vehicle.
So give us an example. You basically have whole life insurance policies where you borrow against it. Talk a little bit about more of the mechanics of that.
Yeah, so what I can do is I can borrow against the total cash that I have put. It's called the cash value. It's the amount of cash that I have put in terms of premium payments. And by the way, not all life insurance policies are created the same. Not all life insurance agents are created the same. There's a lot of garbage that's out there. A lot of what's off the shelf is just not what you would want. You really want an expert to create a policy that works the best for the way that you and your family want to operate. And so the way that I have my policy structured is unique. It's unique to me. It's unique to the amount of income that I make. It's unique to the net worth that I have. And anyone can do it at any level. But it's important to just realize that you want a specialist here. But to answer your question, what I can do is I can take a loan against the cash that is in my policy, and I can then invest it in another investment. So let's say that I follow my own commandments, which I do, and I take that same money where I'm earning right now 6.5% dividend. And I take that money and I borrow against it and I invest it in this other cash flowing investment. And maybe this investment's paying me 20% on my money. And maybe I'm getting that on a monthly basis. That's kind of a nice target for me, a sweet spot for me. Now I've got the same money working in 2 different places, earning me 2 different returns. So I'm doing what the banks do. It's like one step of fractional reserve lending. And I think it's just one of the smartest things that an investor can do.
Wow. How many people do you think utilize this? And if not, why not?
Well, there's a very small minority that do this. Most people don't even know it's possible. Most people don't know it exists. I also think that there have been people that have given life insurance products a bad reputation. You have people that basically say buy term and invest the rest. And I think that could be true for most products. I think most products are not good. But if you have any sense about you and can learn how to invest, that's not the best way. And if you invest in the right type of whole life policy, it's going to pay a tremendous return over the life of the policy. Not to mention you have the flexibility and liquidity to use that money in an emergency or for other investments. And it's the only investment where your money can grow tax-free. So you have tax-free growth. You have tax-free distribution when you retire, and you have tax-free death benefit to your heirs. There's no other investment that has 3 different tax-free opportunities with the return.
Wow. So is this one that you would recommend highly, meaning in a direct correlation with this commandment, or is it really just one example?
So this is one of many examples, but to me, this is the foundation because everything I do through this. I treat this as my bank. And so this is where I have cash sit. I don't have it sit in a bank because I'm not going to make much on it in a bank. I want to make returns on it. And what's nice about life insurance companies for these whole life policies, I have a minimum guaranteed return that I'm going to get. Each policy is going to list that. And your strongest companies, your best companies are going to pay you the best. They're going to have the highest numbers. But you got to be careful because there's also most life insurance companies are direct recognition companies. And what
does that mean?
Yeah, so direct recognition means they recognize that you're taking a loan against your policy. So they're going to pay you less for that money that you have out. So it's really important to invest with a non-direct recognition company, meaning they're going to pay you the same dividend whether they have your money or you have a loan against your policy.
And is this something they have to declare, or you ask them, or what?
So they would have to tell you. They may not advertise it, but you can ask your agent and they could let you know. But I think this is really important because I borrow against my policy all the time for investments. So if I'm using a company that's going to pay me less, well, that's a lot less that my net worth is going to grow. So I really want to make sure that all my money's treated the same way, whether I'm using it and it's in an investment or it's sitting in my policy. I want it to work the same exact way. I want the same exact return. Commandment 6, find an income amplifier. Stay committed to your decisions, but stay flexible in your approach. Tony Robbins. But wait, there's more. That's how an infomercial creates an irresistible offer, by adding multiple bonuses and maybe even giving an extra product for the same price with free shipping. If you're a typical investor and can make 8 to 15% profit per year, you'd be happy enough, wouldn't you? What if you could have collateral that would guarantee you would get your principal back plus interest? You'd be ecstatic, right? That's 2 for the price of 1. In this chapter, I'm going to introduce you to the concept of income amplifiers and what multiple income amplifiers can do for an investor when you stack them together. An income amplifier is any mechanic or negotiated term that helps improve an investment return. Various ways are out there to structure these deal terms, and the more income amplifiers you can get, the better the investment return should be. Before I talk about income amplifiers, though, I want to address a false belief among novice investors and maybe even some experienced investors, namely that the terms are the terms. That's just not the case most of the time. Terms are negotiable. After being offered terms, I always like to go back and negotiate something different that improves the investment, whether it's just me investing or whether I'm bringing a group of investors into the deal. In some cases, a group might give me more influence, leverage, and negotiating power to get even better terms. Investment income amplifiers. A variety of investment income amplifiers are available but rarely used by the typical investor. Here is a list of the most common income amplifiers I use. 1. Negotiating preferred terms. These are terms that improve the economics of the investment. 2. Sidecar agreements. These are an addendum or agreement with pre-negotiated preferred terms. 3. Co-investment opportunity. This is an opportunity to invest in a specific deal outside of a fund but alongside the fund managers. 4. Equity kickers. This is free equity that is given as an incentive to make an investment or loan even better. 5. Warrants. This is an option to buy equity in the future at a predetermined price. 6. Revenue shares. This is a percentage of top-line revenue paid to an investor, typically with monthly distributions. 7. Liquidation preference. This is a clause in a contract that dictates the payout order of proceeds upon the sale of a company or other corporate liquidation. 8. Advisory shares. Business advisors will often exchange their involvement within a company for compensation with common stock options, which can lead to equity in the company. 9. Debt investments. Investing in the form of a loan rather than straight equity. Debt investments allow a return of the principal investment with interest instead of an equity investment that likely has no principal return for a long timeline if it ever does have a return, plus the possibility of some additional income amplifiers negotiated with the loan. 10. Accelerated distribution schedule. This would be investing in the form of straight equity rather than a loan, but with a faster repayment schedule. This amplifier gets the initial investment paid back in a much quicker time frame than what the standard distribution schedule would be based on equity splits outlined in the operating agreement. And 11. Profits interest. This amplifier is an equity right based on the future value of a company. From a tax standpoint, it can often be better than equity because it doesn't incur taxes during the holding period. When the profits interest is taxed, it's long-term capital gains tax rather than short-term capital gains tax, which is taxed like ordinary income the way a warrant is taxed. For a lot of deals in which people invest in a seed round, which is an early-stage investment in a company before it's typically profitable and showing signs of sustaining business, they invested in a certain amount of equity and hope the company makes it. If there's a liquidity event, they're paid based on a multiple of the value of the company when they invested and the value of the company at the time of the liquidity event. Most companies, however, don't end up having that coveted liquidity event, and most companies don't end up making it, so the investors may never see their money again. I would much rather structure an early-stage investment differently, specifically by making it a debt investment as a loan to the company rather than a straight equity investment. Then, in addition to the debt structure, I can negotiate a smaller portion of equity or warrants to be awarded immediately as a kicker. The extra equity or warrants would then be free kickers that wouldn't cost me a thing. Warrants are an option to buy shares of a company at a predetermined strike price based on today's valuation, but exercised at some point in the future, if and when the company is worth significantly more. Warrants are similar to equity, but end up being more of a liquidation preference, which means you can structure them to get paid out before equity holders and often even before debt holders when a company sells. So instead of making a direct investment for equity in a company, the structure I prefer is actually a loan with kickers and often an accelerated repayment plan. Another structure I like that makes sense depending on the deal would be to make an equity investment with an accelerated distribution schedule so I can get a return of my investment quickly but still have a good amount of equity in the deal. I recently got involved in an investment with a well-known company, the Franklin Mint, that sold coins on TV, online, and through mail order catalogs and magazines. In the Commandment 3 Find Invisible Deals chapter, I told you about Dress Barn, a business that didn't grow with the times, didn't transition to e-commerce fast enough, and found itself in a challenging position. A similar situation occurred with the Franklin Mint. An investment syndicate I'm involved in got its members together and negotiated a simple-to-understand but uncommon investment structure that exemplifies the "but wait, there's more" offer. Instead of negotiating my usual 15 to 20% interest, the syndicate members decided to change things up. They agreed on a 10% monthly distribution of gross sales paid as a royalty. That detail will become important later, plus several more income amplifiers on top of it. Here they are. Income amplifier number 1. We negotiated a monthly distribution of gross revenue. Income amplifier number 2. We eliminated downside risk by negotiating collateral in the form of a holding company worth over $100 million. If the investment fails, the holding company is worth significantly more than the relatively small investment to buy the Franklin Mint, so there's a lot of protection to help avoid losing money. The value of the collateral in this example was over 20 times greater than the value of the purchase price of the Franklin Mint. Income amplifier number 3. We negotiated a 20% cash bonus based on the principal investment to be paid out at the end of the 3-year note term. Income amplifier number 4. We added an equity kicker of 6% per $1 million invested. Since this is a kicker, the equity is actually free, and none of the investment went towards purchasing equity. This amount of equity to be given just as a kicker is incredible. Typically, kickers are much less, if even given at all. Income amplifier number 5. We capped the total return of the principal at 2x, or 100% return on investment. It was the one thing this group we invested in required. They guaranteed a maximum term of 3 years to double our principal investment, but we actually anticipate it will take just 1 to 2 years to double it. The cap protects the group we invested in, but it also is a nice return in a short period of time for my group of investors. Let me break this deal down for you in terms of how it worked and what the expected return is. Imagine you as the investor. You invest $1 million into this deal. By doing so, you earn 6% equity as a kicker, so you get that for free, plus a 10% revenue share on gross proceeds capped at 2x the investment, so capped at $2 million. Additionally, there's a 20% cash bonus at the end of the term, which is an extra $200,000. So at the end of 3 years, you would get a total of $2.2 million back. The first $1 million was the initial investment, and the additional $1.2 million was the profit. If this investment takes the full 3 years to hit the 2x return on principal plus the 20% bonus, it will be a 40% return each year with a total return over those 3 years at 120%. If it takes just 2 years, it will be a 60% return each year. Either way, contractually, the deal has a tremendous amount of upside with very little downside. My favorite deals are like this one, with asymmetric risk and reward, meaning the downside of the investment is protected. If I were to lose any money, it likely wouldn't be much, but the upside has exponential growth possibilities. When I stack multiple deals like this one together, investing gets really exciting. If for some reason one of the deals goes bad, I would have others that perform really well and give exponential returns, which means I'd be way ahead. I actually like to structure these deals so that even if 5 deals go bad and only 1 deal goes according to plan, I still come out ahead. This deal is just one example of how I structure deals to create long-term returns, but also offer strong cash flow during the life of the investment. The goal is obviously to have as many investments produce an exponential return as possible while protecting the risk of each investment at the same time. In this example, the odds of 5 deals going bad is extremely unlikely because of the high degree of risk protection I like to negotiate into all of my investments. There's a plot twist to how this deal unfolded that you won't want to miss. It's even more proof that applying the commandments and principles in this book can protect you in the short term while creating unexpected long-term returns and results. The dangers of distressed assets. A promising partnership turned sour. When the Franklin Mint approached us ready for a capital infusion, I saw endless potential if we could spark a rapid transformation. This once revered brand had lost its luster after failing to keep pace with changing consumer habits. But it still had name recognition, and our deal was designed to catalyze a swift turnaround. Our team negotiated a highly advantageous deal, giving us ample downside protection while maximizing upside if the turnaround gained momentum. The creatively structured terms included preferential access to cash flows, valuable equity kickers, and more. On paper, it was a home run deal with asymmetric risk-reward ratios in our favor. In the early months, our unconventional investment appeared to be paying off. Nostalgia-fueled sales spiked as we leveraged the brand's heritage. However, when management made an impulsive acquisition that distracted focus, things changed. After an initial period of optimism and early wins, several compounding missteps by leadership led the company downhill into eventual insolvency. Despite our guidance and warnings, leadership continued to get distracted. What we assumed would be a 90-day sprint to stabilization turned into a prolonged nosedive. As cash flows dried up, we watched momentum evaporate and key talent head for the exits. The person leading the initial turnaround efforts was abruptly let go, despite doing an admirable job. It became increasingly clear that our investment would badly underperform compared to the original projections and assumptions. When the company inevitably defaulted, we initiated prepackaged bankruptcy to contain the fallout. As the process unfolded, though, we ultimately decided not to follow through with the prepackaged bankruptcy, as this would have cost us another $10 million. Another pivot. This time, the senior secured investors pursued a strict foreclosure under the Uniform Commercial Code UCC Article 9. This article allows creditors to repossess a secured property if a debtor defaults on their debt. Now that these proceedings have ended, our syndicate officially owns this company brand and all other associated intellectual property assets outright. So while the deal certainly did not transpire as originally planned, we still anticipate emerging stronger on the other side than we previously imagined. We can now pursue opportunities to sell it to a more fitting owner who can optimize the brand's latent value. Here's a lifestyle investor lesson. Even the best plans can go awry when human nature deviates from logic. Making sense of a disappointing investment. Sifting through the wreckage, I gained several unconventional but critical insights. Sometimes investments don't work out the way they should on paper. Protect against missteps with contingency plans and oversight. Return on investment can take many forms, each with its own time horizon. Look through multiple perspectives, especially non-obvious ones. Adopting a turnaround mindset requires balancing quick action with restraint and strategy, a tricky balancing act. And not all distressed assets are worth the effort post-investment. Vet these deals just as carefully as other investments to save yourself time, hassle, money, and frustration. Course correcting to chart a wiser path forward. And now, I'm walking away wiser with a renewed commitment to risk reduction. Number 1, negotiate structures that anticipate irrational behavior and bind leadership to the agreed strategic plan. Number 2, institute additional oversight and set feedback loops during volatile turnarounds. Lack of visibility compounds issues. Number 3, develop rapid response plans addressing scenarios if investments head south. Fortune favors the prepared. And number 4, cut losses swiftly if turnaround stalls despite exhaustive efforts. Sunk cost fallacy makes it easy to throw good money after bad. Sidecar agreements. Next, I want to introduce you to sidecar agreements and how they work as an income amplifier to add to your toolkit. A sidecar agreement is effectively a term sheet that gives a separate set of enhanced terms, ones that are better than what a typical investor would qualify for and be able to get. I use sidecar agreements often to guarantee I get preferred treatment when I invest. If I'm investing with a group of investors, I make sure that they also get the same preferred terms that I get. Here's how I stack sidecar agreements. The first thing I do is negotiate preferred terms for the current investment. If my Lions network is investing with me, I negotiate terms on behalf of the whole group. Those preferred terms can include a discount in management fees or administration fees or any other fees, a discount on carried interest, an increase in preferred return or interest payment, an increase in profit split, or even a decrease in the minimum investment. Sometimes those preferred terms include an increase in the hurdle rate, which is the minimum rate of return required by an investment. My biggest focus at this stage is to negotiate terms that allow me to improve my overall return and allow me to invest at an amount I am comfortable with based on the investment. Next, I negotiate the opportunity to have preferred terms and first mover advantage on any upcoming investments. I want to be the first money in as many deals as I can while maintaining those same preferred terms. I negotiate the first right to invest in future deals so I can get access to every opportunity before anyone else, and that I am not limited in how much I can participate in each investment. Last, I often negotiate preferred terms on an opportunity to co-invest in additional investments. For example, let's say I'm investing in a fund, and that fund has additional investments that don't fit the criteria or would represent too large of a single investment for the fund. I would negotiate an additional agreement to co-invest in subsequent deals, often with even better preferred terms than were outlined in the first sidecar agreement. These co-investments are often extremely limited and difficult to get into in the first place, but if I get in them, I have even better preferred terms in place for those investments. I will explain this last point about co-investments in more detail, but before I go on, I want to make sure you understand negotiating preferred terms. You can amplify your investment by negotiating preferred terms on any deal, but you can also amplify a deal by using a sidecar agreement for preferred terms, whether you're making a direct investment or a fund investment. Co-investments in funds. I've discussed direct investments in depth already, so I'm going to spend some time here talking about investing in funds and how to amplify those investments. Personally, I like investing in funds. Funds are a collection of many different investments inside of the same investment vehicle. The reason savvy investors like funds is because they mitigate some of the risks that exist if they only have one investment. In a fund, if an investment doesn't work out, that's okay because the other investments that do perform well will typically more than cover the deal that went bad, making the overall return for the fund still strong. Good and bad investments in the same fund can balance each other out, so it's not a total loss like it would be in a direct investment that went bad. Now let's look at a fund co-investment example. Sometimes if you get into the right fund with the right people, you can negotiate a sidecar agreement. You might have money in the fund that has exposure to all the deals, but there may be a particular one-off deal you really like. Maybe you know that market or the operators really well, or you have some sort of advantage or insight to know that this particular deal is a great opportunity. Or maybe there's an opportunity to get equity or warrants for a particular investment. In this case, you can negotiate preferred terms for just that individual investment, which is often referred to as a co-investment. You'll get better returns on your overall investment than if you are only in the fund. Because you're in the fund, you still get exposure to that deal, but often you may want more exposure than the fund will give you. If that's the case, and you look at a deal and know it's a slam dunk, you can negotiate preferred terms or use a sidecar agreement that already has pre-negotiated preferred terms for that single investment. This way, You can participate in some of the general partner economics of the deal for a better return on your investment, which may include equity, warrants, or an overall larger interest payment or preferred return with reduced fees. Earn on invisible money. In the investment world, there's something called phantom income, which is the ability to earn a return from money that doesn't even exist. One example of phantom income is the appreciation that you may see in a rental property from one year to the next or over a longer period of time. Robert Kiyosaki, the author of Rich Dad, Poor Dad, and many other favorite books of mine in that series, also talks about the phantom income you receive from having your tenants pay down and eventually pay off your mortgage, which reduces your debt and grows the value of your asset. Also, once your asset is completely paid off, eliminating that debt service increases your cash flow, which is another type of phantom income. Additionally, when you depreciate your assets and the income from those assets, you create phantom income because you profit more than what you pay taxes on. However, the number one benefit of phantom income is that you earn a consistent return on money that doesn't even exist, if you use it the right way. Each of the different ways to create phantom income can come with a wide array of benefits and drawbacks depending on the situation. The phantom income I want to discuss for the lifestyle investor utilizes specialized whole life insurance products in a unique strategy which offers many benefits and usefulness, especially to investors. There is a way to create a specially crafted whole life insurance policy that is superfunded or maxed out in a creative way on the front end that creates exponential returns as it compounds tax-free over time. Most life insurance products you would purchase off the shelf will not work for what I'm going to describe. Many life insurance agents don't even know how to create policies like what I use. The policies that I use involve an expert in the insurance space who specializes in creating specific whole life policies that perform as if they were on steroids based on the way they are structured. The life insurance expert must add additional riders that help these policies perform exponentially better and in a way that is most beneficial to the client, based on the lower commissions paid to the agent and the accelerated growth and compounding of the cash values, meaning the investment dollars that are put into the policy through premium payments. For example, most people don't know that they have access to money in their whole life policy and that they can actually borrow against it, ultimately using that same money in an investment elsewhere. In other words, the money inside the whole life policy is still earning a return because borrowing against it is not actually taking the money out, only taking a loan against that money. That loaned money, however, can be invested in another deal to earn a return on it. In other words, they can earn two returns with the same money. They earn a dividend from the whole life policy, which has a guaranteed minimum return in most cases, but they can also earn cash flow and potential equity from those same dollars by investing into another deal that has its own return. To amplify the return a little more, if they follow my commandment 4, get the principal back quickly, they can maintain equity in that second investment and turn around with those same dollars and invest it yet again in another deal and earn a third return on the same money. In that case, they would be earning a return and building equity in 3 separate investments, all with the same investment capital. This example of phantom income is also an example of fractional reserve lending like the banks do. Fractional reserve lending takes place when the banks take your deposits and only keep a fraction of them on hand and lend out the rest, usually 10 times with the same money. It seems impossible, but this really is what banks do. They invest a large portion of your deposits into high-risk derivatives, which led to the market crash in 2008. So in my example, where I had 3 returns with the same investment capital, I was able to do what the banks do, but on a much smaller scale and in much safer investment vehicles. In the example, I utilize phantom income because I have all my money out of the deal. I've made a profit on the first investment, and I still have equity and cash flow as if money were still in the deal. In essence, I get to do what the banks do on my terms for my portfolio and for my benefit in a very safe way. And you can do it too. In Commandment 7, plus the deal, I share a real-life example of how I use my whole life policy and earn a return in two places at the same time through a combination of arbitrage, equity, and investment income. Arbitrage is where you can take advantage of making a risk-free profit on the margin between two different prices or rates of return. Let me go through another example. I've already broken down the dress barn deal earlier in Commandment 3, Find Invisible Deals, but I wanted to give you a bit more detail on how the income amplifier strategy worked with it and how you can turn a connection or relationship into a super profitable cash flow investment. Here's my mindset for this deal. I attended a conference with another investor, and we became friends. We started to share our network contacts. He gave me access to some high-profile investors and entrepreneurs, and I did the same for him. This deal was about knowing the right people at the right time because there were only a few people who even had the opportunity to invest in it. One of the reasons I liked this investment so much was because I would be able to get my investment principal back quickly. Another reason was that the odds of this company failing inside of the first year were really small. Even if the company failed in 2 years, I would have all my money out of the deal. I also believed, however, that scaling retail brands online and eliminating brick-and-mortar retail stores was the future of this industry. Here is the structure of that deal. 1, it was a 1-year note. 2, 20% interest was paid on that note. 3, monthly distributions were paid. 4, balloon payment at the end of 1 year, which is a full repayment of the investment principal. 5, I had an option to extend part or all of my note for 2 more years at the same 20% interest plus a 15% cash bonus at the end of the new term and an additional 10% warrant kicker. 6, there was an option to partially or fully convert my note into equity later when time allowed me to evaluate the progress of the company and the investment. 7, a 3% equity kicker per $1 million investment. And 8, the investment was collateralized by Dress Barn's intellectual property, which was worth much more than the investment. Here's the filter I used for this deal. This example is typical of an asset that was selling for pennies on the dollar with a strong brand. The operators are high-profile people who can't afford to have a deal go bad and tarnish their stellar reputation. They also have the financial means to cover anything that could go wrong. This investment was collateralized against Dress Barn's intellectual property, including the brand name itself and customer list of almost 8 million people. Here's the negotiation for this deal. Several items were negotiated, including the ability to extend the loan past 1 year if the business was performing well, and having the intellectual property as collateral for this investment. Additionally, I am first in line to invest in any of the future distressed assets owned by the parent company, so I can invest in each of them and diversify my position and build a portfolio of distressed brands that are scaling online rather than in retail stores. Most investments don't have all these perks. The big kicker negotiated in this deal was the free equity. Rarely do investors retain equity in a company once the investment principal has been repaid. Plus, the amount of equity to be paid as a kicker is extremely high. Typically, kickers are much less, if even given at all. Let's look at this deal in review. My Lions network bought an extremely high-quality, almost 60-year-old brand for pennies on the dollar. If anything went wrong, we could sell it for an immediate profit based on the great deal we negotiated and the fact that several groups made offers on this asset, and at least one of those offers was for significantly more than our offer. Literally millions of dollars more than our offer. However, the parent company, Ascena Retail Group, liked our timeline and team the best. Additionally, the likelihood of the company failing inside of the first year when the balloon payment of the note came due was nearly impossible. We got our entire investment back, retain the free equity, and can participate in the upside of this company's growth as the operations team continues to scale its e-commerce growth. Dress Barn Women's Fashion Retailer 2024 Deal Update. Here's the 2024 update summary. We structured a one-year note with bonus profit kickers. We exited the initial investment with over 20% gains in 1 year. Subsequent unchecked expansion led to distress. Bankruptcy allowed investors to take possession of the brands. And we realized the importance of controlled growth. A while back, I invested in Dress Barn, a women's fashion brand that was acquired out of bankruptcy. The company had strong assets but got overextended with physical retail stores. My partners and I structured the investment as a one-year note paying around 20% interest. We believed the brand value and e-commerce business could thrive without expensive retail leases weighing them down. After the one-year term, we had the option to get fully repaid, extend our note, or convert to equity. Fortunately, the company executed well, and we all decided to exit, locking in our strong fixed return. Emboldened by the success, we looked at other distressed retail brands owned by the same parent company. However, this time, they expanded too aggressively without proper operational controls. As a result, they overextended themselves, and performance deteriorated. They eventually filed for bankruptcy to clean up the situation. While the rapid ascent was exciting initially, unchecked growth put the company right back into trouble. However, the bankruptcy allowed investors to take outright ownership of the underlying brands if things went well. The one-year duration of this fashion brand with bonus profit kickers exemplified finding an income amplifier. We boosted returns substantially by negotiating preferred terms compared to a straight equity investment. As I reflect on this deal, I'm reminded that even though an investment may look great on paper, as investors, we ultimately place trust in human operators to execute their strategic plans and perform as expected. In this case, because we reduced the risk and took a long-term perspective, we may eventually be in a situation where we achieve outsized returns by owning the brands and then selling them to the right buyer. Here's some key insights. The initial investment performed extremely well. We exited with over 20% locked-in returns in under 1 year. Subsequent overexpansion led to financial distress again. Bankruptcy allowed investors to take over the assets, and we learned the importance of controlled growth and proper operations.
The sixth commandment, find an income amplifier. In this particular commandment, you give the example of the Franklin Mint, which for many of us is familiar, or at least we've heard about it. Tell us the story about that.
The Franklin Mint was a company that really specialized in mail-in orders for coin collections and different memorabilia. And so they had infomercials, they sold online. I mean, this was a big, big company. And at their peak, I believe that they did over $1 billion in sales. And I think they did that for a stretch of a good number of years. So this was a legit, big-time organization. And my aunt was just the hugest collector of coins. And I mean, most of my adult life, even most of my life as a kid, I just remember her having tons of coins. She would get these collections, these different sets, and I loved them. I mean, that was what got me into collecting coins. I collected foreign coins and just all kinds of unique coins. And so I've always enjoyed that company. I've always enjoyed the idea of collectibles, certain types of collectibles, especially in the form of currency. And so this company is just kind of a neat company to have the opportunity to invest in and be able to own a piece of.
And why is that specifically an income amplifier? How does it illustrate this?
Well, an income amplifier is more going to be the terms that are negotiated. So there is a typical deal structure that may be presented. And the way that I look at it is I want something that's going to enhance or amplify my income, whether it's what's going to be paid out to me Instead of being paid at the end, maybe it's paid monthly or quarterly. Maybe it's negotiating or having a higher interest rate that's being paid, or maybe it's negotiating some sort of split on the revenue. There are a lot of different ways to get an income amplifier. I'm just looking to find a way to increase the return that I'm going to get on an investment.
And what are some of these bonuses or amplifiers, and how do you get them? I mean, are these things you have to ask for, or do you look for them on the front end?
Well, generally, they're things I ask for. Sometimes people will make offers and say, here are the deal terms I'm thinking, and, this is it. Sometimes it's a take it or leave it thing. Sometimes it's a little more negotiable. But generally, I'm looking for something that's just going to get me a better return. And so something I also like to do is I like to stack the amplifiers. So there could be many different ways to kind of wind income amplification into one deal. So, I talked about having some, extra distribution. So it's on a regular basis. Maybe it's monthly instead of quarterly. One of my favorite type of income amplifiers is negotiating some sort of a revenue share. I love earning a piece of the total revenue or total sales that a company earns. That's probably one of my, if not my number one favorite negotiation.
Justin, based upon that particular deal, it sounds like you had several amplifiers. Is there other ones available as well?
Yeah, so I'm going to try and get as many as I can. That's the goal. Again, I want it to be good on both sides of the equation, but I really want to take care of my investment and make sure that if I'm going to have the risk and expose, some capital, that the return matches a profile that I'd like to see. So in that case, we were able to negotiate a 20% kicker or a cash bonus, on it, which basically just means at the end of the note. So in this particular one, it was a 3-year note, and the 3-year note said that we would get a minimum of 2x our investment. So we'd get a rev share of monthly distributions, and once we hit 2x, then that rev share would stop. But it could happen sooner than 3 years. So if the company does well, it might not take 3 years. So we have a guarantee at 3 years. We actually have, in this particular deal, collateral of a holding company with many other brands that are way more valuable than this particular company. So I feel real good that if anything goes wrong, that's collateralized. Meaning we have rights to, getting our return based on having a larger asset in play that we would have access to. And but if this goes better than planned, which I think that it will, then we could get paid back in a couple of years. We could get paid back even sooner than that. And so at the end of the term, though, whenever it ends, we've negotiated an extra 20% bonus on the original investment that we made. So this return has multiple income amplifiers, and if everything plays out like I believe that it will, it's pretty de-risked, but the upside is really high. And so this would be another deal where I talk about, with my private clients and my lions, I talk about asymmetric risk reward. And what that means is I want there to be a protected downside. So the opportunity of losing money is not good. If we were to lose any money, it wouldn't be everything. It would just be a little bit. But the upside is so big that what's likely to happen, and especially if there are multiple deals like this, you only have to have one deal hit and all other deals could lose, and you're still going to make a tremendous amount of money. And so that's the goal, is to have such good income amplifiers and to have so many of them spread out to diversify your risk that you could have only 1 of 5 make it, but the upside was so high that it covers all of your losses. But I like to protect the downside so much that what is most likely to happen is the majority of them make it and there's upside.
Gee. Talk about the sidecar agreement, because that is a new concept for a lot of listeners.
So I love the sidecar concept. And what that is pre-negotiating terms. And so with groups that I've done a lot of investments with, or if I have a bunch of investors that I'm bringing to a deal, it gives me leverage. It gives me the ability to say, hey, I'm helping you guys out, and I'd like to have you help me and my group out by giving us preferred terms. So what do these preferred terms look like? Well, it could be a reduction in the management fee. It could be a reduction in the carried interest that they will earn on the entire investment. It could be a lowered minimum. It could be access to co-investment opportunities that other investors are not able to get. It could be access to future deals that no one else is going to get access to. There's a whole slew of different things that can be negotiated, but those would be examples of terms that you might find in a sidecar agreement. So often with my investment club and investment group, I will bring, and especially my mastermind, I will bring people into these deals, but we will already have preferred terms, so we're coming out of the gates way ahead. It takes a lot for us to lose money in this situation because right out of the gates, we're already so far ahead.
And is this all because you mentioned you're the first money, or is that the goal, that you are the first people to come to the table?
So I love being the first person. I like when groups and organizations come to me and say, hey, we wanted to let you know about this deal first because we can move quickly. You know, I'm happy to make an investment, especially with a group that I've done work with where they have good returns, they've got a good track record. So to me, it's not as important to be the first money to the table necessarily. I just want the opportunity to be in deals and have the first look before other people sell the deal out or fill the deal up. So when I talk about that first mover negotiation, I just want to know that I will have access to whatever the deal is. I'm okay not being the first money in. I just don't want it to close without my investment or my group's investment. Commandment 7, plus the deal. You can't put a limit on anything. The more you dream, the further you get. Michael Phelps. In the previous chapter, I opened up with, but wait, there's more. Every income amplifier is an extra bonus. Now, I'm going to show you how to finance a deal and the bonuses with extremely inexpensive and safe money. In the world of marketing, this strategy is called selling money at a discount. The last chapter focused on negotiating income amplifiers into a deal, which is a great way to increase the return on any investment. Technically, you can have a great investment without having any income amplifiers, but I get at least one and often multiple income amplifiers on most of my investments. This chapter focuses on another round of additional negotiations that may come in the form of extra income amplifiers, additional protections on your risk, or often both. These additions may happen close to the start of the negotiation or in the final hours before signing a contract to finalize an investment. The myth of a done deal. There is a myth that once you've negotiated a deal, it's set in place. The bottom line is that the deal is not done until the contract is signed. Until that happens, you still have room to improve the overall investment terms. I don't look at deals like others do. Anytime I see an opportunity, I like to take advantage of it. If I see that a company has the ability to make more concessions, or if I haven't at least attempted to ask for something I may not have thought of in the first round of negotiations, I've got no qualms about asking. They can always say no. Sometimes when I ask, they're not in a position where they really need to raise money and are just playing a little offense and trying to get ahead of the game, so they're not receptive to further negotiations. But oftentimes, I'm investing in a situation where they're in a distressed state or at least in a more urgent state, and they have a set time frame for when they need to raise the funds, and they're often willing to make some concessions. I constantly negotiate a deal until I feel comfortable with the terms and feel like my risk has been properly minimized or totally mitigated. A 2-for-1 deal. I'm going to give you a 2-for-1 deal with the added benefit of having no risk. Here's how it works. I use a specially designed whole life insurance policy, much different than off-the-shelf policies, to finance my investments and operate like a bank, but with much better terms, as I discussed in the previous chapter. I use this same bank replacement strategy, taking loans against my whole life policy to earn multiple returns on the same money. I use this strategy to invest in Dress Barn, as well as all my mobile home park purchases to date, all of the operating companies I have invested in, more on this at the end of this chapter and in the next chapter, and many other investments as well. Note, not all insurance agents are created equal. Not all life insurance policies are created equal, and not all life insurance companies provide the services I'm about to describe. The life insurance company that you want is one that uses a non-direct recognition dividend structure. What that term means is that the company will pay you the same dividend regardless of whether you have a loan against the policy or not. Most insurance companies use a direct recognition structure and pay a lesser dividend when you take a loan against your policy, which can still be good if you're earning enough of a return to create an arbitrage, but nowhere close to the arbitrage of a life insurance company that offers non-direct recognition. Often, with direct recognition, an arbitrage is negative, where you can actually lose money on that transaction. So be careful which company you choose. People in general only think about life insurance for its death benefit. They pay money, die, and give their beneficiaries some income. A properly crafted whole life policy, however, can offer you many living benefits you can utilize. The truth is, life insurance is the single greatest asset protection structure that exists. Many people think trusts are, but if you look at all the case law, it is evident that life insurance is the single greatest way to protect your assets from creditors. Additionally, life insurance is a vehicle that allows your money to compound with tax-free growth and tax-free distribution upon retirement, not to mention you also have a tax-free death benefit to your heirs. You can have a policy from a top-performing life insurance company that generally pays around a 6.5% dividend each year with a guaranteed minimum return typically of 4%. Top insurance companies are currently paying dividends of 5 to 7%, which after subtracting costs associated with the life insurance, the total internal rate of return, or IRR, is typically paying 4 to 6%. These returns in life insurance are actual rates of return, not an average rate of return, as was discussed earlier in the book under myth number 1. So unlike other investments that promise an average return of 10%, like a financial advisor pitching an investment in the stock market, this is an actual rate of return. It's a real number and not manipulated, so the return is the return, consistent year in and year out. Back to the 2-for-1 deal. If you can find a great investment opportunity like the ones I've described for you in this book, you can borrow against your policy, which is used as collateral, with flexible payment terms and an interest rate of around 5%. If you come upon hard times, you can actually choose not to pay back the loan, and the policy will still perform well, just not as well as if you paid back the loan. And whenever you die, the insurance company subtracts the loan amount from the death benefit so it doesn't become a burden to your beneficiaries. Use an arbitrage. Let me give you a real-life example of how I use an arbitrage as a strategy to plus a deal. I used my whole life policy when buying my first mobile home park. I took the same money I would have invested in the mobile home park, invested it in my whole life policy first, and took a loan against that policy to invest in the mobile home park. The result? I earned 2 returns with the same money. Why wouldn't I want to earn 2 returns instead of 1, especially when one of those returns is guaranteed? Whole life insurance has a minimum guaranteed return offered with most policies, but many pay more than that minimum through a dividend. Each year, the insurance company assesses how well it performed on its investments and pays whichever is higher, the minimum guaranteed return or the dividend. This dividend, however, is unique in that it is actually considered a return of capital rather than a distribution that is typically taxed. So, this dividend is not taxed. I made a 36% cash-on-cash return in the first year on my first mobile home park investment, but I also received a 6.5% dividend on the same money, which was still in my whole life policy since my down payment on the mobile home park was just a loan against my policy. As I mentioned earlier, there are some costs to having life insurance, so let's use an IRR of 6% to factor in those costs associated with paying a 6.5% dividend. In total, I earned a 42% return on my money, 36% plus 6%, which I used to repay the loan against my whole life insurance policy, and then repeated the process with the next mobile home park investment. That second deal netted a 54% cash-on-cash return. So when I added in the 6% IRR that I earned on my whole life policy, my total return was 60%. Look for investments that allow tax-free growth. This is the best type of growth that exists. These vehicles allow your money to compound faster than any other vehicle. Nothing interrupts the compounding, so these returns have the strongest velocity. Both of these examples have returns that grow tax-free, and because I could depreciate the mobile home park as an asset, that profit also grows tax-free. Note, not many of these tax-free growth vehicles are out there, and most of the ones that do exist have low government-imposed limits, such as a Roth IRA and a 401k Roth. A small cost was associated with this loan, which I explain next, along with my rationale for it. First, let me say that some lending institutions specialize in lending money at lower percentages than a life insurance company and will use your policy as collateral for the loan, just like your life insurance company does when you take a loan against it, saving you an additional couple of percentage points. So instead of taking a loan through your insurance company, you can instead take a loan through one of the lending institutions that specialize in collateralizing whole life policies. You can choose from a fixed interest option or a variable interest option. For the deal I just elaborated on, the fixed interest rate was 4% and the variable interest rate was only 3% at that time. So I chose the variable interest loan. It was close to the cheapest money I could ever find then, and I didn't see interest rates going up for quite some time. And whenever they do increase, I can change it to a fixed interest rate. So instead of paying the whole life insurance company 5% interest for a loan, I save 2% interest by paying the specialized lending institution just 3%. Plus, I have the flexibility of making payments that are as little as interest only, which creates a huge opportunity to generate significant cash flow. Let me illustrate how this deal works so you can see what this arbitrage looks like for you. Let's say you invest in a deal that pays 20% interest, such as one of the investments I have illustrated in this book, using the commandments, amplifiers, and kickers I've shared with you. You make that investment by borrowing against your life insurance policy, which is currently producing a 6% IRR. The interest you pay on that loan is just 3%, which gives you a total return of 23%. And I get that number by taking 20% plus the 6% IRR minus the 3% interest for a total of 23%. Let's go back to the first example I gave on the first mobile home park I invested in. That one produced a cash-on-cash return of 36%. Add the 6% IRR from the whole life policy, subtract the 3% interest, and you're left with a 39% total return. That's free money with no risk, or at the very worst, extremely minimal risk. Here's how the numbers look in real-world terms when I invested in a whole life policy, borrowed the money, and invested it into the mobile home park. This deal is an example of both arbitrage and leverage, making my money work for me in two places to earn profit twice. The deal at a glance. $65,000 in my whole life policy times a 6% IRR equals $3,900. A $65,000 loan from my policy times 36% cash on cash return equals $23,400. The 3% interest on the $65,000 loan equals $1,950. So if you add up the $3,900 plus the $23,400 minus the interest of $1,950, that equals $25,350 as a net profit and a 39% total return. What if you are uninsurable, have poor health, or have any other condition that would make your life insurance more expensive? You can take out a life insurance policy on anyone you have an insurable interest in, family members, employees, or anyone you have a working relationship with where your business would be impacted if something happened to them. The example that follows shows several ways to plus the deal where I added additional income amplifiers and mitigated some of the risk involved with this investment. This next example is for an Orange Theory Fitness franchise. Orange Theory Fitness is an extremely popular and successful fitness franchise. There are over 1,300 locations in the U.S. alone that are regularly scheduled to capacity before the doors even open. The franchise has one of the highest profit margins of all franchises, but it's virtually impossible to buy one today because they're in such high demand. Existing owners and area representatives have first right of refusal to open new studios, and private equity firms are buying up large portfolios of studios at great prices. At any given time, other franchises might resemble an opportunity like this: high demand, proven record of success, low risk, and high profitability, with operators who may be stretched to their credit capacity but have access to deals unavailable to the general public. For any investor who either has access to credit or cash, it is the perfect storm opportunity. In my case, a great opportunity opened up for me to get involved as an investor with two operators who didn't have access to enough credit but were willing to put in sweat equity. This investment opportunity involved knowing the right people and experiencing the natural byproduct of having created strong relationships, ones I reached out to periodically and stayed connected with over the years. I chose to enter into this particular deal with a couple I'd worked with in the past, and I had a great relationship with both him and his wife. They found the opportunity to invest in this organization through one of their connections, but they didn't have the capital to open it by themselves. I'd already had the privilege of advising these two small business professionals on each of their first business ventures, and we enjoyed working together. They knew I'd be a good capital partner because not only would I have the investment capital they needed, but I could also advise them, leveraging my experience from investing directly in several other operating companies over the years. We created a fantastic win-win situation for all parties and were able to get a small business administration or SBA loan through a local bank with a down payment of 16%. Here's the mindset I had for this deal. I'd wanted to get into the franchise space with a strong brand for a while. I'd pursued Orange Theory Fitness for quite some time, but because of the high demand, it was practically impossible to get a license from them. The only way to get a license was to get one from a secondary party who wanted to sell. I had several friends that were successful owners of this franchise. I had connections that were able to help secure this license and strong operators that could run and scale the business. Here's the structure of that deal. 1. Equity investment of $120,000 for the down payment. 2. 33% equity in the business. 3. Accelerated distribution schedule of 67% until the loan was paid off. 4. 33% distributions thereafter in perpetuity. 5. initial equity investment of $120,000 to be repaid within 1 year, and 6, additional cash bonus of $35,000 paid to personally guarantee 20% of the SBA loan. Here's the filter for this deal. The track record on this particular brand was impeccable. No franchise owner at that time had ever shut down, and the company was one of the fastest growing brands in the U.S. and internationally. Additionally, the systems that could be created for this franchise and the systems already in place allowed for owners to be able to automate and repeat and thus scale at a high level. The terms I got from my partners were great: low risk, high returns with monthly cash flow payments and an accelerated distribution schedule, which gave me access to my capital quickly for additional investments. Here's the negotiation on this deal. I negotiated from a minority equity position into an equal partner by contributing more capital without doing any more work. I negotiated an accelerated distribution schedule for a faster return of my investment, with 2/3 of the distributions going to me monthly until I had my full investment returned. I was able to monetize the minority portion of the personal guarantee I had agreed to do with the bank by being compensated with an additional cash bonus that was added to the accelerated distribution schedule. In the end, I only have a small 20% personal guarantee backing this loan because I was able to negotiate that total down with the bank, even though I'm an equal partner on the deal and have a much higher net worth than both of my partners. Let's look at this deal in review. This deal is a perfect example of a lifestyle investment where your money works for you. No operations or time invested, so your most valuable resource, time, is preserved, monthly cash distributions, and long-term equity with fantastic opportunities for a substantial future exit and additional franchises. The only risk for an investment such as this one is if the franchise itself had some significant brand-damaging news or took a massive hit from a shift in the current economic climate. Despite the 2020 stay-at-home measures, this investment was still profitable because of its powerful business model and brand. Additionally, I recently invested in the purchase of another operating company with these two business partners, and the location is really close to our Orange Theory Fitness studio. We have had such a great time working together that we wanted to expand our portfolio together, and I am again the capital partner, and one of my two operators from the Orange Theory Fitness franchise has started running operations for the new business, while my other partner continues to run operations for our Orange Theory Fitness studio. There have been many ways I was able to plus the deal with the Orange Theory Fitness franchise. Based on the strong financials, strength of the brand, premier location, and excellent operators running the business, it was a great investment. However, to improve the deal, I utilized accelerated distribution schedules and doubled my overall percentage paid out so that my principal investment was paid back quickly over the first year of owning the franchise. We also used the profits from that franchise to purchase another business with even better cash flow than the Orange Theory Fitness franchise. Additionally, I was able to get the bank to reduce the personal guarantee from 100% to just 20%, which really helped mitigate most of the risk in this investment. Orange Theory Fitness Franchise 2024 Deal Update. Here's the 2024 update summary. I partnered with two operating partners to invest in this franchise. We negotiated accelerated distributions to get capital back quickly, but COVID significantly impacted fitness industry revenues. There's still upside as an equity partner if we sell, but I got all principal investment returned to reduce the risk. Given the popularity of Orange Theory Fitness, I partnered with two operating partners to invest in a franchise location. We knew the demand would be there if we could secure a territory. One partner had experience in fitness, while the other ran sales and marketing. I came in as the capital partner to fund the build-out and provide strategic advice to help optimize the studio's performance. We structured the investment so I received 2/3 of the distribution until my capital was repaid, which only took about a year. After that, the distributions reverted to an even split among the three partners. For the next couple of years, the studio performed well and produced consistent profits. However, when COVID-19 hit, we faced the same headwinds as most fitness concepts and revenue declined. Thankfully, by receiving my invested capital back quickly, my downside risk was protected. While business is rebounding, we may ultimately sell the studio based on the tenant opportunities within the retail center we've located. If we sell, I would still participate in any profits as an equity partner. Despite COVID's dampening impact, I'm glad we were able to get our capital out early to mitigate risks. I plussed the deal by negotiating a disproportionate share of distributions until my capital was repaid. This reduced my risk while still allowing me to participate in the franchise upside as an equity partner over time. Additionally, I originally had negotiated a personal guarantee of just 20%, but I also negotiated for it to completely be removed after a few years. At this point, I have no personal guarantee remaining, which is another great way to de-risk a deal. As another example, by leveraging my personal balance sheet, I've secured equity in deals without needing to invest capital. I recently provided a partial personal guarantee for 3 Kid Strong Fitness locations with the same partners without having to contribute any cash. In exchange for guaranteeing a maximum 20% portion of the notes, I received 25% ownership in all 3 Kid Strong studios. Over time, I've negotiated my personal guarantee percentage down so it eventually declines to 0 while retaining the equity. I share even more on this technique of negotiating personal guarantees so they're reduced and eventually removed in Commandment 9. Despite COVID's dampening impact, I'm glad we were able to get our capital out early to mitigate risks on the original fitness franchise. Maintaining flexibility while optimizing leverage has continued to open new doors. Here are some key insights. Structuring to get invested capital back quickly reduces downside risk. COVID had a severely negative impact on the fitness industry, but commercial real estate still has promise. Aligning incentives with operating partners from the start makes all the difference. And by retaining equity, upside is still available after principal is returned.
The 7th commandment plus the deal. So I love how this is all shaping up. I mean, one commandment's pretty slick, but then you start stacking them and we really see the power about it. Let's talk about Orange Theory, because this was an example of a plus the deal. Tell us about that.
Yeah, so Orange Theory is one of the leading franchises in the U.S., and it has grown tremendously internationally as well. And so, most of your major markets around the globe are starting to get Orange Theories, and they're really building them out. And so I've been impressed with this company for a long time. I've got a really good friend that invested in a couple of these and has done very well. And I knew for a while I wanted to get in it, but there was no opening. I couldn't get in. It was all about having the right relationships here. And so luckily, there were a couple of friends and mentees that I had over the years who worked with me and trained with me in a different business. And we maintained a great relationship, and they had an opportunity to buy a license, which is virtually impossible. There's just, to get one of these licenses is just crazy. To give you perspective, after we bought this license, we got offered the very next day an offer to buy it for the same price. He came back and offered us twice as much. He came back and offered us 3 times as much. And this is before we did a thing. So this is how desirable these licenses are. This is the boom of this, fitness franchise. And my 2 partners, the 2 that became my partners, it's a husband and a wife that I just think the world of, and had always enjoyed working with them in a previous business. And one of them had the inside scoop on Orange Theory. She had helped open a bunch of studios, and the owner of a region really wanted to hook her up with a license, but they didn't have the money to buy it. And they said, well, we'd love to partner, with me. And it's just been a really great relationship, because I didn't want to run the business. I just wanted to be a capital partner. but they were excited about running it. They just didn't have the capital. So it worked great.
It's a win-win.
It was. And I just remember back to the time where I was young and I was their age, and I didn't have the money to invest in different things. And I didn't know what I know today. And that is that it's really easy to find capital when you have a good investment opportunity.
Oh, let's talk about that, because we talked recently and you said something like money finds good deals.
Yeah. I mean, when you have a great deal, the money will come to you. There's just no doubt. When I was younger, I was waiting until I had the money. And it took me a little time till I had it. And then I started making some moves. I wish I would have known how easy it was to raise money, because I would have done that and I would have started sooner. So it's really interesting here. This is a great deal. And I was happy to provide the investment capital to be able to do this deal. But I didn't want to put any of the sweat equity in. I remember when I was their age and I was ready to put the sweat equity in. I didn't have the money and I was going to work hard, and I was happy for anyone to take a chance on me. And it's fun being on the other side, being able to give that opportunity to someone else, in this case, a couple that I am thrilled to help get out of the rat race and go from working for someone to working for themselves, and to be a part of that equation and to empower them to do it. So it really is a win-win scenario. I can coach them and I can help them in the business just based on my experience, but I don't have to do any of the day-to-day tactical stuff, which they're really good at and they enjoy doing.
Wow. And how is that a plus the deal? Explain how that is a illustration.
The whole idea of plussing the deal is whenever you think the deal's done, it's not done. There's more that you can get. And so I just don't want to leave a deal on the table until I feel completely confident in the return that I can get. I don't have to fully maximize and get such a good deal that someone else doesn't get a good deal, but I want the deal to be good enough that it is worth the exposure on the risk side that I'm taking. And so really on this one, it was more of the deal terms where we were plussing the deal. So on this particular deal, I was able to negotiate with my partners for a good piece of equity on the company based on the capital that we were putting in. But I negotiated in the form of a loan. And that loan was to be repaid to me over the course of that first year. And what we did is we flip-flopped the equity ratio for the loan repayment. So for example, I was a 1/3 owner in this business, and I would get paid back as a 2/3 owner. So in other words, I own 33%, but the distributions would come out at 67% in favor of me until that loan of the capital injection, the equity injection that the bank needed, was paid back. And so I also took a little risk of partially guaranteeing that loan, and we were able to find a compensation for that as well inside of the terms of the loan repayment. And so we not only had a chance to get an SBA loan, which is a great loan, especially for protecting against
scary times.
Scary times, yeah. So that's been really beneficial for us because we have a loan that we haven't had to pay for 8 months, and that's been amazing. You know, it's given us enough cushion and space that we're able to be profitable right now as we're ramping back up, and that is a good peace of mind.
Wow. So what I hear you saying, Justin, is that while some people are waiting for the deal to just get done so that they can move on, you actually get excited and start doing creative planning, thinking. You think about how to plus the deal, and that's actually, I can just tell it on your face. You're actually excited at this phase.
Yeah, it is truly exciting, and it's a joy to try to structure things in a way that really makes sense. And again, I want it to be a win-win scenario. And in this instance, with these partners, I mean, we're partnering up on another deal. And I think it's great that we have the opportunity to do that and that they are excited to come back to me for another investment. because our relationship's so good and so strong. And so I'm not doing things in a way that it really puts someone out, but I can structure it in a way where people are excited to do it because I can still give them what they want while making sure that I get what I want. So again, it is a win-win scenario, but I just don't want to leave the deal until I feel like my upside is where it needs to be and that my downside is protected as much as it can be.
And banks seem to play with this. I mean, the bank was excited to talk about these things.
Yeah, so the bank has their own parameters that they work in, and sometimes, you've got to get creative with banks. Banks often don't like to get creative. So, you've got to do a little work there with them. There's generally just a conventional way of doing things, and they want to do it that same way. But if you work with the right people and if you have the right relationships and if you can kind of provide them with a story so they see how they're going to benefit and how they will come out ahead in this deal and how it's very little risk for them, you can get them to move more than what most people think you can get them to move. I've had some banks do some pretty crazy non-standard deals, terms, adjustments, structures, you name it. I mean, some of the mechanics that I have in place, people laugh about. They're like, how on earth did you do that? One of the mechanics I have in place with one of the businesses that I started, we raised a Series A money, and I was able to put a put option in place on the investment that I had, which basically gives me the right to, it's a way to de-risk the deal. This is something that I use in the second commandment as well, where I want to make sure that I'm protected as much as possible. So if anything goes wrong, I can negotiate this put option, which means I can take my money out at any time for any reason if I don't like the direction that the deal is headed. And so I do that to de-risk it. And I did that with this company, and the VC that came in and did the Series A is like, we have never seen this before. I can't believe we're even going to agree to this, but we're going to agree to it. And so I was able to get a put option through on a Series A investment and participate in the upside of that liquidity event when none of the other investors were able to. Commandment 8, cut out the fat. Beware of little expenses. A small leak will sink a great ship. Benjamin Franklin. How do you feel when you find out you've overpaid for something? Let's say you go out and buy a ring at a nice jewelry store for $7,000, and then you go to Costco and you see that same ring for $3,200, except it's bigger and of higher quality. If you're a collector of rare or treasured items, you know the value of a highly connected person who searches far and wide, makes phone calls, finds what you want for you, and saves you 40% on a deal. You'd gladly pay this person a healthy commission and probably an upfront fee because of the value of this service. And you'd go back to this person again and again. You value the relationship you have with this person on multiple levels. Let me apply this story to the world of investments. First, let's look back, then a look forward. You've listened to the previous chapters and know about many of my investments. For my first 3 mobile home parks, I did the deal without a broker, and I did seller finance for part or all of the purchase price. At that time, I had more time than I had money. I sourced the deal, took my time to negotiate terms, and by cutting out the broker, saved myself a bunch in fees and commissions, all of which translated into an extra $100,000 in my pocket. Through seller financing, I was able to negotiate a small down payment of 15% at 5% interest for 10 years, enabling me to have immediate cash flow and net profits before improving the asset and increasing rents. Best of all, the loan I negotiated was a non-recourse loan. So the worst thing that could happen if the investment didn't work out or I fell upon hard times was that the seller would receive the asset back and my inability to make the loan payments wouldn't affect my credit score. If I'd used a bank, I would have had to guarantee that loan with personal assets, and the default would have negatively affected my credit score. Later on, when I had more money than time, I learned to use middlemen and brokers to my advantage. I was happy to pay them a fee to save me the time from doing what I did in the first portion of my career. The relationship resource. Here are a few points on the resources you can use in making great deals when you have money and you wish to preserve your time. 1. Great brokers will bring you deals you don't know about and introduce you to a network you don't have access to, which will save you decades of time. 2. Great financial advisors and insurance professionals can introduce you to financial products you've never thought of or heard about because they're obscure. And 3, great bankers and financial institutions will introduce you to financial vehicles and instruments that are equally obscure and inaccessible without their connections. When you find these resources, you add the highest quality, precision tools of all to your investment toolbox: relationships. When combined with your other tools, they can give you access to big deals, more leverage, better terms, and ideas and concepts that you'd never learn anywhere else. This entire book and all the tools I've exposed you to have taken me over 10 years to acquire. I've invested close to $1 million in my personal growth and paid hundreds of thousands of dollars in legal and professional fees, education, training, and coaching. These resources have helped me create an investment portfolio in the tens of millions of dollars. That outcome wouldn't have happened, however, if it weren't for the fact that I've cultivated a league of superheroes who can tackle almost any opportunity or deal. Parasitic middlemen. In all relationships, some are healthy for you, and some are just not. The same is true for investment relationships, so be cautious. Look for relationships that are amplifiers or partners in business, not parasitic middlemen. The fastest way to make money is never to spend it unnecessarily in the first place. Costco, Sam's Club, and Walmart all figured out how to cut out the middlemen and keep more profit, generate more volume, and give their customers more products for less money. Amazon figured out how to cut out the middlemen and get their products into your home in under a day. I had to learn, and you will too, the difference between a relationship resource and a parasitic middleman. When you cut out the parasitic middlemen, you become a powerhouse. You win. Let me give you a list of the biggest sources of business parasites that add fat and cause discontent. Sources, not resources, that cost you money and can create unprofitable deals due to fees and commissions. Financial advisors, brokers, insurance salespeople, fund managers, general partners, money raisers, banks and financial institutions. In general, all middlemen. Disclaimer: I love many of the professions I just shared with you if the terms and agreements are structured correctly. I have many friends who are financial advisors, brokers, lenders, and insurance people who do great work on behalf of their clients. But not all financial advisors, brokers, lenders, and insurance salespeople are created equal. How can you discern fat from muscle? Here's my time-tested, cut-out-the-fat toolkit and system that creates dividends and income without exception. Use each of these tools to unlock the best deals and avoid the fat. Cut out the fat. Number 1, do they win when you lose? Brokers and financial investments have hidden fees, and many mutual funds, 401k plans, and insurance policies are loaded with excessive fees, fine print, and exceptions that leave you holding the bag. These professionals are getting new cars, bigger mortgages, and boats without you knowing how they're getting paid. Opaque deals never work in your favor. Number 2, do they have skin in the game? Find partners who will do performance-based deals instead of fee-based services. An exception is if you're working with fiduciaries, for example, professionals with decades of experience who charge a simple fee for services and are completely transparent on any commissions or additional fees they receive. In the financial services industry, the vast majority of financial service representatives, agents, and brokers are not fiduciaries. They don't have to make decisions that are best for their clients, and they actually make decisions that are best for themselves. Legally, all they have to do is provide you with a product that is suitable. That extremely low standard is not one to subject your financial future to. Only a small percentage are actual fiduciaries, which is disturbing. Number 3, do they practice what they preach? Would you trust an overweight nutritionist or personal trainer? The same is true for your financial advisors. Do they invest in the things they're selling you themselves? Or are they offering it to you because there's an extra commission on that particular product? Do they even invest? What's their history? What's their net worth? Look for congruency and character in the people you trust with your money. Number 4, where can you save time or money? What's more important and valuable to you right now, your money or your time? Your answer may change depending on where you are in life at that moment and will determine how and where you can cut out the fat. Let me share an investment nightmare story. In the financial world of Wall Street, brokers and financial advisors are taught to use the term average rate of return. Imagine for a moment if someone came to you and showed you the following. Year 1, you lost 50%. Year 2, you gained 50%. Year 3, you lost 50%. And year 4, you gained 50%. What do you think the average rate of return would be? Most people would say, at a glance, that you have a 0% average rate of return. But let's plug in some real-life numbers. We'll call these Wall Street numbers. Let's pretend you invested $100,000. Year 1, you lost 50%, which means your account has $50,000, not including brokerage fees. Year 2, you gained 50%, which brings you up to $75,000 because it's half of what was left. Year 3, you lost 50%, which brings your account to $37,500. Year 4, you gain 50%, which brings your account to a total of $56,250. That's a negative 43.75% rate of return. The reality is, your account total would be even lower because you paid brokerage fees, hidden fees, and were subjected to other shenanigans along the way. What makes this a terrible deal for you is that your financial advisor gets paid no matter what. That financial advisor and the executives at Screw You Financial have brand new Bentleys and they're sending their kids to private schools on your money. Sometimes brokers save me time, money, and energy. When that's the case, I'm happy to pay them a fee or commission. When they're not doing that, then they should not be entitled to that money. If they're offering me value, I will gladly incentivize them. But if they're offering me something I can do myself just as well, why would I include the added expense? It may not make sense for me to hire someone else to do something that I'm already able to do better or faster. Conversely, if they have more expertise than I, hiring them allows me to do the main things I'm good at, and I'm happy to pay for their services. Remember what I said about a fiduciary? That's the kind of relationship you're looking for. Having some experience or partnering with someone who knows how to ask great questions will make and save you a fortune. Skin in the game. Here's an example of skin in the game. It's more detail on the example in the previous chapter. As I mentioned before, I invested in an Orange Theory Fitness franchise because former coaching clients brought me the deal. They didn't have the money to do it, I did, and I didn't have the time, they did. They were happy to provide all the sweat equity. For them to have skin in the game, they invested their entire life savings of $15,000. It was a comparatively small amount to my $120,000 investment, but it represented everything they had, and it was their sole opportunity to get out of the rat race and become entrepreneurs. In this situation, I have long-term equity, and my partners have a vested interest in the success of the organization. And from my point of view, because they committed their time and resources, the work ethic they bring to the operations practically guarantees success. I also drew from my large network of advisors and professionals because my partners didn't have the money, time, or expertise to pay for or build those relationships. It was a win-win-win. Unnecessary fat. Here's an example of cutting out the fat. Earlier in Commandment 5, Create Cash Flow Immediately, I shared my story of acquiring my first 3 mobile home parks. I had a tremendous amount of success with my first 2 parks, and the third park was the investment that would allow my passive income to exceed my earned income. The first 2 parks were purchased with seller financing, but the third park was a unique situation. It was an invisible deal because it was an off-market deal where the buyer cold called the owner of the property to see if he would sell the park. The 2 parties signed a contract. They avoided the unnecessary fat of a broker or realtor. I have a strong network of business professionals, experts, and friends. In this case, the buyer who put the park under contract was a good friend of mine. He decided he didn't want to purchase the park, so he asked me if I wanted to buy it instead. I liked the property and decided to buy the assignment from him, so I was able to get a contract without paying a broker or realtor. An assignment is when someone has a property or asset under contract for purchase, such as a purchase sale agreement or PSA, but instead of closing the transaction, they decide to transfer the rights of the contract to another person. To put it simply, the buyer has the right to execute and close the agreement or assign it to someone else. And once the contract is assigned, that assignee assumes all the terms of the contract. In this instance, the seller had no say in who bought the property because they are bound to the original contract, not the original buyer they were under contract with, and the contract has language allowing assignments. All of the contracts I use also allow assignments. I had several professionals vet this deal, all of whom loved it. Also, my friend had already done a tremendous amount of due diligence on the deal, so there wasn't much work left for me to do. So I proceeded and bought the assignment for $20,000 from my friend. I was happy to give my friend a finder's fee for all the value he added by doing all the work to find and vet the park, and I was also happy to incentivize someone who enabled me to get the deal without having to do all the work myself, in essence, buying my time back. Additionally, if I had gone through a broker, I would have paid at least double the amount I paid my friend as a finder's fee. It was a win-win for my friend and me. There's more I want to point out about this deal. My friend did a great job negotiating a really good deal on this park, but as you know from the previous chapters, I have many strategies I use to get an even better deal than most. I went back to the owners of the park and renegotiated additional terms, and I was able to lower the purchase price by over $100,000. I was also able to get them to agree to sell me all the personal property associated with the park, including mobile homes and tractors and their massive shed lined with tools, for an additional $50,000 discount. So all in all, I reduced the total sale price by over $150,000 on what was already a good investment. A big myth is that there's really only one way to invest, and you need to use a money manager and exposure to the stock market. I'm not saying those are bad things, but they're not the only things. Having some stock market exposure can be good, but I wouldn't put all my eggs in one basket. I like to be diversified, and I also like to have a little more control and influence on the majority of my investments. To the best of my ability, I want to cut out all middlemen so my family and I get the profit, or I split the profit with my partners. Alternatively, if they perform well, I make sure the middlemen get some profit that they typically don't earn. If someone earns it by directly adding value, I'm happy to pay for it. I've worked with a number of great brokers, and I'm happy to pay their fees. But if I can avoid a financial institution and go with seller financing, I'm going to take that option every time. If I can invest in a way where I don't have to pay a percentage to money managers who make money whether I make money or not, I cut that out as well. Profit from knowledge. The secret to cutting out fat is knowing what questions to ask and when to ask them. You learn this by making mistakes over decades or by investing in a coach who can save you precious time in hundreds of thousands or millions of dollars. Mentorship is the perfect shortcut. In general, if you look at the fees paid on any account for money that's being professionally managed, you'll be surprised to learn what is being charged. When a much larger part of my investment portfolio was exposed to the stock market and I had someone actively managing it, I recall looking at my statements and feeling like I was punched in the gut. It said that I had an average rate of return, which was 7%. I thought, that's cool. I should have made some good money with such a strong average rate of return. But when I dug in a little deeper, I realized I actually lost money. My actual rate of return was different than my average rate of return. I actually lost money with a positive average rate of return. Even though the average return over the previous 5 to 10 years earned a positive percentage, a down year somewhere in that stretch of time caused me to lose money. Just because other years had a high percentage and averaged out to make my overall average return percentage look good didn't mean I was actually making money. I had that eye-opening experience and it felt like I had been duped. I felt like I had been misled. The information shared with me really made it look like I was making money. I felt totally deceived. That is when I first learned what a tremendous amount of misinformation and manipulation are the norm in the financial services industry and conventional investment world. At that point, I realized that people in that world are really looking out for themselves more than they are me. Worse than that, I saw that the person who managed my money still made money even when I lost money. Those bits of information didn't sit well with me. That moment was a turning point in my investment career where I decided to take matters into my own hands and get serious about my financial education, and I started investing myself. Profit from relationships. Besides learning how to cut out the fat, it's really important to be intentional about who you are spending time with and focus on spending quality time with people you admire most and want to do life with. You really become like the people you surround yourself with, so it's important to choose those relationships wisely. Personally, I enjoy meeting new people, and I spend a significant amount of time meeting with other investors and entrepreneurs. Talking to investors and business owners is where I learn new strategies that I'm able to employ. Besides meeting new people, I'm also part of several investment groups. I want to meet like-minded people, but I also want to meet people who think differently than I do, people who play the game of life at a higher level than I do. I'm constantly challenging myself to rise above the status quo, to hold myself to a higher standard, to challenge myself to continue to grow both personally and professionally, and to level up my game on a regular and consistent basis. By the latter, I mean finding ways to get better at what I do through mentors, peer groups, books, and podcasts. Being intentional with these relationships also helps me when I mentor and advise business owners and entrepreneurs. I'm able to show up with years of investment expertise I've tapped into through relationships I've developed over time. I combine and share that expertise along with all the reading, studying, and hands-on experience I've gained independently. In other words, my insatiable desire to learn and grow and my passion to share that knowledge with others combine in ways that profit everyone. My approach to investing translates perfectly in the next couple of investment opportunities I'll discuss. The first one is about investing in operating companies in general. The second one focuses on a specific investment in a portfolio of software companies that already have some strategic buyers in place courting them. Operating company investments. The next example is one most people have never considered investing in, and even if they had, they likely wouldn't know how to structure such an investment. Hidden in plain sight are tons of income multipliers. What are they? You can make a lot of money investing in businesses with little or no capital by increasing the value of that business and get paid while you do it. When the business sells, you can get a huge payout that multiplies your income. Once you start investing and seeing deal patterns, finding income multipliers by solving problems becomes easier and easier with a combination of your experience, network, advice, and relationships. You can walk into a deal with a little bit of cash or access to capital, a great team, an amazing network, and your experience. With you and your expertise on board, the business can increase its revenue, profit, and desirability to be acquired. Everyone wins. After time, you can make money over and over again with little personal effort. Additionally, the money you make on these deals can be negotiated and structured without a broker, fund manager, general partner, investment advisor, or financial institution. You can use these professionals when it makes sense, and you can also reduce expenses when you invest directly into a company without using these professionals. Here's an example of investing in operating companies. I've had several examples of investments in operating companies from the last 10 years that you can use to model deals for yourself. Some are companies that my friends own, and some are companies owned by people I've never met who have heard about me through word of mouth. An operating company is any business that produces goods or services and has regular operations, revenues, expenses, and a team, even if it's just a one-person team in the beginning. An operating company is different from a holding company that just owns assets of operating companies. The size of the operating companies I invest in generally range from small to medium-sized businesses with gross sales of $500,000 to $30 million, although I've had a few much larger as well. Each investment is unique, and each company has different needs, so there is no consistent investment amount or structure. Sometimes the businesses just need some sort of loan to help scale the company and hire more people. Other times, they would like some advice on how to scale, manage a growing team, hire high-level executives to help run the company, create a hiring and training process, create additional systems they can implement, improve and innovate their advertising and marketing efforts, and other challenges. Though no deal is the same, I have a standard framework I use for each of these investments. Here's my mindset on this type of investment. For years, I've been investing in operating companies, and I've also consulted and advised some of these companies on how to scale. I'm constantly reading business books and talking with other successful entrepreneurs about creating standard operating systems, or SOPs, scaling, and utilizing unique structures to fund growth. I'm always sharpening my axe and reinventing myself to offer the maximum amount of value for anyone I work with. Often, people work with me just to gain access to my network, which I'm happy to offer. I think it's a good idea for most business owners. At this point in my career, my favorite deals revolve around just giving a loan with some additional kickers and connecting the business owners with my network of professionals and experts so that they can scale their company without even needing any of my time. This way, my capital can work for me and I can earn a great return while enjoying the lifestyle I have worked hard to create. I love earning a great return, especially when it doesn't involve any of my time. Once you begin, your network and value will grow at an exponential rate as well. Here's a typical operating company deal structure, though the terms vary based on the investment. 1. A 2 to 3 year loan at 8 to 15% interest. I always like to give my friends an amazing deal, which is why I have a much wider range with a lower starting point on the interest rate. 2. Interest-only payments for 1 year. I can be flexible here, but I want to create a comfortable loan repayment for the businesses I invest in. 3. Principal and interest payments for the rest of the loan term. 4. Monthly payments for the term of the loan. 5. Loan collateralized against accounts receivable, real estate, inventory, equipment, intellectual property, stock, and other assets which are worth significantly more than my investment. In the case of a liquidation, I know I can get my investment back. 6. I also often have them sign a personal guarantee to secure the loan. 7. In some cases, instead of a loan, I negotiate an equity investment with an accelerated distribution schedule to get principal back over a quicker time frame with monthly distributions. 8. Top-line revenue share of 0.5% to 10%, depending on how involved they would like me to be. 9. Equity of 0.5% to 10%, depending on the scope and responsibilities they request. Next, let's discuss the filter. Some of these companies had been in business for over 20 years at the time I invested and had a strong track record of consistent revenue and profit. On these investments, my downside is still really low because many of these companies are consistent performers. They just aren't necessarily growing or growing at the rate the business owner wants, and the odds of maintaining their current production or growing that production are very high. I like investments where I can cap the downside risk, but have the opportunity to also participate in a big upside return. Let's discuss the negotiation for these types of investments. Most of these deals don't involve too much negotiating because the business owners come to me through referrals and already know the terms I used with other business owners. There is always still some element to negotiate, though, especially when entrepreneurs want more than just a loan. Sometimes I structure revenue shares on the gross income because I prefer terms that provide monthly cash flow over the life of the business. Other times I structure equity in the company, especially if there's plenty of opportunity for distributions or the company has the potential to grow quickly with an extremely high valuation in the future. Sometimes we agree to both a revenue share and equity. I also know that I can get in a senior debt position with the first lien on that asset to mitigate some of the downside risk. Again, I am in the safest position and will be the first person to be paid back, which is the most important position to be in when investing. In Commandment 1, Lifestyle First, I talked about hard money loans, which is another example of being in the first lien position. My goal is always to create a win-win scenario between a business owner and me. Let's look at this deal in review. In the land of the blind, the one-eyed man is king. What that proverb means is if you walk in with some experience doing deals like these, word will spread and soon you'll get requests to help other business owners. The more deals you do, the faster you'll grow your value and gain experience, which gives you more leverage. Every business owner becomes a mentor to you. The feedback I often get from business owners, business partners, and entrepreneurs is that the loan or investment I gave them was helpful to scaling their business, but my advisory capacity and my network connections turned out to be far more valuable to them than the loan or investment. In other words, the connections I make and the creative ideas I'm able to share on how to scale are worth more to them than the loan or investment dollars. The way I advise and the ideas I share are unique, and the relationships I bring to the table end up becoming valuable strategic partnerships across many brands and professions. This capacity will organically and naturally happen for you too. Remember, when you're just starting out, you probably have more time than money, so the fastest way to cut out the fat is by doing a few more things yourself. That's what I did when I first started, because time was a lot less expensive than money. Also, in every situation, you want to understand how people get paid so that you can negotiate in a way that requires the other party has skin in the game or risk and is providing as much value as possible. Finally, keep in mind that the biggest mistake new investors make is not asking enough questions to find out where the fat actually is and how everyone makes money. In my experience, the best thing you can do is ask a lot of questions, find out where the fat is, and negotiate a deal where vendors, brokers, and bankers only win when you win, and they only get paid after they fulfill their promises. Once you start making a lot more money and have more assets, you'll find that you're willing to pay a little extra to work with these experts in some deals because you can do even more deals, which more than makes up for the increased expense. In addition, the sizes of the deals you'll be doing will get bigger, and you'll have partners and employees who will give you leverage so you can continue to remain profitable while protecting your time. Investing in Operating Companies 2024 Deal Update. Here's the 2024 update summary. We invested in an accelerator providing startup portfolio diversification. We had favorable terms and milestone warrants provided for upside. There were revenue and equity structures to avoid unnecessary fees, and early traction signals promise across several companies. Over the last decade, I've enjoyed partnering with a range of promising operating companies across multiple industries. My involvement ranges from pure capital provider to an active advisor and network connector. I like to structure these investments with debt or equity up front and additional revenue share and equity kickers once key milestones are achieved. This optimizes my return potential while incentivizing the operating team. Recently, I invested in an accelerator platform that provides exposure to over 200 amazing startups. We receive equity up front in each company at favorable valuations. As the companies hit growth milestones, we have the right to invest more at the same valuation through warrants. This provides built-in upside if the startups succeed, while our downside is protected if they languish. Though early, multiple portfolio companies already have tremendous traction. The platform's robust deal flow and rigorous vetting also provide built-in diversification. Importantly to note, this platform plans to invest in at least 800 more companies, bringing the portfolio to at least 1,000 startups total. Our investment includes all new companies the accelerator platform backs going forward. Overall, this accelerator has proven to be a phenomenal model to participate in the growth of emerging companies while mitigating risk. I'm extremely energized by the early signs I'm seeing. In fact, I've invested in another accelerator where each of the first 11 companies has awarded us free warrants. Rather than a portfolio model, this accelerator creates a new fund for each startup cohort. Rather than solely invest capital, I cut out the fat by structuring revenue and equity shares. I avoid unnecessary middlemen fees this way while incentivizing my partners to build valuable companies. Here are some key insights. Invested in several accelerators providing diversified emerging company exposure. Favorable upfront valuations reduce downside risk. Milestone-based warrants allow upside participation if companies grow, multiple portfolio companies showing exciting early traction, and the accelerator model simplifies startup vetting and provides inherent diversification. The last example I shared was more of an overview of the way I invest in operating companies, not just one, because each investment is different and the terms vary. Here, I want to walk you through an example of a specific company I invested in and some of the unique terms I negotiated. This company has a different structure than the last example, but the deal still incorporates most of the other commandments covered in this book. If you ever have an opportunity to invest in an operating company like this one, you'll have more options of what to look for and how to structure the investment. Let me explain my mindset for this deal. I invested in a company that is an incubator for software companies and strategically invests in equity positions in those companies. An incubator is an organization designed to accelerate the growth and success of entrepreneurial companies through an array of business support resources and services offered at below market prices. This company's specific niche is SaaS companies, or software as a service, which are software licensing companies. I like the SaaS industry because it has some of the highest multiples on exits in the business world. In this context, a multiple is a performance measurement found by a simple calculation of multiplying a specific item on the financial statement by another number to determine the total value of the asset. Typically, multiples are applied by EBITDA, earnings before interest, taxes, depreciation, and amortization, which is one way of measuring a company's overall profit. However, SaaS companies often sell for a multiple of revenue, which means the exits are much bigger because the value is based on top-line revenue before subtracting expenses. SaaS exits can have multiples of 8 to 20 times annual recurring revenue, or ARR, or even more. Annual recurring revenue, or run rate, is the annual revenue from a business's existing subscriptions. Companies in high growth can even sell based on monthly recurring revenue, or MRR, which investors find even more predictable. The larger the run rate and current month-over-month growth, the higher the multiple. Most businesses typically have a multiple of 1 to 4 times EBITDA. So not only are the multiples for SaaS companies higher than most other businesses, but the multiples are also taken on top-line revenue as opposed to EBITDA or profit. I like having a position of my investment portfolio allocated to technology such as SaaS companies for the large upside potential. Let me discuss the structure of this deal. At the time of the investment into this particular incubator, there were 7 portfolio companies that were valued at $16 million. I was able to get a 36% discount on the valuation of the company for my investment. That portfolio has since increased in value, so that negotiated piece was a major win. I also negotiated a warrant structure of 1% per $100,000 or 0.5% per $50,000 in the parent company into perpetuity. This piece of the deal means that every time any one of the 7 portfolio companies sells, my investor group gets a piece of the action regardless of how long it takes for a company to sell. The plan was to have one of the portfolio companies sell every 6 to 12 months, so there would be multiple liquidity events. Also, I negotiated the same warrant structure on all additional portfolio companies the parent company acquires to get an ownership interest in each new acquisition for the next 5 years. For clarity, the investment in the first 7 portfolio companies is in perpetuity. It's only the additional portfolio companies beyond those 7 that are tied to the shorter 5-year term. If my Lions network doesn't earn a minimum of a 2x multiple on our investment by the end of that 5-year term, the portion of that agreement specifically related to earning warrants on any additional portfolio company automatically renews for another full year until the 2x minimum is hit. So far, 3 additional portfolio companies have been acquired and added to our investment. We were automatically awarded the same warrant structure for these 3 new portfolio companies as the previous 7, now making it a total of 10 portfolio companies in this investment, with more to be added. Let's discuss the filter here. Most of the time, when you invest in software companies or venture capital funds that invest in software companies, it is a long-term hold, meaning you likely won't see a return on your investment for 7 to 10 years or more. That time frame is too long for me to wait to get my investment back or to realize a return because I want to put that same money to work multiple times at once. For example, if I get my principal back within 2 years of each investment, I can make at least 5 different investments during that 10-year time frame with the same money while earning at least 5 different returns and potentially have at least 5 different equity positions. In this particular investment, the likelihood of an exit within the first year was really good. As long as you choose wisely and negotiate terms the way I'm showing you, the likelihood of an exit within the first year or 2 is really good for you too. In addition, there are multiple opportunities for a liquidity event, so there could be several returns over the life of this investment and possibly even on an annual basis. Let's discuss the negotiation for this deal. In order to reduce the risk, I negotiated a couple of strategic deal terms. The first was a put option, plus 20% interest. If my investor group doesn't like the direction the company is headed, we can get our investment back at any time with a 20% interest payment for the duration the money was invested. The second negotiation was a first liquidation preference so that the first exit would pay our principal investment back in full, regardless of how much the sale price was. Even if the sale was less than the amount to cover our investment based on the warrants, we have a contractual guarantee that we are first in line to get our full investment paid back before anyone else in the company can take out any money. Also, if the owner raises more money, we are still in first position to be paid. Let's look at this deal in review. I like an investment that has a big return potential and multiple exit scenarios with strong downside risk protection. This scenario is extremely friendly to the investor. Within the first year, it is likely we will earn at least our principal investment back and then have all our money out of the deal to participate in the upside for years to come. Even if only one company sells out of the 10 portfolio companies, we still make our investment back and with a good return on top of it. If 2 or more companies exit, however, we could have an exponential return. The likelihood of 2 or more companies selling is really good because already some notable strategic buyers have inquired about purchasing several of these portfolio companies. Additionally, the owner is already in discussions to add several more companies to the current portfolio. It is possible that the total portfolio could grow in size to over 20 companies that my Lions network will have warrant coverage on. If the investment doesn't perform for any reason, we can execute the put option plus 20% interest for a great return. The bottom line is, this incubator was a great investment opportunity to cut out the fat and invest in a way that the owner has plenty of skin in the game and the deal has total alignment with everyone involved, including the investors. 2024 update. This company is in the process of being acquired by a public company. Their portfolio companies are growing and expanding with multiple acquisitions in motion.
The 8th commandment, cut out the fat. Anytime we go to the doctor, we don't want the doctor to say you got a lot of fat in you. It's not a good sign of health. Why is that true with finances as well?
Well, there are all these hidden fees and marked up vehicles that are being marketed. And so my goal is to not use the things that are more expensive if I don't need to use them. So there are great people in the industry that do wonderful work, and I am the first person that is happy to sign up and pay someone if they add value. I have no qualms about paying someone to add value, but most of the time we pay fees and we don't even know it, and we're paying fees for not much value added, or in some cases, no value added, because that's just the way that the system's been for however many years.
Wow. Do you have an example of cutting out the fat?
Well, a real simple example would be instead of using a broker, for example, to buy real estate, you could go directly to the owner of real estate and buy it from them. So with a broker, you would pay a brokerage fee for them bringing you the deal. And by the way, I am happy to pay a broker's fee if they are bringing me a good deal that they have vetted that I wouldn't have found on my own. So I've got no issues with it, but there's a cost to it. And generally, not only is there the cost to them, but they're actually going to mark it up to a higher amount than probably what I would negotiate if I just worked with an owner of a property. So by going directly to the source and buying real estate from the owner directly, not only am I able to negotiate a better asking price, which is going to be lower than the broker comes in with, but I'm also going to be able to avoid paying that broker's fee for bringing me the deal. So again, that is an instance where we could go around the brokers and put in our own sweat equity to find a deal and cut out the fat. But at the same point in time, if someone's adding massive value, I'm the first person to line up and be happy to pay that fee. So I just want to share it's important to be cognizant of what fees you're paying and what fees to be avoiding.
Fantastic. What other examples do you have in your investing history of cutting out the fat?
Well, something that I really enjoy doing is with real estate, if I can get the owner of the real estate to sell me that asset and do what's called seller finance, where they carry the note instead of me going to the bank. I could pay the bank transaction fees and origination fees and whatever their percentage interest is on the loan. And generally, there's just a ton more hurdles with the bank. And then there's a bunch of reporting that's needed every year. And there are certain things written into the contract that you can't break. They're called covenants. And it's really important to abide by whatever the contract says. Well, and not to mention with a bank, there's something called recourse and non-recourse lending. Most banks are going to do recourse, meaning if something goes wrong with this deal, the bank can come after you and your assets to get repayment. And so all those things can present some risk and some additional costs. But with the seller finance deal, you can have the seller carry the note. You can pay them interest, which is good for them. That's a winning scenario, especially if they're not going to be as sophisticated as they might want to be to make that money travel further. They can be the bank. They can make a good interest rate over a long period of time. And additionally, those are non-recourse loans. So if something goes wrong with the deal, they don't have the right to come after you or your assets. They only have the right to take back the asset that you are buying.
Why would the seller ever agree to that?
Well, a seller that has a strong property and they know what they have, they're going to be confident based on the cash flow that it's producing. If you're looking at a cash flow investment, for example, they're going to know that it covers the loan. So they're going to have no concerns about what it makes. They're not, cooking the books, which is kind of manipulating the numbers in the books and the financials. So one of the reasons I like seller finance is because if someone's willing to do that, you can probably trust their numbers, But additionally, they would do it because they've run it before. So if they had to take it back over, they could do that and they'd be way ahead. They still get to keep the down payment and they get to keep whatever payments have been given over the period of time between when the loan originated and when they took it back over. So they would win in the fact that they made a bunch of money, they got the property back, they can resell it. I guess there's risk that it could be run into the ground, but they would know how to fix it because they've been doing this, for however many years. They have experience. But it's great for you as the buyer to not have the exposure of someone coming after your other assets. And that's the big thing. Because even as a buyer, if it doesn't work out, they can't come after your assets and you made cash flow for the period of time that you held it.
You start out the commandment number 8 by saying the final thing doesn't have to be the final thing. You can always ask for more. It sounds like that statement has a lot of history, a lot of experience behind it. How important are these commandments as filters for every deal you go into? Do you keep these top of mind?
Yeah, these are incredibly important to me because they work. These have provided me with real results, and I'm just not afraid to ask for any of the commandments that are in here because I know that people will grant them or will work with me on the terms that I want. So I'm not afraid to ask. The worst they can say is no. And if they say no to one thing, they'll probably say yes to something else. And I'm very comfortable with the word no, and I'm very comfortable with making sure that it's going to work for me. Otherwise, I won't do it.
Makes sense. I love how in this chapter, as well as all the chapters, you have summaries, negotiation, filtering, and then you have the mindset. How long did it take you in your investing career to adjust to the mindset of the whole cutting out the fat?
Well, this one is learned because for a while I didn't know that I could or should cut out the fat. So for a while I utilized these services and I paid high fees. And by the way, let me also say that it's still better in most cases to pay the fees and get a good deal than to not pay the fees because you don't want to pay them, but you avoid getting a good deal. So I do want to make sure that that is really clear. Now, would I rather get a good deal and pay the least amount of fees? You better believe it. So this is just one that comes with experience. It comes with learning what you're actually paying for and understanding, how everything works in the world of business and in lending and with brokers. And, it's just... It's not as complicated as it sounds, but sometimes it just takes a deal or two to actually know what you're working with.
This commandment is so cool. Do you have one more example?
Sure. Yeah. There's another deal that I bought, and this is another piece of real estate. And it was, there's something called an assignment. So when I had a friend that had a property under contract, so he had the rights to buy this property, but in the contract, it said that he could assign it and that whoever he assigned it to maintained the same rights. And so I was able to basically get an unbelievable deal. He decided that he didn't want to move forward with it. I looked at it and thought this could be absolutely perfect. And I ended up paying him a small finder's fee for this deal, but I was able to cut out the fat of brokers. I was able to cut out the fat of some different institutions. I was able to actually cut out some of the work because he did a lot of the due diligence on this property. And it was some of the best money I ever paid. So it was a low amount for a great deal that I made that money back literally inside of the first month. This one happened to be one of the largest returning, most profitable deals that I've ever done, single deals. And what is cool is he had already negotiated terms with the seller. Well, he assigned it to me. I created, obviously a relationship then directly with the seller, and I was able to renegotiate even more terms than what he had previously negotiated, which was already really good. And then on top of that, we were able to use the institution, the bank in this case, the lending institution, to be able to negotiate a few other things because the appraisal didn't come back as high as we thought it would. And I just basically said the bank wasn't going to loan me beyond what the appraisal came in at. And so I'm happy to continue with the deal if they're willing to do it. But if not, I wasn't going to go beyond that. And so they decided to discount the price and go with it because they were in a situation where they needed to sell.
Wow.
And so on many levels, this would be an example of stacking the commandments and utilizing an income amplifier and plussing the deal and cutting out the fat. But at the same time, I did pay a fee to a friend who found it, and I'm happy to do it because he added value, and I'm more than happy to pay for that value.
And I'm sure he was excited too.
He was ecstatic. It was a win-win situation. He walked away, didn't have to do hardly any work, and got a nice paycheck. And for me, I got a nice property. Commandment 9: use leverage to your advantage. Success is 80% mindset and 20% skill. Tony Robbins. I hear people say that they don't have the money to invest in real estate. That's a total myth. You don't need to have the money. I've learned that when you have a good deal, the money shows up from a variety of sources. Investors want a good deal. If you can find one, it's really easy to raise money from them. Sophisticated investors will recognize a good deal and will want in. I like using banks as a source of funds for my investments, but only when they benefit me with favorable terms. When they don't, I cut them out of my deal. In some instances where I'm buying real estate or investing in other assets, I'll use a bank. Traditionally, banks use a recourse loan, which means if I default for any reason, they can come after my assets. With these loans, you want to be careful and know what you're signing. In many instances, the asset itself is a high enough value that there may not be additional recourse. If things go south, hopefully the bank will take the asset and you can move on. Legally, however, the bank has the right to come after all your assets until they get paid back in full. If you work with a bank on a real estate deal, you can typically purchase an asset with a down payment of just 20 to 25%. It's a great way to increase your net worth and have an asset that produces income purchased predominantly with other people's money. In addition, you can get appreciation on that asset and can improve it to make even more money on a cash flow basis by charging more rent. Plus, the whole time, you've got tenants in your real estate who are paying you to rent your property. You can pay the mortgage down by using the renter's money. This is just one example of how you can have an asset grow and only have to put down 20 to 25% to purchase it, or even less if you negotiate a seller finance deal or find the right bank that will work with you. You can collateralize a loan for better terms so you don't spend as much money, and you can get an asset with intrinsic value. Because you can own it for so little down, your leverage is magnified. Another reason some people don't invest in real estate is because they think it is too great of a risk. That is a total myth as well. The truth is, they don't invest because they don't understand it well enough and haven't committed the time to learn it. I don't buy anything based on the hope that it appreciates. I buy assets because I know for a fact the cash flow starts today. Real estate investing isn't difficult to learn, especially real estate rentals. I often review the same deals people choose to pass on because they think the deals are too risky. When I do, I often realize I can get in this deal for virtually no risk and negotiate better terms because all those people who looked before me looked at the first offer someone made to them without any negotiations. In those situations, the only party who would benefit was the seller, so the buyers passed without negotiating further. A deal isn't a good deal until both the buyer and the seller benefit. I go into those same deals people walk away from and negotiate better terms that make money with almost zero risk. Success comes from how you structure the deal and how you negotiate, all with a mindset of both parties winning. The investor benefits from that asset class and gaining more equity, and the seller wins by getting a price and terms they feel good about. All parties win. Lending options. Let's discuss for a moment all the different lending options available, what risks exist with each, and how to use each type of leverage to your advantage. The first two loans are direct lending options, which means that the loan funding happens directly with the end lender. 1. Seller finance. This is my favorite direct lending option. It is much faster than traditional lending products, and often you can negotiate the best terms. This loan is non-recourse typically, which means if anything goes wrong, the lender can take back the specific asset in the contract and cannot come after your other assets. The borrower is not personally responsible for the repayment of the loan. That is a very good protection I like to have in place. 2. Traditional bank loans. I prefer small local banks because you have more negotiating power typically. These banks are looking for loans they can write and often know the local real estate market better than the bigger banks. Most of these loans are recourse loans, which means that the bank can come after any assets you have to get repaid in the event of a default. The primary options here are SBA loans and conventional loans. An SBA loan is partially guaranteed by the government, but you need to jump through many more hoops to get that type of loan, and it can take a longer time to close. Most of the loans I do with banks are conventional loans, and the length of the note usually varies from 3 to 10 years. The next two loans are secondary market lending options, which means the loans are bought and sold between lenders and investors. These are non-recourse loans. 1. Conduit loans, also known as commercial mortgage-backed security loans. These loans typically have Wall Street investment firms originating them. The loans themselves are eventually bundled and sold in the secondary market to other investors. These loans have a lower interest rate than traditional bank loans and can often offer a longer term for the note. Most of these terms are 10 years. These loans are often assumable, so if you sell the asset, someone can take over the current loan for you, releasing you from the loan obligation. That aspect of the loan can be attractive to a new buyer, especially if the interest rate is below market rates. The downside of conduit loans is the lack of flexibility once a loan is written. These loans are designed for more of a long-term hold, so you wouldn't want to use them if you were just planning on flipping the property within a few years. Also, you have several fees to consider. There are fees if you sell or refinance the property early, called defeasance, or if you prepay the loan, the fee is called yield maintenance. Often, there are fees to allow a new buyer to assume the loan. Generally, the fee to set up a conduit loan is 1% paid up front at the time of closing. 2. Agency loans. These loans are issued by one of the government-sponsored agencies such as Fannie Mae or Federal National Mortgage Association and Freddie Mac, Federal Home Loan Mortgage Corporation. These loans are also bundled and sold on the secondary market to other investors. These loans have many of the same pros and cons as conduit loans, such as being non-recourse and having a similar fee structure, but the main benefit to these loans is you can often get a 30-year fixed interest loan. For investors whose strategy is to buy and hold, these loans are very desirable. How to use debt to your advantage. Another successful lifestyle investor strategy is to buy assets and hold them forever and never sell them. If you need cash, you can just borrow against these assets and pledge them as collateral. You can pledge your real estate, your stock, and your whole life insurance as collateral, among other assets. Most people don't know that their stock can be pledged as collateral. Let's say you own $1 million of Amazon stock. Currently, you can go to your local bank and get an $800,000 loan at LIBOR plus 50 basis points, or 0.5%, for a total of 65 basis points, or 0.65%. LIBOR stands for London Interbank Offered Rate, and it's the benchmark interest rate that the global banks use to lend to each other. There is no tax treatment on getting one of these loans because they are not taxable. Let's take this example one step further. If you have $1 million of stock and need $100,000 of it to live on, you can sell $100,000 in stock and be charged anywhere from 25% to 50% in taxes, depending on your income. In this case, you could end up having as little as $50,000 left over after taxes to live on. You would actually have to sell $200,000 to be able to have closer to that $100,000 you need to live on. You would then have only $800,000 in stock left. If you sell $200,000 a year for 5 years in a row, you will eventually spend all of your stock down to zero, except for the gain it makes. In the 6th year after doing so, you are poor and need to find another way to get your $100,000 to live on. Here is a better way. Currently, you can borrow instead against your $1 million in stock and pay as low as just 1% interest or less. Let's say that you borrow $101,000, $100,000 plus $1,000 in interest, against your stock to get $100,000 to live on. In this example, since you have a loan and aren't selling your asset, you would not owe tax on the stock because you have no income or capital gains associated with it. Additionally, you can do the same for as long as the stock continues to increase in value. If the asset goes up 10% per year, then you can borrow against it into perpetuity at the amount it appreciates. In other words, if you have $1 million in stock and it goes up by 10% per year, that is $100,000 per year it increases so that you can borrow against that amount each year to live on. You can do something similar with real estate as well. If real estate appreciates 7 to 10% per year and potentially more in strong markets, you can go to the bank and refinance the real estate and pull out the debt to live on tax-free. There is no capital gain because you didn't sell anything, and you have no income from it because you're just borrowing against it. The liability offsets the asset. Plus, the real estate can be handed down to your heirs so that they can do the same thing into perpetuity and hand it down to their heirs. This example shows what every sophisticated real estate investor does. As the government continues printing more money, your real estate will continue to increase in value because as the supply of money expands, so will your assets. Let's say you have $10 million in real estate and you can borrow $8 million against it. You wouldn't want to sell that real estate because you'd pay taxes. Instead, you would keep borrowing against it for tax-free income. As you continue to refinance equity out of your real estate, besides having income to live on, you can use that same income to buy more real estate that you can borrow against and pull more cash out of to live on. You can literally never make any money your entire life if you follow this plan and live off the debt you pull out of your assets. In order for this strategy to work, you need a low-interest loan environment and a strong relationship with some good bankers. You also want the monetary supply to continue to expand so your assets continue to increase in value. You can use leverage to acquire even more assets and then borrow against those assets. Rather than generating income that you will have to pay taxes on, you can own real estate that appreciates without being taxed, ideally holding it forever, as Warren Buffett says to do. All of this is possible even if your real estate doesn't cash flow, although I prefer cash flowing assets to add even more optionality to your lifestyle and finances. You can use this same strategy of borrowing against your assets utilizing whole life insurance as well, with potentially even greater upside than these last two examples of using stock and real estate as collateral to take out tax-free loans to live on. How lifestyle investing works. This next example utilizes several of the strategies from this chapter and is a perfect example of lifestyle investing. Throughout this book, I've been using examples of mobile home park investments because they are real deals that sparked my success, have generated a lot of money, and are non-obvious investments. I'd like to illustrate this example through the lens of leverage. I'm doing this so you can see there is consistency, continuity, and discipline in the investments I've made. Once you start finding deals, I encourage you to apply the same level of discipline and incorporate all of the principles, filters, and commandments throughout this book. Let's look at another mobile home park example. This particular mobile home park deal I found by cold calling the owners close to 5 years prior to purchasing it. I developed a relationship with the owner and his wife and their daughter that helped run the day-to-day operations of the business. I kept in touch regularly over the years because I wanted to remain top of mind with them. Plus, the mobile home park was right down the street from 2 of my other parks that I owned, so I would stop by in person periodically when visiting them. I knew eventually that the owner would sell the park because he was getting older, but because he had built the park himself, he was so emotionally attached to it that it was difficult for him to let it go. Eventually, the owner died, but the family remembered me. When it came time to sell, I was at the top of their list. Let me explain my mindset on this particular deal. I love investing in mobile home parks for a variety of reasons. If you buy them the right way, they have very little risk. It's easy to get financing on them because they have one of the lowest default rates in all of real estate, which lenders love. You can buy them with any one of several options: seller, bank, conduit, and agency financing, with just a 20% down payment and great terms. These parks produce cash flow on the first day you own them. It's also easy to make improvements, which immediately increases the value and produces even more cash flow. Affordable housing will always be in great demand and is virtually recession-proof. Everyone needs a place to live, and a mobile home park is not only the cheapest housing available, but provides more amenities than Class C apartments. Mobile homes have a yard, no one above them or sharing an adjoining wall making noise at all hours of the day and night, and they can eventually have the American dream of home ownership with only the expense of lot rent, which is just $280 per month on average in the U.S. There is no housing cheaper than that. For you, there are massive tax benefits because you own the real estate. Here's how I structured this deal. 1. A purchase price of $2.7 million and structured financing with a local bank. 2. 20% down payment of $540,000. 3. 10-year note at 5% interest for the remaining $2.16 million. 4. Amortized at 25 years, which means payments are based on a 25-year loan. 5. Monthly cash flow. With that low of a mortgage payment, I had considerable monthly cash flow starting the very first month of ownership. 6. I was able to get an additional loan of $150,000 added to the main note so I could repave the roads and amortize that expense over the same 25 years. This is a strategic way to do capital improvements using bank capital and not your own capital, and with no down payment and only small monthly payments with huge tax advantages. 7. The park appraised for much more than the purchase price, so I knew I was buying the property way under value and was able to eliminate almost all risk. I did buy the park for the seller's asking price, though, so it was a win-win scenario. 8. Profit in the first year was $224,000. The cash-on-cash return that first year was 41%. 9. We profited the following year $326,000. We improved the property and billed back water and sewer charges to the residents. 10. In 2 years, we profited $550,000, and the down payment was only $540,000. 11. In year 3, we continued to improve the property and increased rents. The park rent was still priced way under market, so profitability continued to increase. 12. Due to the great relationship established with the local lender, I negotiated a loan modification to structure better terms and pull out close to $1 million of equity from the park 1 year after I purchased it. A loan modification is similar to a refinance, but it's much cheaper and infinitely faster as it only took a couple of days to do. Here's the filter for this investment. This deal originally made sense to me because I knew it was an off-market deal where I was able to work out a price directly with the owners. I knew I was getting the park way under value, so it would be easy to get a loan on the property. I knew the cash flow from this park alone would cover all of my expenses, current lifestyle, and beyond. This purchase would allow me to achieve my goal of not needing earned income ever again, and it was the catalyst to many more additional deals with strong cash flow. The additional cash flow that exceeded lifestyle expenses was then reinvested into more cash flowing assets to compound the return of that single investment. Let's discuss the negotiation on this deal. Many of the deal points had to be negotiated to get this great of a deal. While I was in the final stages of negotiation and finalizing the purchase-sale agreement, the sellers decided they wanted to use a broker to sell the park. Originally, it was just the sellers and I working together. Once the broker entered the equation, he wanted to increase the purchase price by $300,000. So the first negotiation was to get that price back down to the original price. Then there was considerable negotiation with the bank to get great terms. I always get terms from at least 3 different banks whenever I decide to get financing. That way, I can put the banks up against each other and negotiate even better terms off of each one of them. I have found that when lenders know several banks are competing for my business, they are competitive with their terms because they don't want to miss out on providing me the loan I need. Once the deal was done, I negotiated the extra loan to repave the roads and then the loan modification to get even better terms, which were already great at the time, but I was also able to pull out $1 million in equity out of the deal. I could then turn around and invest that money into several more cash flow generating assets. Let's look at this deal in review. This example is yet another one about leverage and phantom income, as I discussed in Commandment 6, Find an Income Amplifier. I earned cash flow on nearly $1 million that didn't exist when I first bought the park. Just the cash flow alone on that phantom income is earning me close to $150,000 a year now. The bottom line is that it was a great deal for a plethora of reasons, and it's a property I still own today. The best and fastest way to get and use leverage is to borrow someone else's money or do a seller finance deal with a low down payment or no down payment at all with no recourse. What you're effectively doing is transferring wealth to yourself with no risk or cost. If you can find a way to improve that asset without writing a check, you improve and increase equity and increase cash flow as well. Here's an example. You can find an asset and do seller financing with a low down payment or no down payment, or use one of the financing options I discussed in this chapter. Perhaps you could find a service provider or partner willing to make improvements on your property for a small percentage of income, and then you could find a property manager who would also work for a small percentage of income. This scenario is a no cash transaction with no risk. The best part of using leverage is that it's just a negotiation and an exercise in creativity. All anyone can say is no, but most of the time you can land the deal by asking great questions. And having someone to model who's done a similar deal in the past paves the way. Finding a mentor or a mastermind can be so powerful. Just one idea can pay for itself by 10x in a single transaction. Mobile Home Parks 2024 Deal Update. Here's the 2024 update summary. Mobile home parks are among the highest returning investments ever. We grew our portfolio through additional acquisitions. We added institutional management to scale. These assets proved profitable even during recessions, and we used leverage to accelerate the growth. Many years ago, I reached out to an owner of a mobile home park near some properties I already owned. He had built the park himself years before and was emotionally attached to it. Despite his reluctance to sell, I made sure to stop by periodically to build rapport. After years of patience, the owner died, and his family finally decided it was time to sell. Because I had nurtured the relationship, I was at the top of their list. We negotiated an off-market deal for the property at a substantial discount to intrinsic value. The low basis meant that I could earn strong cash flow from day one, and there were clear opportunities to add value and grow the bottom line. In the first year alone, we generated over 40% cash-on-cash returns by improving operations, and that was just the beginning. Fast forward to today, and that single park has produced millions in profit over the years since acquiring it. The success of that third park gave me the confidence to continue acquiring additional communities. Now our portfolio has grown to over 1,500 lots, and we partnered with an institutional operator to scale the platform. Beyond the returns, mobile home parks proved to be one of the most stable assets, with occupancy remaining high even during recessions. As more institutional capital enters this space, values have grown substantially. I used extensive leverage to my advantage to acquire mobile home parks. The leverage magnified equity returns manyfold, while the assets' cash flows protected my downside. This allowed me to scale rapidly. Here are some key insights. Mobile home parks generated strong profits even during recessions. The portfolio growth and institutional management enhanced efficiencies. Emotional sellers and off-market deals can yield bargains. And this segment continues to attract growing institutional attention. New deal example, KC Dogs. Here's a deal that didn't make it into the 2020 version of the Lifestyle Investor, but is a perfect example of what can happen when you combine multiple commandments with my core principles of lifestyle investing. This shows you how you can structure and negotiate your investments in a way that's a win for everyone involved. Overview. I had the opportunity to partner with my friend John to purchase a dog training company. At the time, John was working in corporate America, making $65,000 a year. Meanwhile, the owners of this dog training company were paying themselves $75,000 a year. I saw this as the perfect opportunity to help John ditch the rat race and step into a business where he could make more money off the bat and also earn some sweat equity upside. This deal came about through good old-fashioned relationships and intentional networking. I had introduced John to the concept of buying a business rather than starting one from scratch, since acquisitions can have an established track record. He learned about this company through a connection that led to the owners. We moved quickly to put in an offer and secure the deal. When we first took over, the business totally cratered. The seller was shady, the staff bailed, and there was no training program like we were promised. But through overhauling systems, hiring strong leaders, and booking out months of training appointments, we got this business producing over $100,000 per month in just a few months. We ended up selling at 1 year and 1 day for over an 11x return. Mindset. My mindset going into this deal follows Commandment 1, lifestyle first, and Commandment 2, reduce the risk. I wasn't doing this to make the most money possible. I wanted to help my friend John exit his corporate job for good. Even though I could have taken far more equity, I let John have the majority stake so that he could reap maximum rewards. I also knew with the proper systems and leadership in place, a dog training business would be recession-proof. People love their pets and will spend money on them even in tough times. The huge demand for dogs and training coming out of COVID made this look like a smart bet. And with a proven model in place, our downside risks seem minimal, even if we had to overhaul things initially. Structure. We purchased the company for $500,000 with $100,000 down. At the time, the business had a $160,000 EBITDA. We purchased at a 3 times EBITDA multiple. We structured an 80% loan with a 20% down payment. We split ownership 60% John and 40% me. This gave John majority equity so he could have the maximum reward and be pot committed to making this work. The owner's salary of $75,000 was accounted for in the existing EBITDA. Filter. The criteria I used to evaluate this deal made it really appealing to me. With COVID trends showing a massive increase in pet and dog ownership, I knew demand for training would be high. We had the chance to purchase the business at an attractive 3x EBITDA multiple. Having my friend John as a strong corporate operator to lead the transition also gave me confidence. My maximum downside was capped at my $100,000 investment, but the upside potential was huge. The deal structure allowed for distributions in the short term so I could get my capital back quickly, and I would retain long-term equity for residual cash flow. Based on these factors, it was clear that this deal could produce strong returns with minimal risk. Negotiation. There were several elements of this deal I negotiated for preferred terms. Although I could have taken the majority of equity, I gave my operating partner John 60% ownership to align everyone's incentives. I also negotiated with John for an accelerated distribution schedule of 80% of the cash flow so I could get my $100,000 principal investment back in less than 4 months, which completely de-risked the deal for me. Then we reverted back to the 60-40 equity split for distributions. Given my relationship with banks, I was able to personally guarantee financing at very favorable rates. In this case, I negotiated a partial personal guarantee, so I was only on the hook for 20% of the bank note. Something important to consider is that over time, personal guarantees fall off. You may not realize this, but you can negotiate the terms of a personal guarantee with banks. I've often been able to reduce personal guarantees to half after 1 to 2 years and eliminate them completely after 3 to 4 years. This leaves me with no more personal liability. Reducing and eventually eliminating personal responsibility was an important negotiating point for me in this and other deals. I also negotiated the deal terms with John to include a salary bump from his corporate job along with significant equity upside. My goal was structuring a win-win partnership where John could build his wealth by owning a business instead of just collecting a paycheck. These negotiated elements made the deal work well for all parties. The deal in review. This investment reinforces the value of stacking my commandments and core principles. It provided passive income and aligned with my lifestyle and operating partner's lifestyle from Commandment 1. The business was likely to thrive even in tough times, which reduced my risk, Commandment 2. We found an invisible opportunity to buy a business in a booming industry with plenty of demand, Commandment 3. And I negotiated terms to get my principal back in less than 4 months, Commandment 4. Finally, it produced immediate cash flow, Commandment 5. And as I previously mentioned, although I could have been more aggressive, I structured this deal so my operating partner John had the majority of equity. My priority was creating an opportunity to help him build wealth through business ownership. This exemplifies the long-term win-win partnerships I try to structure. A decade later, John continues to partner with me on new investments because of the generosity on the front end of this deal.
The ninth commandment, use leverage to your advantage. That sounds a little complex. Break it down for us, Justin.
So this one is actually easier than it sounds, but basically I want to gain the maximum amount of return with the minimum amount of investment. And really, this is one where it might sound contrary to other commandments, especially the last commandment of cutting out the fat, because a lot of the times you're using leverage by utilizing a bank, some sort of financial institution. But I think it's okay as long as it's on your terms and as long as you're getting a good deal from it. So, for example, in the last commandment, I talked about using seller finance, and I love seller finance, and I would pick that first any day of the week. But if I can't get a seller finance opportunity in place, I'm more than happy to use a lending institution. And what I like to do is I like to get 3 different lending institutions at a minimum anytime I'm negotiating rates, because I want to keep the banks honest. And if the bank knows that I have someone else that could give a better deal, they're more inclined to give a good deal. So one of the things I like to do is create competition amongst the banks, and I put them up against each other, and I negotiate the terms against each other, and then I figure out which one will work with me for the best terms, and I'll go with that bank.
Love it. That is so good. You talk about in this commandment as well that there's some unheard of things. For example, you use an illustration, but you talk about 103% you made a cash-on-cash return in 1 year, and that's unheard of. So it sounds like this commandment is pretty powerful. It's worked to your advantage throughout your career in investing. How often does this one particularly surface?
Well, that particular deal is, to date, the best investment return I've ever had. It's actually 105% cash-on-cash return. So it's the largest I've ever had. I made more money back than my initial down payment. And so this would be an example of where I used leverage to my advantage. So I was able to get a conventional loan with unbelievable terms. I was able to get a 20% down payment. I believe it was 4.5% interest and a 10-year note. And it was just an incredible deal. The terms were great. Everything worked out great. So that down payment, I made 105% on it within the very first year of owning that asset. And then I was able to turn around and sell that asset at a year and a day. So if I had done it at less than a year, it'd be short-term capital gains tax. A year and a day would make it long-term capital gains tax.
Wow.
And so then I turned around and sold it at a year and a day and was able to turn close to a $250,000 profit on it. So the total profit was over $400,000 in 1 year.
Wow.
And that was really eye-opening for me because that was at a time where my earned income was less than that. So I was putting in a lot of hours, working hard, trying to build a business, and And in so few hours, I was able to make incredibly more than what all my hours combined for the year made. And it was one of the biggest aha moments I had where I was like, I've got to stop trading time for money and I need to start buying assets.
Wow. So that was really the seed of the lifestyle investor. Was that one of those pivotal moments that kind of crystallized it for you?
Yeah, I shared one of them at the beginning where I was kind of giving my family the leftovers and, where I really had to direct my own time and be in charge of that. And that was really, the first one. I mean, this one was a huge one. This was the one that said, okay, I've got to stop messing around. I can't be spending my time this way and trading it for dollars. Even though I was a high income earner at that point in my career and in my life, relatively speaking, definitely compared to what I'd earned, in the past in my life, but it didn't even compare to what I could do if I had assets working that could work while I slept and produce income while I was on vacation. And especially just this example, it's like, I feel like I could have looked at it as, man, this is demoralizing, but I looked at it as, wow, this is really empowering. I have just been thinking about this the wrong way. This whole time I've been thinking, oh, if I just work harder, I can make more. And that's what I was doing. But it was, no, if I can work smarter, which actually means I work less and I buy assets, I can make more.
I think light bulbs are going off everywhere. And I hope that the listeners are having some of those pivotal moments that you talk about all throughout this audiobook. Even for me, I'm just like, wow, whole life insurance, boom, light bulb, or these other plus the deals. So the invisible deals. I just think there's so much power when you stack these commandments together.
Commandment 10, every dollar of investment gets a return. An investment in knowledge pays the best interest. Benjamin Franklin. What if I told you I could give you a guaranteed 5,000% return on your investment and get your initial investment back in just 2 months? And if you chose not to do it that way, you'd lose your investment for sure. In times of war, soldiers are told to prepare for the worst. That's because when you prepare for the worst, it never happens. I'll tell you what the investment is at the end of this chapter. Myths about knowledge. Some people believe they can't invest because they don't know about investing. Another myth. You can learn. In fact, once you own investments, you're quickly forced to learn about them. I found ownership to be the fastest way to learn. Ordinary people think that if they're not an expert, they can't do something. That's a total myth too. You can hire experts for everything. I work with a team of advisors who are infinitely smarter than I am on many different topics. That's why I work with them and why I'm excited to have them on my team. When I talk to a professional, I let them know up front that I'm not hiring someone to do all the work for me. Anyone can do that. I am hiring them to teach me all the nuances associated with why they make the decisions they make. I only hire professionals who are the foremost experts at their craft. I want to learn what they know so I can draw upon that knowledge in the future. This approach ensures that I get the highest level of education in working with them. There's more. Not only do I get an incredible education from these experts that I can use in the future, but I can also avoid paying for the same work in the future once I understand the how and the why behind it. Imagine if you hired someone to educate you. You'd want to know why they made certain decisions because you're not paying for the service, you're paying for the education. That mindset has really benefited me. Because I've paid close attention and asked my attorneys, CPAs, and tax strategists tons of questions in every one of my deals, I come into all new deal negotiations with that background and expertise. In addition, because I can do so much of the pre-work myself, I might need less of their time, which means lower legal bills when I do use them. I take great joy in paying for top-notch legal and professional services. I used to be bothered by paying so much in legal and professional fees until I understood how much work and effort it would take for me to figure those things out on my own. Now I see that I earned an incredible return from hiring the best and brightest minds to help me. It is the happiest money I spend when it's the right fit. In my experience, the best type of primary attorney to hire is one who specializes in bankruptcy. They see the world as it falls apart. They understand what the breakup process typically looks like and the real risks that exist. Because of this perspective, they can add specific elements to your contracts to protect you and your partners at the beginning. I really believe it makes sense to outsource anything that's outside your core competencies once you find an expert who will teach you what they're doing. My advisors are brilliant, and they have years of expertise in fields I know little to nothing about. Hiring them saves me so much time and headache for something I couldn't even do as well as them, even if I made it my full-time job. Plus, they may think about things completely differently than I and offer insight I would never have had on my own. My advisors also help me pay attention to my blind spots and are much more detail-oriented than I am personally, so they can ensure small details don't slip through the cracks. Besides helping me make a better return on my investments and structuring my deals to perform as intended, they also help me not make poor investments. When I think about what education and expertise I want help with the most from my advisors and how they can continue to add value to me, my thoughts are based on them helping me make better overall returns, protecting me from losing money, and helping me minimize my tax exposure, among other things. My legal professionals have made me an incredible return on my investment with them because of focusing on these key areas. Sometimes getting into a deal is really opening the door for future deals. It's letting people know you're there to play and will be first in line when they have the next appealing deal. A huge part of investing is networking and establishing relationships. Then it's making sure you do what you say you're going to do. If you say you're going to invest in something and fund it, it needs to be funded exactly when and how you said it would be. Leave a good impression wherever you go. One other point on finding the right advisors. Some people don't realize the importance of working with people you actually really enjoy spending time with and learning from. I first interview all professionals I work with so they understand how important education is to me. I also make sure we'd be a good fit and that I'd actually enjoy working with them. If not, I cross them off my list. I want to work with people who are experts, but I also must enjoy working with them. Therefore, my vetting process for selecting experts is important to my success. Gaining knowledge in investing is also about modeling success. When I find someone doing something that works, I'm going to copy it. There's a good chance that once I educate myself more with that particular model, I'm going to innovate and make it better. It doesn't mean I necessarily will do what they do better, but it does mean that I can at least replicate what other successful people are doing. I'm a big fan of immersion learning, so I enjoy boot camps, conferences, and seminars. I've attended countless of these events over the years for various investment topics and projects. I'm also a fan of reading. I read at least a book or two a week. Reading is probably my top way to learn outside of hands-on experience. I'm also happy and excited to enlist the help of mentors. I've had many mentors in my life. Most often, the relationship begins with simply asking a person to step into that role. And by the way, I'm happy to pay for that mentorship. I've invested in various mentorships over the years because I know that the return is tenfold, 20-fold, or maybe even more. Cash Flow Quadrant, Rich Dad's Guide to Financial Freedom by Robert Kiyosaki was a pivotal book that taught me how to think about where in the cash flow quadrant I fall in terms of being an employee, self-employed, a business owner, or investor. Early on in my entrepreneurial career, I thought I was a business owner because I was running a small business. But really, I wasn't a business owner yet. I was self-employed. A true business owner has systems and teams that run the business so it operates successfully without the owner's involvement. If I would have left town for an extended period of time, then my business would have fallen apart. Robert Kiyosaki gave the example that if a business owner could stop running their business for over a year and it grew during that time without them, then it's an actual business, not a sole proprietorship. That big realization taught me I had to create a better business that didn't rely on me to function and scale, which is a challenging task most entrepreneurs never achieve. However, my biggest realization was that what I thought I wanted was to be a business owner, when what I really wanted was to be an investor instead. Only then would I truly be able to separate my time from income. My focus became how to move to the investor side of Kiyosaki's cash flow quadrant to invest in or buy businesses rather than start and run businesses. I spent many intentional years moving toward that investor goal. So what's this 5,000% return I shared at the beginning of this chapter that could repay itself in just 2 to 3 months? The biggest and best investment you'll ever make is increasing your knowledge and capabilities by investing in a great business coach. A great business coach can prevent you from making stupid mistakes, such as hiring the wrong people, and help you build a better team around you in record time. You don't have to learn what they know. They can bring you into deals and opportunities that you couldn't find yourself and help you structure deals and think about different ways to negotiate. Think about it like this. If you could go back in time 20 years and invest in Apple or Google, would you do it? A couple $1,000s would be worth tens of millions or more now. A great coach is like getting into a time machine. Nobody can ever foreclose or bankrupt your brain or take your knowledge and experience from you. When you hear about billionaires who have lost all their wealth multiple times over their careers, this secret is why they're able to reinvent themselves over and over again. Here's the short version of how an investment opportunity came together and why this example is an important story for you to think about. Example, single-family home maintenance company. I had invested in a single-family home maintenance company with 2 business partners as an investment through another business we owned together. The parent company that made that investment wanted to raise money through a Series A investment, which is typically the first significant round of venture capital financing. Venture capital is a form of private equity and a type of financing that investors provide to startup companies believed to have long-term growth potential. I had previously sold some equity in that parent company that they were paying out in installments, but the unpaid balance of the note still owed to me looked like debt on their books, preventing them from raising money through a Series A investment. During the Series A raise, there was a conflict between my 2 partners who ran the operations of the parent company and the 2 owners of the maintenance supply company. After multiple attempts to renegotiate between the parties, it looked like the maintenance supply company we had invested in didn't want to pay us what they contractually owed, which meant we might have to litigate to get paid. I really wanted to make sure this situation could be solved amicably, so I stepped in and negotiated a deal. I forgave the balance of the note the parent company still owed me to clear up the debt getting in the way of raising their Series A. This was in exchange for the full rights of the royalty agreement that we had in place from the original investment in the single-family home maintenance company. The royalty agreement was based on top-line revenue on gross sales. However, I reduced the overall amount the maintenance company would pay to help create a better cash flow scenario for those 2 owners and their company. It was a true win-win-win for all 3 parties involved. Let me explain my mindset on this deal. I invested time with my attorney analyzing my investments and cash flow. He connected me with several of his colleagues at his law firm to get expert recommendations on several of my current ventures. During a brainstorming session, we saw a huge opportunity with the parent company that could help solve the conflict my partners were having with the maintenance supply company. It was a very outside-the-box opportunity and solution, A perfect example of the power of having a strong, creative, and strategic legal team that thinks differently than you do. I learned some unique contractual mechanisms and some creative ideas to facilitate brokering a much better situation and deal for all parties. I likely would not have come up with this on my own. Here is the structure of the agreement. 1. It was a $0 investment, but I did forgive a note that the parent company owed me for close to $500,000. 2. I offered to help the maintenance supply company negotiate out of a contract they had and create a new and better contract for them to avoid litigation. 3. I received a percentage of top-line gross revenue. 4. This revenue share was paid with monthly distributions. 5. I got warrants on the gross sale proceeds if the maintenance supply company ever sold. And 6. I got first liquidation preference if the company did sell. Let's take a look at the filter for this example. This deal was a great investment because it's in a booming industry with unlimited growth potential. It didn't require much time or capital from me and would create a monthly income stream to cover my family's lifestyle and ultimately buy me more time. Also, I was able to help the maintenance supply company out of a sticky legal situation they were in and renegotiate deal terms to benefit them. Looking ahead, I know I can be a resource to them as they continue to scale. It was a win-win scenario for all parties involved. Let's take a look at the negotiation for this deal. I negotiated a percentage of top-line revenue with a monthly distribution, which is always one of my favorite investment structures. I was able to negotiate additional warrants if they choose to sell in the future, and that right is based on gross sale proceeds rather than net sale proceeds, which is a very important distinction. It's similar to the difference between a top-line revenue share model and a profit share model, where a revenue share will produce more income than a profit share because it's prior to expenses being taken out. The same is true for gross sale proceeds, producing a better return than net sale proceeds. I was also able to secure a minimum guaranteed return on the revenue share proceeds in case the owners sell the company earlier than planned. Let's look at this deal in review. Once you've accumulated enough knowledge, assembled a great team of advisors and professionals, and gotten involved in enough deals, you'll be able to find tremendous opportunities to negotiate and even renegotiate deals in a way that benefits multiple parties and provides long-term cash flow and equity painlessly with a little bit of creativity. Without the knowledge and experience of others and getting into the game, opportunities like this win-win investment will never appear. All of these learned skills require taking a first step, making a commitment, and pursuing a dream to get started. Single Family Home Maintenance Company 2024 Deal Update. Here's the 2024 update summary. This negotiated revenue share provided over $2 million despite minimal capital. The company achieved significant growth through bootstrapping. Home services and maintenance is a highly valuable sector. Strategic advice is more beneficial than capital for the founders, and it has minimal ongoing time requirements. When I first advised a single-family home maintenance company on their growth strategy, I negotiated a modest revenue share in lieu of heavy involvement. This aligned incentives while allowing me to stay focused on other projects. Frankly, I assumed it would provide some supplemental cash flow, but didn't expect much. However, within a few years, distributions from my tiny revenue share grew to over $45,000 per month. To date, I've received over $2 million in cumulative distributions without ever having to contribute capital. The company's commitment to reinvesting profits allowed them to grow quickly. Their services fall into an extremely valuable niche: property maintenance and repair. Private equity firms aggressively acquire companies in this space with their own proprietary software for 10 to 20 times EBITDA multiples. For the founders, access to my network and growth strategy advice proved more valuable than capital. By aligning interests early on, the revenue share provided exponential returns despite minimal ongoing time involvement. This deal exemplifies how pursuing unique structures beyond just capital can yield outsized upside. Even more so, identifying emerging sectors primed for consolidation can produce phenomenal returns over time. Though I provided minimal capital, I ensured that every invested dollar got a return through the revenue share and equity upside. Beyond the financial return, I gained valuable knowledge about their operations and growth strategies. Here are some key insights. My negotiated revenue share provided over $2 million in distributions. Home maintenance and repair is a highly valuable consolidating sector. Strategic advice and connections were more beneficial than capital. There is minimal time required beyond the initial strategic involvement, and unique deal structures and emerging niches can generate massive upside. Outsmarting the venture market. The typical way a venture fund operates is based on several rounds of funding before a liquidity event, which means it can reasonably take 10 to 12 years to fully realize a yield. Naturally, I wanted to figure out how to shorten this timeline. Here are a few principles I follow when investing in venture capital deals. Number 1, diversify across multiple funds and 100 or more seed investments. Number 2, target the highest growth Series A to Series B phase. And number 3, access discounted secondary shares post Series B. This strategy stack gives me an edge over individual VCs when investing in high-risk, high-reward venture deals. Through experience and deliberate strategies across stages, sectors, and fund structures, I aim to maximize the upside while minimizing downside risk. To diversify risk in the early pre-VC stage, I invest in specialized funds that construct portfolios across 600 or more seed and pre-seed startups. This breadth spreads exposure across sectors, geographies, and founders to avoid concentration risk. Given the long odds at this nascent phase, volume is key, and with at least 600 seed bets, winners can more than offset inevitable flameouts. I let the fund's experienced investment team handle the heavy lifting on sourcing and due diligence to access the most promising emerging startups nationwide. A major advantage of this strategy is being able to write off losses from failed startups while taking up to $10 million or 10 times the investment in tax-free gains on winners under Qualified Small Business Stock (QSBS) regulations. This optimizes the upside while mitigating the downside risk. I also leverage creative channels like accelerators to gain pre-VC exposure to startups. I've mentioned the Portfolio Accelerator with over 200 early-stage companies, many already profitable. This provides broad early access to minimize risk. As they add over 800 startups over the next 5 years, my exposure to early winners compounds. What about after startups raise a Series A round? I've learned the optimal time for outsized yet shorter duration gains is from Series A to Series B. This is when valuations often surge 5 to 10 times over just 2 to 3 years as market traction validates the model. At this stage, I tap specialists who have proven models for identifying the most promising Series A companies poised for hypergrowth. These groups typically invest early in a startup's Series A extension, then exit a couple of years later in the secondary market after the Series B round closes. This is when valuations normally peak before returning to steadier growth trajectories. By concentrating capital in this brief window of maximum acceleration between A and B rounds, outsized returns can be captured. After startups complete Series B and later rounds, risks decrease substantially as the company typically has an established product and business model. I partner with seasoned secondary players to purchase founders and employees' shares, often after Series B, at favorable valuations. Their diligence filters for profitable, de-risked companies with strong growth prospects. Buying post-Series B stakes at discounts to true value is a path to generate outsized returns with lower risk. I also spread capital across sector-focused funds in high-conviction areas like AI, cloud software, digital health, fintech, biotech, and blockchain. This diversity by sector reduces correlated risks. Within each sector, I'll invest in 5 to 6 top funds to further spread exposure. Before doing this, I scrutinize fund economics, fees, carry structure, and incentives to ensure optimal alignment. For U.S.-based sectors where America retains a competitive advantage, like AI, autonomous tech, and biotech, I strategically concentrate more capital into top VC funds and startups poised to lead globally. This targets assets positioned to outperform. Of course, I review track records on relevant benchmarks before investing in new managers or follow-on funds. It's key to learn from failures and emphasize funds that demonstrate improving performance over time. Patience and long hold periods give time to compound outsized returns. Additionally, I'll fund riskier early-stage venture investments using steady cash flows from proven 10 to 12% income streams. This insulates my lifestyle if an emerging bet flames out. And when the next one hits, I'll recycle those gains to fund the next 5 seed investments, rapidly cascading returns. Once reliable income surpasses my monthly lifestyle target, let's use $25K per month, as that was my target when I first started, 100% of the surplus becomes investable. Compare this to the early career scramble to save 10 to 20% of wages. The psychology flipped is profound. With abundance and discipline, I can commit 80% of this surplus to compounding and 20% to causes. As your reliable income grows, you can adjust those figures to compound your wealth even faster or multiply your philanthropic efforts based on your goals. Cascading cash flows lets me take bold risks across 100 or more seed investments, turbocharge gains when winners emerge, and pay it forward. That's the heart of sustainable wealth creation. By being selective, strategic, and diversified, I aim to leverage startups' steep growth trajectories while safeguarding against risks. With the right expertise and deliberate approach, venture capital can generate tremendous upside. These principles allow me to participate in a way that follows the core investment principles that I apply throughout the rest of my portfolio. Here's a lifestyle investor lesson. Most experts agree that you need at least 50 to 100 seed investments to receive just one positive return. Optimize your seed investments accordingly. Principles for hacking VC. Based on hard-learned lessons, I've identified strategies to reduce risk and maximize upside when investing in venture capital funds and startups. Here are key principles I follow to boost returns and limit risk. Number 1. Fund higher risk VC investments using steady cash flow streams. Build up monthly or quarterly cash flow funds first, then deploy those distributions into riskier VC bets. If an emerging investment fails, lifestyle is protected and cash flow continues. Number 2, diversify intelligently across sectors, stages, and geographies. Don't put all your eggs in one basket. Spread capital across early, mid, and late stage funds. Disperse investments across high conviction sectors. Mine are SaaS, AI, biotech, and fintech. Mix exposure by geography between startup hotbeds like Silicon Valley, New York City, Austin, Boston, and the Southeast. Mitigate risk through thoughtful diversity. Number 3, leverage micro VC platforms for early stage access with dilution protection. Gain entry to nascent startups alongside top-tier VCs via platforms like AngelList. Negotiate pro rata rights to avoid dilution in follow-on rounds. Invest directly in companies on favorable terms you dictate. Number 4, target the Series A to Series B phase for maximum value acceleration. This is the steepest part of the growth curve, where valuations often surge 5 to 10 times in just 2 to 3 years. Concentrate capital in this brief window of hypergrowth to maximize gains. Number 5, access discounted secondary shares post-Series B for lower risk and higher return. Purchase founders and employee shares at favorable valuations after risks diminish. Leverage secondary specialists to filter for profitable, mature startups. Number 6, scrutinize VC fund economics, fees, and carry structure to align with incentives. Negotiate investor-friendly terms for follow-on investments. Insist on performance versus benchmarks before committing additional capital. Number 7, review track records versus benchmarks before investing. Reference against year, sector, and stage to gauge top performers. Require funds to demonstrate learning from failures. And number 8, prepare for long hold periods to let winners compound over 5 to 10 years. Be patient and allow underlying value to build. Avoid premature exits. There's a reason venture capital is risky. It requires highly specialized experience, relationships, and deliberate tactics to outperform the odds. As individual investors, we can play the VC game in a way that limits risk. As with any lifestyle investor deal, it starts with your mindset and then how you filter, structure, and negotiate the opportunity. While I've shared the companies and funds I've done business with, it's critical that you do your own research and make decisions based on your own due diligence, investment principles, and gut instincts. After a full-day strategy session that seemed like just 10 minutes with one of my favorite private coaching clients, let's call him JJ, we enjoyed a celebratory dinner. We had worked together in building a perfect portfolio that matched his lifestyle investing goals. After only working with him for 90 days, he's already invested in close to 10 deals, each in the multiple 6 and 7 figures. One of the benefits of working with really smart lions like JJ is that I learn as much from my clients as they learn from me. The day after that strategy session together, here is what I wrote in my journal. Yesterday was a fun strategy session with JJ. I am so impressed with JJ and his desire to learn and his ability to retain information. He is incredibly smart and he is dialed in on so many levels. I enjoy how deep of a thinker he is and how strategic he is. I feel like he's thinking so many steps ahead of most people. His intellectual property knowledge is amazing, and he is offering so much value to the company he most recently invested in and is really helping them scale. He not only had a big strategic exit in his first company, but he is setting up his next company to have an even bigger exit and is offering so much wisdom to the executives and other owners. I'm excited for round 2 today and to get into the details on many specific strategies I use. I think JJ is going to benefit tremendously from our time together and our new friendship. I'm also enjoying learning his perspective and insights as well. This is going to be a fun year and beyond for us. At the beginning of this book, I told you that being wealthy has everything to do with having a wealthy mindset. I can't stress that enough. A wealthy mindset means living in a wealthy ecosystem of abundance-minded, coachable thinkers who can spot mutually beneficial opportunities where everyone wins. Investing isn't a zero-sum game. I have the greatest satisfaction in knowing that I'm truly teaching someone to fish by sharing these principles and commandments that work. I have the privilege of changing people's mindsets and providing fantastic financial returns. Every dollar of investment gets a return, especially when you're investing in your personal growth and your lifestyle investor mindset.
Our final commandment, the 10th commandment, every dollar of investment gets a return. I mean, that's something that you think would be common sense, but when it comes to investing, it's not. What does it mean?
Well, to me, it means that I want to learn and gain an education as I'm investing and as I'm growing. So it's not just about the financial return, it's about the compounding of the education that I'm getting from all the experts around me. So one of the things that I love to do is when I am building my team of experts, you know, who's going to be in my cabinet and who are the people that I'm going to look to for advice. I'm all about interviewing them, and I want them to sell themselves and help me understand why they'd be the best fit. But one of the things that I always say is, if we're going to work together, I need to know that you're not just going to take care of whatever it is that I need taken care of. I need to know you're going to teach me why you're doing it. I want to build my knowledge and my expertise, and I want to grow really just my understanding of the things that I don't know, so I am better prepared in the next deal and with the next opportunity.
So it's almost, is it like a metaphor? Every dollar of investment gets a return. Are you basically saying that during the process of investing, you're constantly learning for the next deal as well?
Yeah, without a doubt. And there's a compounding and stacking effect just in this commandment, because I might learn something from my attorney that then stacks for the next deal where I have a better foundation to start from. And then I learn something from my CPA in a very strategic way to structure things, and I might then use that on the next one. So I don't have to keep going back to the well to see how to do things. I'm going to be constantly growing and improving my game and my investor IQ and my negotiation skills and the options even that I can choose from when structuring deals.
It sounds like anyone who is considering the lifestyle investor Lions, I mean, my radar's up as I'm hearing this, because you're basically saying that you're constantly growing. In other words, people who buy into the lifestyle investor, it's not like it's a done deal. It's not like it's a process that has been completed. They really have committed to a lifelong learning relationship that you're constantly updating. I know you're a reader. You're constantly reading. So the 10 Commandments to me sounds like it's a basic framework that is built out of 10 Commandments, but then you're constantly growing it as well. What are some big visions that you have for the 10 Commandments? Where do you see this going eventually? What's your big dream?
Well, these are going to constantly evolve. Now, I know that they're foundational enough in nature as they are today to stand the test of time. I mean, these are, I've been utilizing these same principles and these same, strategies and criteria now for, over a decade. And so I know they work, but what I don't ever want to get is set in my ways. I want to always be ready to learn the next thing. I know that there are plenty of people smarter than me, plenty of people doing things differently than me, and I'm just eager and hungry to learn what they do so that I can prepare myself better and I can educate those that I have influence with and those that are in my network and are part of my mastermind to be the best that they can be and to be the most educated that they can be. So I just want to constantly grow, constantly improve, constantly learn. And I have a commitment to myself and to anyone that knows me really well of being a lifelong learner. I love to learn. And the coolest thing about learning is that there's then a ton to be able to teach. And I love sharing everything I learn with the people that are closest to me and that are in my network.
We started out with part 1, the conflict. We just ended part 2, the commandments. We're moving into the final part 3, the call. Is there anything else, Justin, that you want to share with these 10 commandments?
Well, there's always an opportunity to grow and improve yourself. I mean, the moment that anyone arrives, it's going to really be hard to be teachable in that moment. And so I just don't ever want to arrive. I just always want to be on the journey, always looking for the next big thing, the next big opportunity, the next tool in my tool belt that I don't already have. And because of that, it gives me an opportunity to strike a lot more deals and to use a lot more of my tools readily because I want to apply them. I learn something new and I want to apply it right away. So it becomes a game. The big thing is investing in general and kind of growing net worth and growing wealth, it all becomes a game at a certain point. And once it becomes fun and a game, then the emotions are gone, and feeling like you have to control what happens and cling on to money so hard that because you don't want to lose it, that you are emotionally making poor decisions or emotionally, I guess inactive. It's like the indecision that prevents any form of action.
Yes.
And so, that's not what I want for me, and what I want for the people that are in my mastermind and are in my coaching program is to really have this desire to learn, to grow, and to be willing to take action and get to the point where it is fun and it's a game. Because when that happens, that's when things really can take off.
And I would think if you'd ask most people in the world today, fill in the blank, money is. Most people would not say money is fun or money is a game. In fact, for most people and most marriages and most families, money is a life and death situation. I mean, money is a stressor. Money is a strain. But I love the way you've defined it. And truly, once money takes care of the basic expenses of life, then you're right. You can engage, you can interact, and you're not as emotionally tied to the ultimate outcome. So this has been absolutely fantastic. I can't wait to get into part 3.
Part 3, the call. Next steps. Success isn't overnight. It's when every day you get a little better than before. It adds up. Dwayne Johnson. Now that you've discovered the 10 commandments of a lifestyle investor, are you ready to do the work? Becoming a lifestyle investor is about creating the life you dream, a life of abundance, but it's also about helping others through that abundance. Once you've mastered this lifestyle, you create a ripple effect inside your circle of influence that can change lives and impact hundreds, thousands, or even millions of people. Not everyone who reads this book will expend the time and energy it takes to shift their mindset. Each person has some baggage related to money. I believe everyone is conflicted about money at some level. Either you are conflicted and realize it, or you're conflicted, unconscious, and unaware. Before you go on, here's what I recommend you do. Stop listening and write out what you believe about money. Get specific. Now, go back through the commandments and complete any response you skipped. My goal is that you re-listen to this book and refer back to these commandments often. Make notes. Jot down thoughts, questions, and ideas. Better yet, start a journal and watch your progress as you implement these strategies. First things first. Have you identified people who are smarter than you in certain areas and can help you become a lifestyle investor? Make a list of these people. Next, figure out your stripped down, bare necessities living expenses. Think about it this way. If you were injured and couldn't work for 3 months, what money do you need in the bank to ensure your family survives? Write this out using actual numbers. Take that 3-month figure and multiply it times 4. That's the annual amount your family needs to survive. If you break it down monthly, it shows you the amount of cash flow you need coming in each month to cover your basic expenses. Doesn't look as formidable as you thought, right? Do this same exercise with your current lifestyle if you haven't already, so you know what it costs you to live each month. Now you can figure out how much cash flow you need each month to become financially free. That's what your freedom looks like. Freedom formula. Now review your personal freedom formula. What needs to happen to fulfill your top priorities? It's time to take action if you want to become a lifestyle investor. 1. How much will you allocate to make your first investment? 2. How much monthly cash flow will that investment provide you? 3. What are some investment opportunities that interest you? 4. Evaluate your portfolio against the 10 commandments. Where do you rate? 5 out of 10, 7 out of 10, or 10 out of 10? 5. Find a deal that aligns with all the commandments. Network with people you might know who invest, or join my private coaching or mastermind group to access vetted deals. Build a network of other lifestyle investors who share the same values and goals you do. Invest in education. Brian Tracy says, "Our lives are changed by the books we read and the people we meet," which fits nicely with the characteristics of the perfect lifestyle investor lion. They're all about having the right education and desire to learn and figure out how to become financially independent and wealthy. If you want to earn more, surround yourself with like-minded, abundance-minded people. As Tony Robbins teaches, take the top 5 people you spend your time with, add their incomes, divide by 5, and that's probably what you earn. Lions also hire a coach, join mastermind groups, read books by people they admire, and network their way into meeting them. Consider how many total years you're going to be making financial decisions. Even 1 year in a group like the Lifestyle Investor Mastermind will change the way you make those decisions for decades. There are 3 reasons you should invest in education. 1. Building wealth is a skill set just like any other. So many ways to create wealth exist, it's impossible to capitalize on all of them. But you need to have enough of an education and skill set to recognize an opportunity when it presents itself, or to find an opportunity that is invisible to most people. If you took all my wealth away today, I could build it back in a fraction of the time because I know how to do it. It's part of my skill set, and I believe other people can develop that same skill set. 2. Building wealth is more about the consistent behaviors and using a system rather than having a one-time exit event. I have never had a big payout. Instead, I have been consistent with small returns adding up over time. Understanding consistency is good when you invest so you don't take the approach of trying to hit a home run with each investment. Hitting many singles and doubles adds up over time. Triples are nice, but unnecessary. And 3, invest in yourself first. As you invest in your mind, body, and spirit, you create more opportunities that otherwise would not have existed if you hadn't been. A rich man without his health will spend all his money to gain it back. Mindset. A lifestyle investor lion is willing to learn, hungry for a better life, growth-minded, a giver, not a taker, ready to invest in themselves and others, coachable, open to constructive criticism, and an action taker. Structure. A lifestyle investor lion will arrange their life to have time to take action on what they're learning, adjust their schedule to create margin, learn and grow in their investment knowledge, leave their comfort zone, and surround themselves with like-minded people and other investors. Filter. A lifestyle investor lion possesses certain criteria. They are willing to invest in themselves first. They are willing to invest actual money. They are willing to model other successful investors. They make financial decisions based on their financial education. And they pull the trigger on the right investments. Negotiation. A lifestyle investor lion looks for the win-win in every opportunity, gives and contributes meaningfully to the community at every opportunity, serves others as a producer, not a consumer, in every opportunity, approaches every opportunity with a growth-minded partnership, and seeks to 10x every opportunity. Start now. You can become a lifestyle investor at any age or life stage. One of my clients recently told me that his 13-year-old granddaughter wanted to start a business. As he listened to her, he realized he could teach her to become a lifestyle investor just as he was becoming one himself. And that's exactly what he did. She invested her savings and followed her grandfather's instruction and took out a small loan from him that must be repaid. Today, she earns $125 a month from those investments. That amount is a lot of money for a 13-year-old, so her grandfather is teaching her how to break up the cash flow she earns into savings, new investments, and repayment of the loan she owes him. However, she certainly will spend some of that money on fun things she desires as well. That's the actions and attitude I love. One person who learns to be a lifestyle investor and takes that knowledge to teach another. It's especially exciting to see the impact it will have on future generations of family and friends. Whatever your age, you can choose to become a lifestyle investor. It's all about adopting the correct mindset and getting started on the journey. Final thoughts. Imagine what life will feel like when you design your perfect day, rate your most important freedom values, create an inspiring freedom vision, and take your first step towards adopting a lifestyle investor mindset. Review the Mindset is Everything chapter. Here's my dream for you. See opportunities you've never seen before and build the life you desire to live. I encourage you to take the next 5 big steps. 1. Reread your freedom vision from Commandment 1, Lifestyle First. Right now is the best time to anchor a vision and a dream for what you want as a lifestyle investor. You're closer than you think to achieving financial freedom, monthly cash flow, and passive income. 2. Access bonus content from the Lifestyle Investor Mastermind. Watch some of the most powerful moments from the Lifestyle Investor Mastermind education calls at lifestyleinvestor.com/gift. You'll get expert wisdom on tax strategy, whole life insurance policies, estate planning, investment criteria, and different asset sectors. 3. Listen to the Lifestyle Investor podcast at lifestyleinvestor.com/podcast. Start performing at your highest level. Get tips and principles to learn how to think and invest to limit risk, maximize repeatable returns, and achieve lifestyle goals using passive income cash flow strategies. 4. Take a 60-second quiz to find out your number one investor blind spot. Since you're listening to this book, it's because you're looking for practical, tactical resources and tools to give you a shortcut to becoming a lifestyle investor. The truth is that there are 4 blind spots when it comes to investing that can hold you back from growing your wealth. Take the short quiz at lifestyleinvestor.com/quiz. Knowing your blind spot as an investor is the first step in making changes that support your lifestyle goals. 5. Schedule a free strategy session with the Lifestyle Investor team. If you're serious about becoming a lifestyle investor, you desire to learn and build a cash flow portfolio, and you want access to my network of experts and advisors, you can save yourself decades of time in our community. Our strategy sessions typically cost $500 because, as the saying goes, when you pay attention. During these calls, it's common for people to gain major clarity, insights, and breakthroughs that affect their finances and lifestyle. In appreciation for you listening to this book, I'd like to waive our fee and offer you this strategy session at no charge. Head to lifestyleinvestor.com/strategy to schedule a free, personalized consultation call with my team to explore the best options for the results you want. It's one of the best, low-risk ways that you can experience the value of the lifestyle investor mindset and community.
Justin, we are now at part 3. We started with the conflict. We moved into the commandments. Now we're at the call. And what I love about your brand is that you really are there for everyone at every level. And what I mean by that is that certain people can definitely tap into the podcast. Certain people can tap into the book. But you also have these higher level opportunities, which are essentially a call to the lifestyle investor. I honestly think these people are an investment. You see what I'm saying? Like, people are an investment because you're going to spend your time in them. Have you ever thought about it that way?
Yeah, I mean, it makes a lot of sense because when I do select to work with someone, I have a framework that I run them through that's similar to the framework that I run an investment opportunity through.
That's cool. I like that.
Yeah, I want to know if they're going to be a good fit. So for me, it's not about taking anyone that wants to work with me. It's about finding the right fit client. It's about finding people that are the right fit for the community. So it goes beyond just who I would be excited to work with, because in some cases, it's going to be people that impact a community of others. But first and foremost, there is the first barrier to entry, which is me having an opportunity to get to know them and see if they'd be a great fit.
Yeah. And let's apply that same filter that you apply for the perfect investment for the perfect lion. Meaning, let's go back to mindset, structure, filtering, negotiation, and summary. And I would tell anyone listening to this audiobook that this is a great grid for investing anything in anyone. So let's go to the mindset. Who are these people? How do they think? What is the mindset of someone who might be the perfect lion, the one who's a lifestyle investor fit?
Well, I'm looking for someone that is willing to learn, that is hungry for a better life, for a challenge, to learn in general, someone that's going to contribute in a community of other lifestyle investors. And it's someone that has the desire to learn and to grow, and someone that is coachable. I really need someone that is willing to be coached, to take criticism in a way that is productive. And then I want someone that's willing to take action.
Yes, I love that. So action takers, people who are learners, and people who are coachable. Those are the three things that I heard. Let's talk about the structure. How is this person structured in terms of their life, in terms of their time? What is the type of structure that this person ascribes to?
Well, I'm looking for someone that's not so busy that they, can't actually take action on the things that we discuss. I need someone that's willing to move their schedule around. I need someone that is really excited to be in a position where they can learn more and they can grow their education, whether it's with me or with someone else. Hopefully it's with anyone and everyone. I'm looking for people that are willing to get out of their comfort zone as well.
I love that. So it sounds like they're growth-minded, growth-oriented people who are flexible in their schedule, meaning they have margin. I mean, it's almost an investment. These people have to be willing to invest the time to get bigger returns. What's your filter? I know you speak a lot of places. You teach master classes. You're online. You have a filter because certainly there's more people wanting this than you have time. What's your filter?
Well, in order to kind of make it to the top tier and be a one-on-one lion or private client, it's really going to be, I mean, that's the tightest filter, if you will. It's the toughest to get through. And someone would really need to have at least $250,000 in investable assets to be able to kind of have a shot in that role, to be one of the 6 that I work with in any calendar year. And for some of the other ones, though, it may not be as high of a barrier to entry, but there is still a barrier. I need to know that someone has the ability to make financial decisions. I need to know that they're willing to make an investment in their own financial education. We have talked a lot about investing in this audiobook, but one of the most important concepts that I hope isn't lost is the first place to invest is in yourself and in your education and in creating a space for you to be the best that you can be so that you can show up to a deal and have the education to be able to pull the trigger and make a smart investment.
And then negotiation. I love the fact that in every commandment, I heard a culture that you talked about where it's win-win. You don't say, I'm gonna pull one over on these people or this institution. You're really looking for the win-win. What's the win that you can bring the lion, and what's the win that they can bring to you?
So the win that I can bring the lion is that I'm always looking to give at least 10x the value of whatever investment someone may make in any type of course, mastermind, coaching, or product that I offer. So I always want to give way more than what someone's going to pay for whatever that might be. And there are obviously free options as well, and so that should be really easy to 10x. But if someone's going to spend their hard-earned money investing in themselves, then I have a commitment to make sure that I am far exceeding the expectations that they have and helping them earn that back. What I would expect from them is to be in the type of person that in a community, they're not just a taker.
Ooh, that's good.
I want someone that's going to be giving and willing to contribute to the group and willing to contribute even if it's a one-on-one relationship, with me in a coaching dynamic. I want someone that's not just going to show up as a consumer. I want someone that's going to show up as a producer and a consumer, someone that's going to give and take, and do that in, it might be more of taking than giving, but I want that at least there to be some amount of wanting to help and serve other people and support others or support our relationship in a way that's best.
I love that. That's a true partnership, and those are the ones that last. Well, now let's go to the fifth and final part of your framework, which is really the summary. So if we can summarize the call, I know you've hinted at different opportunities along the way as I've asked, but I know you're going to get a lot of people right now who say, I want the exact next step. I want the link, or I want the application. So it sounds like your website, name that one more time.
It's lifestyleinvestor.com.
So lifestyleinvestor.com. People can go and really at any level, they can not only take this conflict that you talked about, and I love it. In part one, we got into so much goodness about what people bring to the table, their past, their view of money, their relationship. And that really was a conflict that everyone has to kind of be deprogrammed. Then we got into the commandments, and those 10 commandments are fantastic. It's something I'm going to print out. I think everybody needs to just put those front and center. And then it's now the call. Shame on us if we hear something and if we don't take action. My favorite book talks about you don't look in a mirror and see that you don't look at and you leave your image. You make adjustments. And so perhaps this book was even a mirror for some of us saying, I'm not quite there yet, or I want to be there. But now let's talk about what levels. So it sounds like you do a free podcast.
Correct.
And what is that podcast going to do? Are you always talking yourself? Are you at times interviewing? Are you mentioning deals? Are you talking about case studies? What can people expect with the podcast?
It's a little bit of everything you just said. It's primarily me interviewing people that are interesting to me or that I think will be interesting to listeners, but we'll get into case studies, we'll get into deals. I'm always talking about things that I'm doing and investments I'm involved in, or maybe a new negotiation or situation. So it's a little bit of all that.
I love that. That's such a good taste. And then for the person who says, hey, I want more. Maybe they're not at the level where they can invest finances in big deals yet, but you mentioned the course. So the course is a great starter step for people that really say, you know what, I want more than the podcast, but I can't yet step into a deep relationship with Justin. Is that correct?
Yeah, and so we have an online course with several modules that people can go at their own pace and learn in whatever environment is best for them. They can show up in their pajamas if they want to, or go to a coffee shop and really just do it on their time, at their leisure, and in a series of time that makes sense for them to be able to learn and apply and feel confident and comfortable to move to the next module.
And what I love about that course, because I've seen it, is people can literally pause and they can stop and say, oh my gosh, I got that point, but I missed a little bit of it. Let me go back. Plus, there's also these guidebooks. There's these templates where people can literally pop in their information and customize it. That's the beauty of this course to me, is it's not a one size fits all. People can come at multiple ages, just like you shared in the audiobook. What did you say that you had a 10-year-old that is kind of like your youngest lifestyle investor, that granddaughter of the 57-year-old?
Correct. Yeah, she will be my youngest lifestyle investor.
And not that we need a name or anything, but is there any cap on the age, or could people literally say, I'm retired, and kind of become a lifestyle investor too?
They could totally do that. There's absolutely no cap, because someone even in the retirement stage can majorly benefit from something like this, even if they've never practiced it their entire life. They could start practicing it right now and get major value from it.
Love it. And what about the person who then can go deeper? You got the podcast, you got the course. What are some other ways that people can get involved?
So I've got a class, and the class is a real powerful one where I basically, kind of take a deep dive into a few different areas. We're going to talk about some of the common mistakes that people make. We're going to talk about some of the stronger asset classes that are out there, some of the investments that I particularly like. I'm going to really dissect a lot more of the specifics of what I do and how I invest.
And then for the people who say, Justin, you woke me up. This audiobook has made me see the light. And they say, I want to get invested in you. I want to take a deeper step. What are the one or two options for those people?
Well, I have a masterclass as well, and there are a couple of different versions of the masterclass, a half day and a full day. So that's easily a much deeper dive than the class, the first class. Mm-hmm. And then from there, people generally graduate from the master class, and the next step for them would be the mastermind. And that one, there is a cap to how many people can be in it, mm-hmm. But it's really just right fit people that want to be in community with others. They want to learn all the things that I teach. They want access to deal flow, and they want to be in a community of other like-minded investors that they can ask questions of and partner up on deals on, and really just grow together with.
And then those 6 that you work with, let's say that the 1 or 2 people who are saying, man, I qualify, I want to apply. I know you have a list, a waiting list, but what are some opportunities? Where can they go?
So there is a page on the website on lifestyleinvestor.com where they can apply. I think it's /coaching. And they could apply to be one of my Lions, which would be a one-on-one private client. And there are a couple of different ways that they can work with me. Some people want a full year program where everything is spaced out over that year in bite-sizable pieces. We have other people that say, I want that same program, but I want it delivered in 6 months. I want it supercharged and accelerated, and I want to really, shoot out of the gates much faster. And so I can take the same amount of content that they would get in a year, and I can break it down over 6 months.
Fantastic. Well, Justin, this has been an absolute blast talking with you, learning from you. I love the call to actions as well, because again, I think it's a crime to talk about something and say, oh, go figure it out. Have a good life. I know that people are wanting next steps. So, Justin, this has been fantastic. I know you've enlightened me. You've expanded my awareness. The lifestyle investor is now something that's in my vocabulary, and I look forward to sharing it with others. I know if people did find value, they could totally go to their favorite bookstore of choice online, do a review. Those are always helpful for any author. Justin, you have a heart to spread this message. And just like you wrote the book for your daughter, you really have written a legacy piece for everyone. So thank you on behalf of all those who will hear this, Justin, and I look forward to continuing to grow with you.
Thank you. And this has just been a privilege and an honor, and it has been a complete joy to be able to share so many of the things that have allowed me to live the life of my dreams. And I'm excited to help empower and inspire other people to do the same thing.
You've been listening to The Lifestyle Investor, the 10 Commandments of Cash Flow Investing for Passive Income and Financial Freedom by Justin Donald.
About Justin Donald. Entrepreneur Magazine calls Justin Donald the Warren Buffett of lifestyle investing. As the founder of The Lifestyle Investor and a master at low-risk cash flow investing, Justin's ethos is to create wealth without creating a job. He excels at simplifying complex financial strategies, structuring deals, and disciplined investment systems that consistently yield profitable results. After 21 months of investing and before his 37th birthday, Justin's investments generated sufficient passive income for him and his wife Jennifer to leave their jobs. Following his straightforward investment system and 10 commandments for lifestyle investing, Justin negotiated deals with over 300 companies, multiplied his net worth to over 9 figures, and continues to maintain a family-centric lifestyle. Justin's extensive entrepreneurial experience includes owning several profitable real estate-related businesses, one of the largest mobile home park portfolios in the U.S., various additional rental property portfolios, Orange Theory Fitness and KidStrong franchises, and multiple successful operating companies. One notable venture is Stellar, a residential maintenance and rehab company that Justin co-founded that recently completed its Series B funding round led by Illyrian Ventures and S3 Ventures, the largest venture capital firm in Texas. Justin routinely publishes his wisdom on lifestyle investing as a member of the Kiplinger Advisory Collective. He has also been a South by Southwest investor judge and a keynote speaker for organizations like Keller Williams and Entrepreneurs Organization. He is a member of Tiger 21 and serves on the board of Front Row Foundation International. Through his Lifestyle Investor Mastermind, Justin now consults and coaches entrepreneurs, executives, professional athletes, and successful media personalities on lifestyle investing. He hosts the Lifestyle Investor podcast with the aim of helping listeners consistently generate repeatable returns. Justin has appeared on hundreds of podcasts and shared prominent stages like Texas Rangers Stadium with renowned leaders like Richard Branson, Robert Kiyosaki, Sam Zell, Ron Paul, and Kevin Harrington. In January 2021, Justin released his #1 Wall Street Journal and USA Today best-selling book, The Lifestyle Investor, The 10 Commandments of Cash Flow Investing for Passive Income and Financial Freedom. The book is now in the top 1% of all books ever sold, with all proceeds donated to the Tim Tebow Foundation and Love Justice International, 2 nonprofits that combat human trafficking in over 50 countries. Justin and his wife Jennifer are dedicated philanthropists who contribute to various causes privately and through their church, with a primary emphasis on fighting human trafficking among other humanitarian efforts. Additionally, they sponsor several children through Compassion International. The Donalds reside in Austin, Texas, and love adventure-based international travel with their cherished daughter. Connect with Justin through his website, lifestyleinvestor.com, through email at support@lifestyleinvestor.com, on LinkedIn at linkedin.com/in/Justin W. Donald, on Facebook at lifestyleinvestor.com/FB, on Instagram at Instagram.com/JustinDonald, and on x.com/JWDonald1. Final note to the listener. I hope you enjoyed this audiobook. You now have the clarity you need to save more time and money. To experience the full benefits of this content, I encourage you to access further content associated with this audiobook. Please visit lifestyleinvestor.com/gift. When you do, you'll learn more about earning passive income, long-term equity, and how to achieve financial independence while gaining total freedom from your business or job. You'll also discover courses, webinars, masterminds, and coaching opportunities designed to help you put the lifestyle investor to work for you. Simply visit lifestyleinvestor.com/gift, where you'll have access to free video teachings, podcasts, and more. One last time, that's lifestyleinvestor.com/gift. Want to start your lifestyle investor journey quickly? Visit lifestyleinvestor.com/class. I'll walk you through a step-by-step system to reach financial freedom with cash flow investing and passive income. I'm Justin Donald. Thanks for listening.